Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys.
Right. Good morning, everybody. Welcome back. Happy Wednesday to you. Let me share my screen. Sorry about that. Busy morning as always. Hope everybody's doing well. Just putting out fires. That's the name of the game. We're just surviving out here in terms of the Edge Finder is this kind of, I love it, but it also is, it's like the troubled child. I always have to be on watch, fixing stuff, repairing stuff, updating stuff. Right now we're doing an overhaul of our tutorial guides on how the Edge Finder function, and it's just a bear of a project. But you guys don't care about that. I'm not complaining. I got a great job and I'm happy to be here. So let's talk some markets, see what's going on. So today, what's on the radar? Well, today is Fed Day. Today is really key because you have a couple things to look out for. So you have the FOMC statement, the economic projections, and the rate. They're not going to change the rates today. That is virtually not, it's just not going to happen. But the projections for future interest rate cuts are really what the market's going to pay attention to. You also have the press conference at 2:30. So it's a huge day. It doesn't automatically get data. No, it does. The Edge Finder's pulling all this data, but the data pulls and checking on the the validity of the data and just seeking out bugs and errors. It's just bug fixing. That is programming 101 is like you spend a ton of time just improving things. Cameron, thank you very much for the $2. XRP case dismissed. I'm not too familiar with the XRP drama, but I would imagine if there's some kind of case dismissed, it would be good, right? Up 8% today. XRP, very nice. Cameron, thank you again for the $2 donation. I appreciate that. How is crypto doing in general in all this chaos? I mean, it's not doing great, but it's not doing as bad as I would have thought. 10% pullback. Well, let's think about this. So SP500 had a 10% correction. What did crypto do? Bitcoin did 30. Now, Bitcoin is the kind of quote unquote index of crypto, right? So obviously certain other things got crushed more. Ethereum from its recent highs down, oh my God, 57%. And that's not from its all-time highs, right? The all-time highs for Ethereum, we're still looking at a 64% drawdown peak to trough recently. It's pretty good drawdown. Actually, thank you very much for this comment. We have seen it. I've just sent that. Actually, that was one of the things that I was working on this morning. It's just a typo. Instead of year over year, this is quarter over quarter. You are correct. So we've got that. That'll be fixed soon. The data is correct. It's just the naming convention here needs to be changed to quarter over quarter. So that's what I mean. A lot of the day-to-day operations at A1 are just like fixing a little typo or changing the calculation or changing the color coding of these pages. There's a lot of stuff. And then sometimes it breaks and you're like, oh, well, we got to go fix that. So that is the headaches of, the software side of things. But fortunately, I have a great team that helps me out with a lot of that stuff. So we are on top of it and we'll make those changes. Don't worry. When are you managing your gold trade? Great question. Let's look at the gold trade. Nothing to do here. Hasn't moved today. Maybe a little bit up, a little bit down, but nothing really serious today for gold so far. You still have, like I said, the Fed meeting is likely to move everything. You're likely to see volatility for stocks, for commodities, for currencies. Everything is likely to move on the dot plot. That's really what's interesting to me today is the dot plot. The dot plot, if you are not familiar, the Fed dot plot basically is just a map, right? A projections map of where Fed officials see interest rates likely going in the future. And these people are, in theory, or supposed to be some of the top economists of the world, right? So their projections of where interest rates are going is very, very important to the market. Carlos, thank you very much for the €2.49. I appreciate you on that. Thank you so much. Is gold just turning around, Nick? What's your opinion on the 30-minute chart? 30-minute chart, you got it. Also, just a quick plug. We made a channel membership, and this is kind of sad. We don't have a single channel member, and I wish that I could give away, and I think there might be a way to do this. James in our office mentioned there might be a way to do this. I'd love to give away some memberships on my YouTube channel if that's a possibility. But if you want to become a channel member, the reason I made that, we came up with the fun idea that during live streams, when somebody drops a donation or becomes a member or a member asks a question, it shows up big on my screen. So if you want to ask questions and help guide the stream, consider becoming a channel member for like $5 a month, and you can ask questions. I'd love that. I think it'd be cool to have our first channel member. I was like, man, that's actually kind of maybe we need to improve it. But honestly, we dropped the price on it just to make it so that we could get some members. But I think it's a couple bucks a month, and you get if you're here for hours and hours and hours, it's like a subscription. Why not consider it? And you'll be supporting our work. And we go through a lot of coffee at A1. That was my my joke on the thing is we go through a lot of coffee. You're funding our coffee purchases. Anyways, Carlos, thank you very much for the donation. Let's take a look at the gold chart. Why not? Oh, thank you, Chandler. Dropped a link to become a channel member if you are interested. Again, there's no pressure, but if you want to ask your questions, it'd be cool to have some members and ask questions. So gold 30-minute chart, really pretty range bound here. But I think, Carlos, I want to look at the 30-minute chart, but let's just do a top-down analysis really quick. We'll get to the 30-minute, I promise. So gold on a daily chart, solid, incredible momentum. This is a beautiful chart. The longer I do this stuff, the longer I do trading and investing and all this stuff, the more I realize that this is a beautiful chart and you don't want to fight it. Okay. So because people have just been getting killed by gold. Let's be real. And I'm not teasing at anybody who has painfully fought this trend. Okay. I'm not laughing at you. I'm not trying to hurt your feelings or anything like that. But gold teaches lessons year in, year out. Gold typically does this insane thing. It's like a wild dragon. It goes so much higher than you think it will. and it goes so much lower. It is literally like a dragon. You know, dragons can like skyrocket into the high sky, or they can just nosedive and then, you know, crest off the, you know, right before they hit the ground. And dragons are crazy. Okay. Gold is a dragon. That's the best analogy I can think of. So gold, this dragon just keeps going higher and higher and higher. And so many people try and slay the dragon. They try and call the top on gold. It is just the crux of the retail trading community. Gold's got to come down. Gold's got to come down. And what does it do? It just rips their face off and keeps going higher. Now, that won't happen forever. But hear me very clearly with this. If you think you can call the top on gold, you are very likely mistaken. You could get it right, but here's my thought on gold, okay? Very solid uptrend. The dragon is powerful. I ain't fighting this dragon, okay? I'm trying to ride the dragon, trying to go with the dragon. So I'm buying pullbacks. That's what I did over here, right? So people were getting super bearish on a couple days down on gold, and that was a great buying the dip opportunity. We had a lot of fundamental catalysts and continue to have the same reading, by the way, on the edge finder. So I will, like I said, I will get to the 30-minute chart, but I want to start with context here. Daily chart uptrend, bullish reading because most of the economic data shows cool economic data for the US dollar. Weaker US dollar, momentum to the upside. Seasonally, it's a great time to be long gold. High probability trade, scouted out by the edge finder. Pulled back for a few days. Boom, I got long. Was that a guarantee that it was going to go higher? No. But I would say that was a pretty high probability trade when I took it. I felt really good about the trade when I took the position. I managed my risk. I put my stop below here, and I'm trailing stops now. Someone asked me, how am I managing this trade from here? Well, I've got my stop loss below specifically the 4-hour level of support, just below this consolidation. So consolidated here before we ripped again, right? If we come down here and test that area, perfectly fine. No worries. I won't bat an eye at this. If gold comes down to this area, there's a good chance, not a guarantee, but a good chance that I think we would see some response from that and that we could continue to go higher. That's the 4-hour chart breakdown. So where did I put my stop loss? I put my stop loss below that level. If that level gets invalidated, then I want to just get out of the trade. I'll take my profits and move on. And some people might say, oh, well, Nick, that's where the liquidity grab will occur. Maybe, but I've done this for a long time. And a lot of times when I try and get fancy like that, I just miss opportunities or I overthink it. This is just a consolidation zone. I really would like to see price bottom out before we even get to the bottom of that range. Some traders might play the liquidity grab. They might do that. Do your thing. If that works for you, I just keep it really, really simple. Consolidation support, right? If we come down to this area, I want to see it react. If we don't, just take me out. I'll look for a better opportunity at another time. And maybe that's the low. Maybe I get, stopped out. People are so afraid of getting liquidity hunted that they just like, they'll move mountains. They'll change their strategy. They'll take more risks. They'll do anything not to get stop hunted. And this is what they'll do. They say, well, if I just put my stop loss down here, then I can avoid the stop hunt. But then by doing that, by getting all fancy with it, what did you just do? Well, when it does this, sometimes you just added a whole bunch of risk to your trade thinking you were going to be smart and catch the bottom, right? Like, just keep it really simple. That's my opinion. We have a consolidation low here that we broke out of. If we come back into that area, let's not overthink it. Could we get stop hunted? Maybe. But most of the time, a good level just holds. In my experience and my approach to the market, I don't need to get fancier than that. Key level, 2980. I'd like to see that level hold. I really don't want to see it go much more below the 3000 to 2980 level to stay in the trade. Okay. I promised we're going to make it to the 30-minute chart. We're almost there. Let's do the 1 hour consolidating after this big break, right? So that consolidation that we just got done discussing is a lot more visible on the 1 hour chart. You can see where we broke out, or you can see we just look at that beautiful, just regimented buying trend to the upside. Now we're doing this again. We're consolidating. So as we get closer to that 30-minute chart, right? What are we doing? We're just range bound. So if you are bullish or bearish on gold, I think you need to wait for some sort of decisive move. Let's make it to that 30-minute chart like I promised. Here's the 30-minute. Pretty much the same context as the 1 hour. We've got a level of support here. We've got the resistance at the all-time highs. If you're a day trader, if you're a short-term trader, and you have a bearish reasoning, if you are bearish for whatever your reason is, I don't think there's a good reason to be bearish. That's my opinion. You do what you want and you do your own strategy. Don't listen to me if you have your own strategy and you're making money and you've back tested it and you're comfortable doing what you're doing, do not let me talk you out of your trading strategy. Like, I'm not here to do that. I'm not here to give you any advice. I'm here sharing my thoughts, my opinions, and my experience in the market for the last, almost a decade. So my point is, I'm if you have something that works for you, do you. But for me, the higher time frame is important. Fundamentals are important, and they're both bullish. So I'm not looking to short. But if you were to get bearish on gold from a technical basis, the bare minimum I think you would need to see is to change this pattern of uptrend, consolidation, uptrend. You would need to see this uptrend consolidation and then actually failing out. But again, the difficulty that I see with trying to take a contrarian or a bearish setup on gold, the problem is you're fighting a really strong dragon. Like I was saying on the daily chart, if you want to try and call a top, go for it. But again, it's been a really, really rough time for the people who have been bearish the last few years, but last few months. I mean, you had some good bearishness over here, but and will gold be in a forever uptrend? No, there will be a point, but there will be a point where it starts going bearish. But I've been beat up too many times by the market to say I know where it's going to turn bearish. Okay. The bare minimum, Sebastian's got it. So that's I hope that was helpful to you. Again, thank you very much for the donation to the stream. It's going right in our coffee tin can fund. S&P 500 up 0.2% here today. Nothing crazy. NASDAQ. Again, I think a lot of stuff is going to just be consolidating for the morning here as we wait for the Fed to present their dot plot and when we hear from Jerome Powell during the press conference. It should be a pretty volatile day. With the dot plot, that's going to give us an insight into what the bond market thinks, or what the market in general thinks the future rate cuts are going to look like for this year. Some people think we're getting 2. Some people we're 3. Some people think we're getting 4. Some people think we're getting 0 rate cuts this year. And how you view the economy, how you view the data that's coming in, and also think about the tariff stuff, that's going to impact the projections. So if you think that tariffs are going to, let's just think through this for a second. I would ask you to do your very best to check we're going through security right now. Take your politics out of your bag, set them into the security thing, and then we're just going to light them on fire because we're not here to do politics. But set your politics for aside. Think logically about tariffs. Do you think tariffs are going to cause tremendous inflation, moderate inflation, little inflation? What do you think it's going to do to growth? Do you think tariffs are going to cause a massive contraction in growth? Do you think they're going to cause a little contraction in growth? That's what the Fed now has to think about too. The Fed is looking at all of these data points that we discuss so frequently when we talk about the U.S. economic heat map. When we look at, look at that got changed. Thank you to Giles and Frank. Appreciate you guys. When we look at GDP, when we look at PMIs, when we look at retail sales, when we look at inflation, the Fed is looking at this stuff too. But what's making markets so volatile, you want to get to the crux of the volatility recently. Why has the market been so crazy? It's because tariffs come with a big old fat, and it's fat, question marks. Okay? Plural. I mean, it's a lot of question marks with this. Again, are tariffs, let's go through some of the facts, okay? Are tariffs going to cause prices to go up? Undoubtedly, yes. There is no question. We have heard it in company earnings reports already. Target, a big retail outlet, Walmart, Costco, they've all been very clear. Tariffs, we're just going to raise that price and pass it on to the consumer. Because businesses are not just going to take a margin cut in their profitability due to higher import costs, right? Places like Walmart and Target, they do a lot of their inventory comes from other places. Now, don't hear me wrong. I'm not saying inflation spiral like 2021, where we just went into this unending inflationary problem. I don't think that happens. Where I think this discrepancy is the debate is not if tariffs cause inflation. You want to know what the economic forum debate is right now? It's, does it cause persistent inflation or temporary inflation? Dare I say transitory inflation? Some of you might remember from 2021 that ended up being famous last words for the Fed, right? So that's something to think about. Carlos, thank you. Wow, a double donation. Really appreciate you on that. Smart and solid answer. Would love to have more chat. Carlos, we're here Monday through Friday. Come anytime. Ask your questions, and I will do my best to answer them. Yeah, exactly, right? Transitory. People have some terrifying flashbacks to that word. But in 2018, did tariffs cause massive inflation? The answer is no. Inflation actually in 2018 pretty much remained unchanged. Why do I point that out? Well, because we had tariffs in 2018. Trump was president, put on a bunch of tariffs with China. You can see there's the big Trump sell-off with the tariffs, right? Was there inflation? It didn't really materially form in the market. There were price hikes due to tariffs, but the inflation did not match up to the feared stuff, and the market bounced back. Now, to be fair, some people are saying this time it's different. This time we've already been battling with high inflation. We don't need a bump in prices again. That's fair. That is fair, and that is a fair concern. My personal take on it is that I think there is likely to be the bigger question is growth. If you disrupt a bunch of global trade, could it be inflationary? Maybe, maybe not. But what's more likely to just be straight up difficult is growth. We could see growth take a hit, right? A lot of global corporations rely on the way the system is currently. That being said, the optimist would say, okay, maybe we have tariffs, maybe we have short-term price increases, and maybe we have a whole bunch of government layoff stuff, and maybe the private sector picks up the slack and starts hiring a lot more people. That's the hopeful side of things. We'll see. S&P 500 still flat on the day. Again, I really think that today you're waiting on the dot plot. That is going to be this afternoon. We will be streaming pretty much all day, which will be fun. Do me a big favor, if you're enjoying the show so far, hit the thumbs up button, subscribe. I really appreciate the support. What do you think about silver? Silver and gold. Oh, wow. Look at silver down 1.23%. Gold's holding up a whole lot better than silver right now. I'll tell you that. I actually like silver pullback, although I don't think we currently have. Let's see, top setups. Yeah, silver's still a neutral reading, so probably one that I would skip. Euro, pound, still getting bullish readings. Pound and euros trying to pull back. I would actually love to see them pull back more. Pound could give us a quick shoot to the downside. That would be great. 1.2750, 1.28. That would be awesome. Do you do installments with your Edge Finder? Yes, we do. If you'd like to find out more information about that, our flexible pricing, you can send us a direct message on our website, a1trading.com, or make it easier. We'll drop the link in the chat so that you can speak directly to our support team. If you'd like some information about the Edge Finder, or you'd like to explore our payment plan options, just feel free to chat with our support team and we'll help you out there. There's the link. Okay, Ivan is coming up next, guys. We're gonna take a look at some markets here in just a second. I'm gonna play the marathon rate here today. I'm gonna be streaming pretty much all day, so I'm gonna let Ivan go for a few minutes by himself, and then I'll join back with him. I'm gonna go get some water and just take a second. Ivan's gonna be taking over the stream here. I'll be right back in just a bit. After this, Ivan takes over. Stay tuned.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show.
Hello everyone. I hope you're good. It's a bit long time ago since last time, but I'm currently looking at New Zealand Canadian dollar, where Canadian dollar yesterday came out with shocking high inflation. So I thought, well, why not New Zealand CAD then, mate? I don't know how they speak in New Zealand, but somewhere in the essence of Australia. So I'm looking for ever so slightly a short position on it. Can look at CAD Swiss. I sure will. And I don't think it's going to be a short position. The reason for it is I believe that tariffs is inflationary thing because, well, it's both sides arguably, but I believe we're going to come out higher because the reason why you have trade is because something is better, cheaper, faster. And if you can't get it cheaper, faster, or whatever you did, then you have to have someone who's inexperienced at a higher price, doing it locally and at a worse quality. So that's why I believe inflation should come up. Bibo, aren't you a comedian? No, I have never been given a comedy show, but hey, you never know. So, beyond that, dollar CAD looks like a sell-off. Yeah, I can agree to that. So the reason for New Zealand, we'll agree that they have low inflation, they have low activity, they have a negative GDP, they have sour consumer and business environment. They cut twice and they're going to cut again next time. So why not, right? So, and then Canada is now having a bit of inflation issue. Maybe not, maybe so. British pound Canadian, not really what I was thinking, but there was one more I looked into. It was Australian dollar Canadian. This is equally, I would argue, equally a good, at least fundamental. I don't know if it's an equally good setup, but Canada seems to have a good Canada day today, not Canada as in their national day, but seems to have a lot of strength coming into it. I like that. CAD is also making a bit of a higher high. So in that space, where are we with the dollar? Oh, CAD Swiss it was. Okay, sorry, my bad. It's a bit rustic. I haven't been here for a long time because I was not here on Monday, and I was like wondering why I'm not here on Monday. But hey, here we are back. Okay. Yeah. But okay, let's go back to I'm the mentor, right? Who said it? It was EG says, what about a sell opportunity on cat Swissy? Everyone knows that is a sell opportunity, right? Everybody knows that. That was about 18th of February. And then everybody knows that was a second opportunity. Those are your primary, where I want you to start selling off, right? So your problem right now is that market has fallen about 300 pips. You have fallen about 1, 2, 3 weekly target. You are in about monthly target. What I mean by this, and this is Pivot Points is available for free, it's just that you have hit support levels, you have hit beyond the aggressive support levels, so that the ones that you would agree with selling with you has already left the chat. What time frames do you trade, bro? Baji, you know me. 4 hour and then 1 hour frame trade. So I can agree with you, IG, that a cat Swissy is bearish, but I want to argue that it might not be the best opportunity because it has already done what you wanted to do. And is it going to continue? It can continue forever until whatever. But I don't like this pullback or how we have acted around 0.60 because that looks awful lot to take a profit to me. Yeah, that is okay. That is okay. That is your opinion. And you're very much allowed to do that. Then let the market show that they're going to break 60 again. Then we're good to go again. But right now, I more than anything else technically see this one having a bit of a field day higher again. I don't know if we're going to go back up there again per se, but this speaks reversal to me. That's all. So Bank of Japan had a bit of a meeting today, and I, as much as you are, I was wondering like what happened. What did they say? Well, they said something about that the wage growth was a bit higher than anticipated, but ever so slightly on target. The economy is recovering moderately, but there is still some weakness still left. And that, they left their policy unchanged and expected at about 0.5. The question going forward is, of course, are they going to continue their ever so slightly rate increases? And I would arguably say yes. And as far as I understand, Governor Ueda is that he sees I would argue the bullish sides to everything here. So, in that sense, Bank of Japan is bullish. Why is yen as of right now falling? That could be a couple of reasons. One is we are pricing out risk at the moment, because we had a lot of risk in the previous weeks, and we have somewhere time now in between the tariffs that we are risk on. Okay, but for the yen, also we did not see any definite. We're going to start increasing interest rates very soon. So that again, you need to price that out, take off your positions, and say, okay, hey, we might not be as aggressively higher as we previously thought. Okay, then yen has a bit of an unwind, and then we'll make it through the day or whatever. So, other than that, but by the way, I've tried to look into sells, but didn't work it out. So for me on the yens, I'm still bullish. And right now on the yen pairs, we are making higher highs. And I did not join the bottom in the bullish side. So I guess I can. Mamma mia, but it's not really good to be buying so late. Yeah, Japan carry trade unwind. Then we would be falling if that was an unwind of the carry trade. Yes, Bashi, I really love the British pound yen as well, but it's like being slapped twice, left, right, and center. So you have to. And by the way, in my back test, in my performance, and in how I trade, British pound, Japanese yen is the one that kicks me most in the leg and gives me the most losses and gives me the most remorse. Okay, so there is that. S&P 500 is, I have seen Nick talking about saying, well, we can go higher than fall. Absolutely. I would argue that we are carefully trying to convince the market to go higher. Yeah, also you need to, you need to really love being slapped. Maybe your cheek will be a bit red by the end of it, but it's only survival of the fittest. If the Japan increases interest rates again, yes, the yen pairs will move lower, yes, but it's not likely as of now, as of today. Therefore, is having a breather. So when that is likely again, then sure. So what you need to really look at is their next inflation, because Japan's inflation is now 4%, as far as I remember last time. And if that continues to be, then they have to start increasing interest rates again. So we'll see. I would argue this is a bottom that everyone sees to try to buy into. That probably is your trade idea. But remember, some of the trade tariffs has been postponed until April. That can come back, and that means that we are can continue falling. That is your risk, but that does not mean that you're not allowed to and able to look for a buy here. I have not been able to, as of yet, to find a buy. I probably should have bought this level, but for me and my technical analysis, it's a bit too early. What do I mean by that? I need a break of that, then a pullback. So I need that. In my positions, I will make 50%. It's a 50% chance to buy here. So I would lose and win some. But if I do here and I do there, I would go up to 70% win chance. So I would rather wait for the 70% win chance rather than the 50. And more than anything else, if I'm thinking of what to do on SPX, if that is even a possibility, if I know that all retail traders will be buying, I will be looking as a institution. I will be looking to be buying around 5.5. That would be great to take out all the stop losses and then turn it higher. That is 100% your risk at the moment. What do you think about Jerome Powell? He has to be bullish. He has bullish, not really bad. He has to be more hawkish. He has to be like, we're not going to do anything. We have to look into what is the risk is too high. He has to say that we're not going to cut anytime soon. May is too far away. We have to be data dependent, and market price in a more likeliness of cutting in June, as far as I remember. May is like, not really. I think he has to push. He has to push the May meeting. Well, inflation came a bit lower. We have a bit of a weakening, I would argue, data at the moment, as Nick has proclaimed it to be. But I really want to see the April inflation for me and Powell to be potentially at least on the same side. So he's probably going to say something in that direction. And if he doesn't, if he is dovish, market not going to do anything. But if he is hawkish, if he is like, well, we don't think we're going to cut anytime soon, dollar is going to go higher. So yeah. JP is very good at giving no information like a secret agent. Not really. Then you don't understand him, Bashi. He is like a brother that protects you, that tells you what he's going to do, but you are like you're pulling out of information out of him, and then you have journalists asking whatever questions those are, which is basically the same 3 questions, just in different variations from all the different journalists. That is okay. That is just their journalist jobs. But if you look at what Powell says over time, he's ever so slightly changing and he's adapting to the narrative. But because what happened back in COVID, back in 2020, back in March, they made emergency rate cuts without announcing the meeting first. They just did it. So he can act if it's necessary, right? That's where you have him. You feel like he's saying nonsense, but we're actually having the economy in ever so slightly at the moment in a good position. But you have to look at his speeches when he changes stance. But then you've already expected it to happen. So for you, it's like, oh, it's no new news. But that news in itself is value in itself. Okay? So just for them to say that they announced that they were starting their cut cycle, we're now starting to cut for the first time or whatever. That was expected by the market for a long time. But just in itself, them cutting is dovish by itself. And remember that for you, or for him, it's news to say it, but for you, already expected it. So, take a grain of salt of him. He's a good guy. Love him a bit. Give him a hug sometimes, please, for me, okay? You said dollar's going to go up today, cause inflation, so we wait to have a pullback on the FX pairs. So, what I said is that the market has positioned itself bearishly on the dollar. What does that mean? That means that they have sold it off like a ton of bricks. They're expecting recession. They're expecting rate cuts. They're expecting the Fed to come out and say, hey, we are going to, we are very worried about the economy. We are seeing inflation coming in lower, A, B, C, D, E, F, G. That's what the market has priced themselves in. But I don't believe, and I see, and my opinion is that, before he says it at least, that he does not have the data to say that we are worried about the economy. Therefore, he's going to sound more hawkish because the market has pushed itself to a corner that there's no more dovishness in it. There's only upside, because the only thing that Powell can do to continue this bearish trend on dollar is to open up for massive or more rate cuts this year than they have done before. But with inflation coming down to 2.8, he doesn't have the data basis to do it. You feel me? If Powell is hawkish, okay, less dovish. Sorry, maybe not hawkish per se, but less dovish. If Powell is hawkish, how would SPA react vice versa? New chatter here. Dollar would rise. SPX, I would arguably maybe have a bit of a bearish, but in that scenario, stocks can still rise. That is not judgmental to their. The only that it's bad, really like horrible, quote unquote, for the stock market is if he comes in and raises interest rates. Because I've talked about I've talked about this before, but ever so okay. If CPI start rising, we have 3%, we have 5%, okay? That is threshold, that is very crucial, okay? This is CPI. CPI rises beyond 3% about here. When we have when we have interest rates, sorry. When we have interest rates, they come out later and they react later. So you would probably see you'll probably see something in this direction. Let me see if we can just move it a bit more. So lower, by the way, and later, and more like that. And when you have interest rate rising later at a slower pace than inflation, which happened because inflation went to 9% and interest rate only went to 4.5 or 4.75. So it's later. So market and dollar has already risen by the time interest rates start hiking. So there is that delay, I would argue, from here, maybe from here, oops, I can't even do it. From here to here in that time period, and last time in 2021, that was about 9 months. There is no negative costs to the businesses, so they just make more profit before it costs them more financing it. So therefore, there is a period of rising inflation but not rising interest rates where businesses are making more money, and that stock market loves it. Stock market loves it, and I can show it to you. I don't know why we're on this trail today, by the way. Is this fun trail? I don't know if this is a fun trail, but that's a trail at least. So 21, that's about June 21. We had increase of interest rates in about March 15th, 22. And the market got a sniff about 5th of January that we're going to have rising interest rates. But this time period and inflation, I think at this point was about 7% or so. I don't know why I said 7% or so. And at this point, it was about 3 going up to 4. So 4% inflation rise led to an increase of stock market price of about 15%. When did live start? About 9:20 New York time, Eastern time. Are you a fully fundamental trader? No, I use fundamentals, I use sentimental, I use seasonality, and then I use technical to trade. Bashi, you're never gonna make me angry. Okay, you are gonna make me angry. If you ask me horrible questions, I'm gonna be angry because do you know why that makes me angry? To ask me bad questions? Because no question is ever bad. There is no bad questions in my vocabulary. I'm your mentor. You have to ask bad whatever questions that you have so that you can move on. Reverse psychology. There is no bad questions in trading. Because somebody just asked, are you a fundamental trader? Is that a bad question? I've answered that a million times. New Zealand dollar looks to have good for long on the daily chart. What do you think about it? I think that New Zealand dollar should have a bit of a bearish turn. I did not predict it was going higher, and now it's having a bit of I tried to sell it, and it has a bit of a higher highs and higher lows, and maybe it's coming down now. That would be great, right? Sean says, where the order block? I have no clue about order block. If there's one thing that people talk about, order blocks and not OBWGN, but OBs and all those things, no. I have no clue. I respect those people that talk like that, but I have no clue. You tell me and I can tell you. We are speaking two different languages. It's not even Mandarin. To me, it's not even a language. It's different words that has no meaning to me. No, I respect people who does order blocks. Oh, Sean. Oh, yeah, okay. I almost went into the trap. Oh, okay. All right, I need to be. No, I honestly, also, if you're gonna tell me about wave theory, I will fall off. I will fall off the chart like dollar dead. I will fall asleep. But if you tell me that we enter the same we enter the same place at the same time, and we all kind of make money out of it, then cool, great, love it. Just I'll just click. I will just click on my own videos then, or I will watch Nick instead because I understand Nick. Nick understands me, hopefully at least. And I say that your dollar is too high for me. I would love to sell your dollar, but there is very good reasons for why your dollar is higher. But I can't sell it. I need to look like this. So, in the meantime, I make jokes. Can you tell me about the algo? Yeah. Yeah. Well, somebody does. But yeah, and I think, yeah, I saw someone in chat, by the way, but you can also, I maybe they work best as wave engineers, how to make energy out of waves. I know that you're pushing maybe you're pushing some kind of electrical engine of some sorts with the wave, but why haven't we made a lot of wave machines around our coast? We have so much water waves, and we have 15 meter, 20 meters, or 60 feet of waves in the ocean. Why can't we make electricity out of it? Right? But what I understand, and the language I understand, is that dollar CAD is my worst performing trade pair. So I have no clue. You tell me. You're probably better than me, Nick, on dollar. But yeah, I'm having fun.
What's up, Ivan? I'm glad you're having fun. I wanted to show you something. You were talking about earlier the stock market sentiment. I thought this was really interesting. This is, I know this is a little foreign language to people who don't ever trade options. So bear with me for just a second. This is Tesla puts, okay? Now, the reason I bring this up is Tesla puts were super popular a couple of days ago because when the market's crashing, what do people do? They go buy bearish bets, which are puts on the market. I just wanted to show this because this option, I've been watching it pretty much all week, put contracts. The current price for Tesla is around $232 per share. Mm-hmm. Well, the puts that people have been buying, and this is why I caution people when you get super bearish on the stock market, you have to make sure that when you do that, you're not doing it when everybody else is. So the put to call ratio went crazy here recently. And check this out. Mm-hmm. These put contracts have lost almost half their value this week already. Well, this is actually more than that if you consider the last few days, but this is just today's losses. The reason I show you this is that, Ivan, we've been living in this kind of stock market correction, and what I find so fascinating about this is that as the S&P 500 and the NASDAQ dropped, what happened is that people got really, really scared and started believing that the market's going to crash. And you and I have been doing this for a long time, Ivan. What we know from experience is that when everybody rushes to one trade and thinks it's the easy trade, aka buying puts and betting that the market's going to crash, that was the theme the past few weeks. And the put to call ratio skyrocketed. Now, the put to call ratio just shows you the ratio of how many puts versus calls are being transacted in the market. People rushed like crazy with their wallets out to buy bearish bets on the stock market. And now the market has bounced, and all those puts, many people lost a ton of money this week buying put contracts. There's a huge amount of volume that goes into the options market. And the reason I point that out
is because for some people out there, and I'm not picking fun at somebody who did this, but a lot of people, see the market dropping. They see something like Tesla and they're like, I'm going to short this thing and I'm going to make a ton of money. The difficult thing about trading, the difficult thing about the markets is there's no free lunch. When it's obvious that the market is correcting, everyone goes and buys puts. And if everybody buys something, it gets very expensive. And so as we have just a moderate bounce, all those people who bought puts got crushed. So it's just interesting. I just wanted to point that out, just a phenomenon about markets. Ivan, you and I talk about this often. Chasing is dangerous.
Can I ask a dumb question?
Mm-hmm.
Can you go back to the Tesla put situation?
Yes, hold on. Let me just pull it up on the live.
Because how can something lose 50% of their value?
Yeah. So if you were looking at Tesla puts, right? So we've selected puts. We're on Tesla.
And explain Forex terms.
Yeah, I'll try and keep it as simple as I can. So like let's just say, and options are complex, so totally understandable if that came across as confusing. Let's say that in 9 days, I think Tesla's going to go much lower than $232 per share. I could just short, or I could buy puts, which are basically leveraged bets. I could buy a put, and that would give me the ability to make a big bearish bet without contributing as much money. That's why people love options, because small accounts can blow their account or lose or make a ton of money really quickly. Well, that's why they are so volatile too, is that if you buy this put contract and the market drops, you make a ton of money. But also, if the market doesn't go down in the next 9 days, you lose all of the money that you bought the put. So if I spent, let's say I go put $1,000 on Tesla puts, and I think that the market for Tesla is going to drop hard. If it does, I can make a lot of money. I could turn 1,000 into $5,000. But a lot of times what happens is you just get 1 or 2 days of sideways action, or the market bounces a little bit, and that $1,000 kissed goodbye. And that's what happened to a lot of traders this week. Even if you're bearish, right? Even if you are thinking like there is some more downside to this market, just be careful when you get bearish. If you chase stuff, it gets ugly quick.
So it almost sounds like binary options.
It is. It's very similar. Just not just for stocks.
Can you exit the contract on the 8th day? But do you lose all your money then, or is it gradual? Like
so the contracts have changing value. They trade, the premium to the option changes over time. So if I'm looking at Tesla and let's say I buy a call, right? Let's say I make a bullish bet.
Yeah, you think it's going to go higher? Yeah.
So if I think it's going to go higher, and let's say the expiration day is this day right here, this vertical line. If it's trading here, I lose all my money. If it's trading here, I lose all my money. If it's trading here, I lose all my money. If I bought calls, if it's trading here or here, I can make a tremendous amount of money. So you lose money. Now you could close it at any time during this P&L. But as you mentioned, it typically loses value over time simply because you're running out of time for that option to make a move. Hopefully that makes sense.
So I can become a millionaire shorting Tesla before the fall?
Ivan, you can do a lot of things, but I think shorting Tesla is so much easier said than done. Now, I guess in recent times, people made a ton of money shorting Tesla because this thing's crashed. But nothing easy. Just wanted to go over that. And just more importantly, even if you're not an options trader, just be careful with chasing markets. It's really tempting and easy to get lost in that. So just something to think about. Ivan, thanks for the segment you did and sharing some thoughts on. I saw you talking about the Canadian dollar, talking about the New Zealand dollar. So appreciate your insights on that. And for everybody who is watching with us live right now, Ivan does one-on-one coaching. It's something that he specializes in. If that's something that you're interested in doing, if you'd like to work with Ivan on a one-on-one basis, you can actually send him a direct message in our Discord channel if you're in there, or you can find him on his YouTube channel. We've got the link. We'll drop that in the chat here for anybody who would like to check out Ivan. Make sure to go check out Ivan's YouTube channel. You contact him there, find out about his coaching offers if that's something that you're interested in doing. Ivan, thank you very much for coming on today.
Thank you for having me.
See you, man.
Okay, guys, up next, the options pro himself, Chris Pulver, is going to be on the stream talking a little bit more about what is happening with this market. Big sell-off here recently. We're starting to see a bounce. We'll see if that materializes into something bigger. Guys, we are going all the way up and through the Fed meeting today. I will be back for another segment with Chris Pulver later on today, I believe, 1 p.m. Eastern. That's just a couple hours away as we count down the minutes to the Fed minutes. So actually, it's not minutes. Dang, that was almost crafty. The Fed economic projections, the dot plot, and the statement, as well as the press conference. Big day today. We'll be back for that. Chris Pulver is going to take over and get you guys prepped for this major market event. Before I step away, let me just a quick reminder. If you guys want a chance to win the Edge Finder, we're doing an Edge Finder giveaway in our Telegram channel right now. It is free to join. The link can be found in the chat right now. We'll drop the link to where you can join the Telegram. And we are going to be doing, like I said, an Edge Finder giveaway. Just drop your name in the hat for a chance to win. And you also get some bonus content in our Telegram channel. Okay, up next, Chris Pulver taking over. Stay tuned.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Hey everybody, how we doing? Happy Fed Day. It's going to be a lot to watch. I've got a couple things to share. Just let me post a message really quickly. 573. So if post FOMC sparks a near-term rally, the bullish side will look pretty good for today. Okay, so we are sitting with a little bit of green in the market today. SPX up about 0.7%, SPY up 0.68. We've got the NASDAQ NDX up 0.88, Q's up 0.89, Dow up 0.55, Russell up 0.8%. VIX is down again today. Not a bad thing. Did a little deep dive in the VIX. The average VIX decline after we have some elevated volatility and certainly a reasonable sell-off in the market takes about anywhere between 4 to 14 days, and we're on like day 6. So part of me would not be upset to see 1, 2, 3, 4, 5, 6. This is 7 candles post peak. If we get to like 10, if we go like 7, 8, 9, reset back into here like the 15, 16 VIX zone, that would be allowing this market to recover a little bit. I'm still watching some key levels and key technicals. All it is dragging a fib from high to low. I think in the near term, the bulls, we came and poked that level right on Monday, and it was right at that 200 moving average and that 30% pullback level. So this high, this low, the bulls in the near term, if they can get above the 200 moving average and they can chew into this little 38 to 50% fib zone, there's a lot of support in here that's going to be critical. So as a correction, a move above the 200 moving average is an encouraging sign for a correction. I think the key to this correction is going to be that a higher low to higher high is going to have to be the next leg of the trade. We don't know if that's going to be the case. I think today's FOMC could be a lot of noise and kind of a big nothing burger. There is we do have economic projections from the Fed. The dot plot's going to be revised. I looked at this morning. So here's your dot plot chart on the CME Watch tool. This is pre-FOMC, so I just did this morning. We have the majority of Fed members sitting around 3.875%, looking at the target rate for the year. That's roughly in that like 40 to 50 basis points, which is going to be on par with about 2 cuts this year. You go to the dot plot, you've got the dot plot chart, and you see most of the Fed members sitting right here, just under that, 3.8, 3.85, and we will see. Like this is all subject to change. So pre-FOMC, that table's also pre-FOMC. Here is the projected. This is pre-FOMC. So we're looking at maybe 2 cuts for the year, and that third cut would be coming into maybe this shows March of 2026. So right now the Fed is not really looking to do anything until possibly June of this year. The one thing I think that would be a need today from the Fed is that they're going to have to talk through positivity in the economy. They're going to have to say that they're watching things closely. Labor market still in good standing. Overall market or the overall economy resiliency is looking good. If they say things to reassure, that might be encouraging. And then you'd have this kind of dynamic of you've got Powell on one side saying the economy looks good. You've got Trump and co saying that we're just going to go straight tariff war. And we don't know until like April 2nd. I guess that's the big announcement with tariffs is every country's going to have a number, and I think that's where the uncertainty lies. And this is why the rotation away from the U.S. right now seems to be so exaggerated, is because if we're going to go into fiscal austerity, then you're going to see rotation out of the U.S. I really think that you can't necessarily have a deep slide in the U.S. markets without dragging the global economy down. I think the U.S. is still just too big, and so if the U.S. goes into a nasty like 15 to 20% dip, it either comes back with a vengeance or we're going to have the entire global economy dragged down with it. But I think that would forever change the landscape of what future investing looks like, because it might be that China looks more attractive than the U.S. and Europe looks more attractive than the U.S. and anything non-U.S. looks more attractive. So I'm continuing to watch these non-U.S. related instruments. I did some deep diving yesterday. It was kind of easy. I went to like Morningstar, looked at kind of reviewing these. I actually went into my 401k and I could look up all these targeted funds, and I want to see what the holdings were. So I kind of like the one of these is Latin America. It's Latin America. Latin America. It's an iShares, I think. Yep. So there's a Latin American 40. I already have exposure in Brazil, which is EWZ. And then ILF is a little bit more of Latin America, which I think value-wise, coming back into these lows in 2022, which is the bottom of our U.S. bear market, coming back to the lows of COVID. If you're looking for some diversification that's non-U.S., it's got a decent dividend yield, which is obviously not bad. It's just a play. Like, I'm not looking at crazy amounts of capital, but I think a 3 to 5% allocation non-U.S. for me, and maybe more. I don't know if I'm going to go much higher than 5%. But between Latin America, between Europe, between China, I'd be willing to do like up to 5 or 10% allocation. It's not a game changer. It's just a different way to deploy that capital. It's important to me that I have the capital and the cash to deploy with options. Anyway, we'll talk through it. So let's go top down. Markets are up today. That's fine. And VIX is retreating. That's fine. A lot of, price action coming later today. It could be a big noise event. We do have a couple gaps to be mindful of for this week. So going from last week's Thursday, Friday move, today's price, we've had a little bit of a bump to the upside. We still have a gap right here that the market is trying to test. We still have a gap down here from Thursday, Friday. The correction area to me is between 5750 and 5800. That to me is like the bullish correction zone. And it could be pretty simple. If you just go low to high, higher low to higher high, this market, I'll plot this on my chart just as a spot. This may be like spot on. Let's find out. So if I go low to high, and yesterday's little 50% pullback ends up being a symmetry swing, that puts us right around 57.95. So I'm going to make a note right there and paint this green and label this one. This would be a symmetry swing. For correction. So we'll see if we get there. Because a couple things I could see lining up with this symmetry swing. Let me go a little bit higher Let's go 30-minute time frame. That symmetry swing right there puts me into the same area where I plotted a harmonic pattern that looks something like this. Something like this. This is from August lows. So if we have this pattern come into fruition, one of my favorite things in a higher time frame harmonic pattern is we come right back to this merge. That merge is that low that I pointed out. So a low, high, higher, low, higher, high makes that merge, hits around that 38%. That checks the box as, okay, this harmonic pattern is satisfied. If we go back a little bit deeper, that's fine. But you can see how much of a fight the bulls have, right? The bulls getting back to this level, the bears could come back in and reject that hard. The bulls even coming back and having a really nice retracement. We're still fighting the backside of this trend line, you know? So, I mean, for the bulls, for me, this has to be, hang on one second. Okay, the bulls for me, if we go back to this chart, let's go here. Bulls for me, you have this harmonic merge level at that low, okay? You have lots and lots of support right here. So between 57.75, okay, and 58.50. So we'll round it and say between 57.50 to 58.50. That is a nice fight by the bulls. But my concern is that the bulls find a way to fight back and the bears find a way to squash that rally. But the key is if they squash the rally, if we have a high or low, the bulls need to fight back. My biggest concern is that we have, short-term pricing getting up to here to kind of finish the quarter, and then April 2nd with another round of tariff news, which could be, kind of cementing the fate of the market. I mean, obviously in the near term, longer term, the market's going to be fine. But near term, if we're going to break these lows again, where from? Do we have a chance for sellers to reload again? I probably will. I probably will take on some 30 to 60-day hedges if that is the case. If we go higher, that's totally fine. I would gladly sacrifice the 0.25% or the 0.5% that I typically risk on a hedge. But if I'm right on that move, that 0.25 to 0.5 can pay me up to 1 to 2%. And that to me is worth, offsetting some of the pain if we're going to go back and revisit these lows. So it's going to be like a really delicate market here the next probably 2 to 4 weeks. We have to get through FOMC today. We got to see where the market closes by Friday. Next week, we get into the 28th, which is almost wrapping up the month. We have the Q1 expirations. We have major options expirations between this Friday is major Apex expirations. We have volatility index expirations and futures expirations. That's all riding out this week. Next week, we get to the end of the month. I think we have core PCE next week as well on Friday. And then we have Q1 ending on Monday, the 31st. So we have to navigate all that. And then you go into a fresh month in April. In April, you have more tariff talk. So that is going to be, if the market is sitting here coming into tariff talk, okay, well, there's room to get down to the lows, which is tradable, as opposed to if the market's already here with tariff talks. I don't know if the market is going to be, breaking lows, faking out lows. I think a bear trap would be a great signal to get long, but you don't know that unless it actually shows like it's down one day and then up the next. That would be a bit of a bear trap scenario, which I'd like to see that play out. As I've expressed the last couple of weeks, especially, my biggest concern is that if we break these lows convincingly, that there's just a lot of room. There's a lot of room to the downside. And, 2022, which was a challenging year, 2022, if you look at how it played out, I'll just go to the chart rather than drawing it out. We came in like a 5-wave correction. Here's 2022. So we had a 1, 2, 3, 4, 5. Honestly, from a textbook standpoint, for technical analysis, that was a very nice, orderly correction before it finally came out of it, which was not fun to live through. I mean, that was a 25 to 35% correction between the two indexes. Stocks were down a ton. You had your, Mag 7 stocks. I mean, Meta was down 70+%, Tesla down 60+%, Netflix. I mean, all these stocks that everyone's loved for the last several years were down a ton in 2022. But my point is, this same area that is a high to low, right? Everyone's thinking like, oh, there's going to be a bounce, right? But what if 2025 is the same magnitude of this correction, but rather than having it be an up and then another down, what if 2025 is just a little bit of a flag and the market just falls lower? And there's so much momentum here. We just have like this big scare. And this would look a lot more similar to COVID than it would 2022, even though it's a completely different circumstance, you know? But the law of large numbers, and you're sitting at all-time highs. You have to have this deleveraging. You're concentrated. This rotation out of the U.S. You've got fiscal policy that's changing to an extreme, from extremely accommodative to then extremely austere, where they're tightening and essentially cutting programs, and nobody knows the extent of it. So that is why this market doesn't really know what to do. Like I said, if you have a longer-term horizon, if you're looking out 2, 3, 5 years, just stay the course, trade through it. You'll be fine. But I do this stuff every single day. It's not awesome to think like, well, today, what happens? This week, what happens? This month, what happens? I can have some mild spells where I've got some flat lines in my portfolio. I can manage some drawdowns. I always have hedges going, so it's okay. But I'm certainly not going to be excited to see this market drop another, maybe 5 or 10%. That would not be good, right? Meaning I'll be fine, I'll survive it, but it's going to be a pain in the butt to be just watching and holding and waiting, and then just trying to take nibbles on what feels maybe to be a falling knife. On top of that, that's why I'm rotating out of US and I'm having some exposure non-US, because if China's going to be pretty resilient right now, Europe's going to be pretty resilient right now. Anything non-US looking pretty resilient right now. It's where money is going. Also on the sector side, and this is not fun for most traders. It's not fun to think, how can I trade the market right now and defend myself? How can I trade the market and make some better decisions than just being all in on S&P or all in on Mag 7? Well, even though these are showing green for the year, if we're going to see like a nasty slide to the downside, all these can get worse. And so it's this. The market can suck less if you're rotated into the proper sectors. Doesn't mean it's going to be energy's up this year and healthcare's up this year and utilities up this year. It could be the case, but realistically, if we're going to go into like a legitimate bear market, these are all going to be down. These are all going to be down. It's just they'll be down less, right? Discretionary will be way down. Tech will be way down. The index will be down. These sectors might be down less, and that's one way to hide out, is you go into more defensives, you go into dividends, you go into lower volatility. That's a good way to hide out to kind of protect the portfolio. But I think after the first, 50 to 60 to 70 days of trading this year, these sectors are likely going to stay the course. And this is kind of symbolizing a pretty good rotation into other things. So, does tech lead us out of this little correction? I don't know. I don't think so. I think that we're rotating from a, growth to value right now. And it's going to be, the biggest improvement for risk appetite is going to be Bitcoin going up and consumer discretionary showing some sign of life. So if you want to see a ticker that's looking to see where money's going to be treated well, if the consumer discretionary gets a decent bounce, and one way I'd look for that would be somewhere in here. This is a 5-period yearly moving average, and if we come down and poke that level, that could be a pretty strong support zone. Since we got out of the bearish move in 2022, okay, we started to have some higher lows. You can see that big blue line. If this comes down to close below and then close back above, we might see a little lift up in consumer discretionary, and that could equal some risk appetite. That is a good indication. On top of that, if you look at Bitcoin prices, I think Bitcoin prices is ultimately representing some of the best risk on, risk off trading. Right now, Bitcoin is, so gold is a little bit softer today with some indecision. That's totally fine. Silver, some red today. GLD is down slightly, not by much though. Gold futures down a fraction. Bitcoin 84. Again, you're not getting really any major rips. You're not really getting any major dips. Key level 75K, 74K. A bear trap. If we're going to continue to kind of slow grind. A bear trap is fine. A bear trap here, but we've got to close back above right side of the trend line. This changes. Okay. Bitcoin pricing. to the upside or downside. This means major risk off tone. This means stability. This means risk on. That makes sense? So I mean, things to keep an eye out for on the overall, consumer, the overall like risk appetite tone of the market. Bitcoin's a good barometer for that. Consumer discretionary based on sectors, good barometer for that. So otherwise, a lot of people are going into lower beta, more defenses, more dividends. This stock does pretty well in that environment. This is MO with a pretty healthy, like 7% dividend. The stock has appreciated a ton. I was very lucky on this one in 2024 to be buying this around $40 and still riding it. So I'd almost like to see this thing correct a little bit more, just so I can play some lows. I want to see some structural lows instead of this thing just continue to go higher. But it's kind of the perfect storm of rotation where this stock might be treated really, really well. And I'd love to see this thing get back to 2017 highs. It's not, I'm talking $20, but if you've got $20 of appreciation plus a 7% dividend, that's a nice little multiplier for profit. All right, let's go into some currencies here. Currency strength. Make sure that I'm getting dollars up a little bit today. CAD, we've got New Zealand weaker. Not a ton of volatility on the vertical axis, so things are relatively contained right now. Yesterday's trading, Swiss was strong. Do we have a Swiss National Bank rate decision tomorrow? I know we have the Fed today. I think we have combination of like Fed, Bank of Japan, or Bank of Japan. They already did it, didn't they? Didn't they do it Tuesday to Wednesday? Yeah, so Bank of Japan held rates at whatever their window is, but basically 0.5%. Press conference, so Japanese yen yields were down. News today, all about FOMC. What else do we have coming in tomorrow? I think we have pound rate decision and Swiss rate decision. So Swiss is expected to cut rates by 25 basis points tomorrow morning. That's 4:30 a.m. Eastern time. That'd be another 25 basis points lower, which is totally fine, which is why I started to add in, load in, and level back into some of my Swiss crosses for buy stops and buy limits. Bank of England expected to pause. We'll see what the bank rate votes look like, if there's any dissent, whether they change the 0.27 structure right now. I don't know. We'll find out. Governor Bailey speaking at 8:30. Unemployment claims for the U.S. And I'm sure that unemployment claims are going to start to be more important if they start to tick higher. Otherwise, they stay right around that same like 200,000, 220,000. Just keep a close eye on that. But yeah, there's a lot of stuff up in the air, and that doesn't make the market happy. But what's funny is, to hear the saying like the market loves or the market hates uncertainty. Right. But when is the market ever certain? I think I've been even last year, it's like there was some certainty for me in 2023 to be a bull. There was mostly certainty through 2024, but that hiccup in August was certainly an eye opener. But I stayed the course, and through the election, I was pretty bullish. But COVID was not certainty. All I looked at on COVID, it wasn't really, oh my gosh, sweet, just got profit in SPX. Perfect. Very good. That was a nice little winner this morning. Thank you. Thank you. I'll take that all day long. So trade update. Okay, so that trade is done. That's nice, a little winner for the Fed. But the I mean, how many of you are just like super certain out there? I'm certainly not. I've been doing this for freaking 25 years, and I've never had like absolute certainty. Because if I did, I'd trade a lot more aggressive. I mean, I survive in the markets. I do pretty well with a lot of quarter to half to 1% risks, and I throw them all over the place. And I trade pretty much anything, and I trade what looks good, probabilistically. I trade what looks good mechanically. I have very similar strategies that I deploy, and they tend to work. And I've done really well by that. There's a time that I'd like to be a bit more aggressive, but I also think why? Like if I'm more aggressive and I'm not right, all that's going to do is sting and dig a deeper hole. So it works both ways. I mean, I don't take huge risks and I spread out the risk. So therefore, if I'm wrong, I can survive it. If I'm right, it kind of snowballs into some nice gains. But if we look longer term, I will say this: if the market is going to put in, a low that we can rally from and we can somehow get back to highs, like I'm going to try to time that. There's a point this year that I like to be more aggressive, but we have to have a little bit more clarity. I don't think the market can ever be like, oh, the market loves certainty. Well, what certainty? I think Trump is the worst candidate for certainty because if his agenda right now is, I don't care about the stock market, we want to change this government stuff, we need to cut, we need to fix, then you're taking away the punch bowl that has kept this market running through COVID. It's all been fiscal policy, it's all been fiscal spending, it's all been big government bloated to now the debt ceiling is a big or the debt spiral is a very real risk. And if anybody's followed Ray Dalio the last 3-4 years, and he's just going on broadcasting out change the world order and how this is so important, it's important. It is important. It is important. You can't ignore it. You can't kick the can down the road, even though we've done it for a long time. But I just don't think you can be so doom and gloom that it's like, what is Ray Dalio's end game? I mean, is he calling for a change of world order as in like the world ends? Is he talking change of world order like the U.S. is all of a sudden dethroned from world number 1 to world number 2? You don't think the U.S. is going to fight back? So I don't know. I mean, I just don't subscribe to the doom and gloom where it's like the world is ending and the market's going to be. Well, if the world's going to end and this financial market's going to be the worst place to be, then I guess I need a new job. But since 1928, this market's found a way to navigate a lot of things. What this might do is this might require a lot of restructuring. This might require things to change. I don't know. But we're in an environment where the market is evolving. Every single year, there's something different. Right now we have retail traders with probably the best tools and resources ever, the most convenient trading apps and ability to trade and pressing the button, being in trades in a matter of seconds. Versus institutions that are running quants and algos that can trade hundreds of thousands of times a day. Zero DTE, which has changed the landscape of options trading, options volume, which has been exponentially growing since 2020. I mean, we have an ever evolving market. I think the evolution continues to be lower fees, lower commissions, more liquidity, and possibly everyday expirations and even a 24-hour market in the coming years. So for that to be like, oh, the world's going to end, the financial markets are going to implode, the U.S. can't. Look, we can have drawdowns, but let me see if I have some pictures here. I think I do. Let me go bear market. Fudge, where'd my picture go? Darn it. Let me go downloads. Thought I took a screenshot in here. Drawdown perspective. Okay, here you go. Perspective. Here's a couple of perspectives. Let's put this in perspective, shall we? So here's one. Okay, so intra-year decline. Okay, Every year, this is the certainty that everyone's wondering. You want market certainty? The 100% certainty is that every year since 1928, we've at least had a 1% correction. Big deal, right? Big deal. Everybody should know that. So the market pulls back, right? So 1% corrections happen all the time, every single year. The 5% corrections happen 95% of the time and happens on average every 1.1 years. So we're going to have a correction. This crazy 2%, 3% correction that we operated in for almost the entire year of 2023. Obviously, 2024 was not that year. We had a 5% correction in April. We had a 10% correction in August. And we even had like a 4 to 6% correction in December and January. We had a 10% correction now, which happens about 64% of the time every 1.6 years. Okay. Now we're talking a little bit deeper, 15 to 20% corrections. Look at the probability here. Only about 47 to 27% of the time do you get those really big corrections. That's your correction territory. That's your deep correction territory. And if you're greater than 20%, we're talking bear market. Bear markets only exist 21% of the time, right? Anything greater than 20%, we'll say like 26% of the time or less, we have bear markets every 4 to 5 years. Well, we're obviously on that cusp, but we did have a bear market in 2022 that we came out of, right? But that 4 to 5 year window puts us at like a 2026 to 2027. I mean, for me, a sustained bear market, if there's any such thing, I just, that's why I'm so curious how 2025 plays out. Because if we get through a correction phase in 2025, early in this administration, I think there at least is aggressive enough policy to put in place to try to win back some market optimism by midterms and possibly have this, this first year could be like the crappiest year. And then the next 3 years could be the rebuilding, right? So if we do have a decent drawdown, 10% is no joke. This is S&P. So 10, 11%, we had 10.3 from peak to trough this last decline. But if we get worse, I mean, the probabilities of those bear markets it's slimmer, but it does happen. Every 4 to 5 years, you have a 20+% correction. We haven't had a 20+% correction since 2022. So put us out to 2026, put us out to 2027, bear market territory, right? 30, 40, 50%, even lower probabilities, most pain you're going to feel. Like it's going to suck if this market ever pulls back to, GFC type levels, like 50+%. It's going to be awful, right? The hard part is how fast does it happen? How quickly do we get to 30, 40, 50%? How quickly does the market bottom out and build its way out of it? How many traders survive along the way? That's the challenge. If you have a long-term horizon and you're not over leveraging, you can survive whatever the heck this market gives you. But the hard part is these declines that ruin everyone's trading and track record. That's the hard part. So just a little perspective. Okay, another perspective. Same thing here. Bear markets, 20, 25, 30%. Probabilities get extremely low, but they do happen. Every 4 years, 20+% correction. This happened in 2022. So on average, right? And since 2018, we've obviously seen a lot of booms and busts in the market. So just a little perspective. That's all. Okay. So we are settling in for, I've got another winner today, 794. Center price. I just have to get a trade posted here. This was around 50. So we opened up this morning. Let me go to the 5-minute chart. I'm going to have to go here at the top of the hour. So I will quickly run through dollar, gold, oil, silver, Bitcoin. We opened up right around 56.30 today. So I believe it was a 95, 50, 695, 5705, and 5555. So that was a 275, 230. All right, just updating my tracker here. Cool. And this is where we're at. So current day, I can go ahead and delete this now. Delete this now. Yeah, we're right in the middle. So we still have a gap here. We still have a gap from Thursday, Friday last week. We still have this recent high. If this is a low to high, higher low to higher high, I'll watch. Current prices that I see with some of my order flow levels and liquidity levels. One thing that's standing out is I mean, this would be a pleasant surprise, but if I could forecast this and this software is accurate, I see a pretty decent support level around 560 with the ability of this week by Friday making a move up into 570 to 572. This strike is actually a 573, and I would love it. I'd love to see the market find a way to price out something to the upside and make a decent move. We're not really going anywhere, right? I mean, this shows like 59% call options, 90% put option volume, but price has gone pretty much nowhere since the open. So we're still waiting with bated breath. What's the Fed going to do? What are they going to say? What's price? What's price going to do? That's the most important thing today is what price is going to do. Okay. All right. But yeah, 572 would be a nice level. If we can get to some recent highs again above 5,700 on SPX, that's good. I've measured out that swing symmetry towards 5,795. The levels I'm watching between 5,750 and 5,850, or even 5,750 to 5,800, I would be, kind of completely understanding like that's realistic to get to, but I think the bears would have their day to load back up and at least push it down. Push it down to a correction level or push it down to a revisit of the lows. The bears were aggressive here. The bulls showed up a little bit for relief, but we are just waiting, right? So I don't know. Is this what the next couple of weeks are going to look like? And then we have to get through tariff discussion before this market actually does something good? Or is the Fed today going to allow the market to get a little bit of a lift? And then, Trump and company can talk it back down / maybe that's what happens. So we'll find out. All right, let's keep going here for a few more minutes. Dollar index. Let's go actually get this back up here. Different chart, dollar index. So dollar index, couple levels I think are important to watch. This has had a really aggressive decline. Any pullback into this area here on the dollar, I think is worth selling. If you get a pullback here, I would be looking at a smaller time frame. So a pullback anywhere between around 104.50 to around 106. Go down to a smaller time frame and see if this offers a pullback above and then back below. So if we pull back above and then we get back below, selling the dollar and resuming this downtrend. Okay, that pullback area, like I said, 104.50 or so to 106. I would love to see this thing line up for a sell trade. I just don't want to be too noisy, right? Like that doesn't mean I want to buy the dollar, but if you are buying the dollar, I hate the stop losses right there because this thing could still, gets kind of bleed lower. So I'm more of the camp of if we pull back into this zone, that this leads to another revisiting stop loss that is, in the direction of the trend. Stop loss seems a little bit safer there, and then you go to some fresh lows and you trail this thing. Okay, but that's looking at dollar index. Oil, just super noisy around this low. I don't know if we're going to bounce up or break the floor. I'm not trading oil. Natural gas, I'm still long natural gas. This one is, I do have a couple trades. URA, I need to add to a diagonal spread. Pfizer, I need to add to a diagonal spread. They expire on Friday. I need XLC to stay above 86, which shouldn't be a problem. Yep, so that was looking good for profit this week. XLE needs to stay above 83. That was looking great for profit this week. Those are fine. Let's see. Let's go back to gold. Gold, a little bit of a pause today. I mean, we're kind of seeing this correlation with dollar versus gold. If dollar shows any near-term strength, gold's going to pull back. If dollar shows any additional weakness, gold's probably going to continue to go stronger. If the dollar's getting weaker, gold is getting most of those bids. Those bids are not going into Bitcoin right now. MicroStrategy is still hanging in there at 295. Coin, this is next week. but I may have an expiration where I've got the chart alarm set at 195. I need to see this thing above 195. Otherwise, I take on some shares of Coinbase, which is okay. I can do it. I can repair it. I probably will. If I'm assigned, I'm going to try to repair it aggressively for, maybe $300 to $500. Copper. This is another reason, does anyone think there's a recession coming this year? Because this is called Dr. Copper for a reason. Global economy wise, we are getting some growth outside of the US for the first time in a while. And copper is usually a reflection of the global economy. So copper has been in a great uptrend and is looking pretty good. Nick, what's up, dude?
Hey, Chris. I know you got to bounce at 11, so I'm coming to help you out. I can't wait to speak more with you later because you just got into a great topic. You got copper on the screen. I'm with you too. I think the recession call is a little aggressive, and the broadening out globally is a positive sign.
It is a positive sign. I just think that it's funny how the whole sentiment shifts to, American exceptionalism to now like America's in the toilet, broaden out elsewhere. I mean, look, I'm fine allocating, but I don't think I can go all in on anything that's just, non-US is, because look, if the US is really going to be that dire, it's going to drag. It's going to pause. Like US and Europe. I mean, are we about to make enemies out of Europe? Or are they still going to become, trading allies? Anyway, it's a rotation. I think that's the important thing. It's a broadening out. I said early in this year, like if we decline, the market can broaden out. I still don't think we're necessarily at the lows until we have U.S. market breadth showing that sign. So that to me is still the S&P stocks above the 50-day, S&P stocks above the 200-day. Those to me would be like my my bargain shopping buy indicator. Like that's how I time the market for a little bit more of a rally.
Well, Chris, too, one thing to think about. Just I know I'm going to kick you off because I know you mentioned. But last thing I'll say is the diversified portfolio this year is working really well compared to, like you're just pointing out, U.S. tech stocks obviously dominated the last few years. But now this year, they're, as you mentioned, in the toilet. I actually think that is my opinion going forward is don't abandon U.S. stocks completely, but the diversified portfolio may be here to stay. And thank God if it is, because that is, there's been a lot of people who have been disciplined and waiting for a rotation, and now you're finally getting it. I don't think you want to completely drink the Kool-Aid and say, European stocks only and everything else is terrible. But I think, somewhere in the middle is probably the truth. So thanks for coming on, taking over for a little, Chris. We'll see you back later. We'll talk more about all this stuff, and we'll catch up with you in a bit.
Sounds good. All right. See you in a little bit. Thanks, Nick.
See you, man. Okay, I'm going to go ahead and there we go. Got the screen. I was on earlier, back here for another session. I saw somebody asking, was it Ball Out? Ball Out was saying, what time is James on? Just so you guys know, I believe it is in 15 minutes. But if you ever need to know when somebody's coming on that you're looking for, head over to a1trading.com. Just click the live stream schedule. We map it out here. So you can see James is coming on in 15 minutes. And this should convert it to your local time. So we've got 15 minutes to go until Forex James comes on. So I'm just going to fill in the gap here. Take a look at some charts here that I've been watching. Another public service announcement. I mentioned this earlier. We're doing an Edge Finder giveaway this week. If you want a chance to win a free copy of our team's tools, you can enter for a chance to win. We'll be announcing a winner this week. So grab your chance to win by joining the Telegram channel just been dropped in the chat. Yeah, by popular demand. We had a lot of people who were like, hey, when is so-and-so coming on? Or how do I know what time you guys are streaming? We always do our scheduling internally. We coordinate our shows, and then it gets posted up on our website, a1trading.com. If you're a real fan of the show, you could also just bookmark our website and click that anytime you want to know when a stream is happening. Also, I'm curious, what are you guys trading right now? I'm just curious if you guys want to drop a comment or a chat here with us. What are you watching most or trading today on Fed Day? I'll go through what I'm currently looking at really quick. I'm long gold. Trailed my stop loss on this one. Just going to wait for this to either do one of these guys or do one of these guys or do one of these guys. What I love about trailing stops is that when you're in the groove of trailing stops, like once I have my fundamentals, my sentiment, breakdown and my technicals. Once all of that is all checked and I'm in a trade, the beauty of trailing stops is like I just have so little to do in terms of activity for trading, and I kind of love that. DAX, Lee, you've been trading the DAX a lot. That's awesome, man. Congrats on that trade, by the way. DAX has been ripping. Bitcoin, dollar yen, gold, shorts on EJ, pound Swiss, gold, silver, US 30, gold. Very nice. Yeah, so what I've got going on is I am still long gold. This has been, actually, I wanted to show you guys this too. Check this out. Look at this. For the fans of the put to call ratio, probably my favorite. Actually, yes, I'm going to say this. This is my favorite sentiment indicator. My favorite contrarian indicator in the market is the put to call ratio. But what I'm thrilled about is this. We added. Now, the put to call ratio, all it does is it just says, is there a lot of demand for calls or a lot of demand for puts on the options market? And if you're not too familiar with the options market, on the options market, you can trade calls and puts on gold, silver, oil, stock market indices, individual equities. You can do options on everything. I mean, you just got done listening to Chris Pulver. That dude does options literally on just about everything. I really like the put to call ratio for gauging crowd sentiment. And what we saw here recently, guys, is that gold started to get a huge demand for puts. Now, it's recently come down. We're actually getting close to kind of a overbought sort of call demand being very high on gold, but we're not quite there. I wouldn't say we're stretched in either direction. But let's just go look at like March 12th, and let's go look at March 3rd, February 28th. So late February and early March, the put to call ratio right here suggested everybody was buying puts, everybody betting on gold. Oh, this is it, right? We have the data to say that the crowd started buying puts aggressively. We're looking at gold here, which is cool. Like we can track the volume weighting on gold. And gold was telling you that people were buying puts on gold aggressively, right? The put to call ratio shows that. Then what happened? Everybody goes out and they buy puts. Gold's going to go down. And what happened is it actually ripped. So I love using contrarian sentiment indicators. It's one of the core features of my trading that I use. And to map it out, we have all the tools in the Edge Finder for easy access. But the put to call ratio is by far and away my favorite indicator for looking at crowd sentiment. A lot of people don't realize how much volume goes through, specifically speculative volume. A lot of it goes through the options market, right? If everybody thinks gold's going to go down or stocks are going to rip, a lot of that speculation takes place in the options market. So what I like here about gold and why I think that it can keep going despite, what seems to be a never-ending uptrend, right? Is that when it comes to gold, the concept of it's too overbought does not exist, in my opinion, especially gold. Gold, if it went like this for another 5 years, I would still not consider it to be quote unquote overbought if the fundamentals still make sense. They print more dollars every single day. That should make the price of gold go up. Somebody actually made a comment recently. They said, is the recent uptrend in gold really gold going up, or is it more so currencies losing value? And the answer is a mixture of both. Gold has actually outpaced inflation and in terms of its gains. So there's some actual demand for the metal that is above trend, above just the lost purchasing power. But there's also lost purchasing power. Central banks all around the world
adding liquidity to the system, adding printing currency creates gold uptrends, right? It only makes sense. If there's more supply of currency, you should need more currency in order to buy an ounce of gold, right? There's also, as Heimer puts it, geopolitics, right? It's a clear and present danger to the market. People uncertain about Ukraine and the Middle East and China and Taiwan and all that stuff that just kind of doesn't seem to go away. So the concept of, oh, gold has to keep going, right? Or has to drop is dangerous. Also, IGB, do me a big favor. If you don't like a guest or their commentary, please don't announce that you don't like their commentary and that you're leaving, because that's incredibly rude to the people who take their time to come on and host a show for us. It gives me a chance to be a human being and go take a break and get some water and stuff. But if you don't like a segment of the show, just leave. Don't announce that you think they're not worth watching and that they're bad or something like that. And just for context, you specifically were disrespectful to Chris Pulver. That dude has taught me so much stuff. So when you listen to my commentary, I've learned a lot of things because of Chris Pulver. So just you're a commenter on the screen. Please just consider that your words do actually, they impact people who are taking time out of their day to add value to this community live stream that we do. I like to only watch you for trading. Totally cool. Respect that. But disrespecting my guests will get you banned, and I really don't appreciate it. NASDAQ up 0.85% here on the day. S&P up 0.6%. Dow Jones up 0.6%. And Russell up 0.8%. VIX down 4.5%. Gold's flat. So here's the thing. I want to also, Chris was talking about something earlier with the upcoming meeting, something that's really important. The dot plot, right? What is so important about the dot plot? Well, the dot plot is the forward projections from central bank, from the Fed officials saying whether they think, interest rates are going to get cut a couple times, a lot of times, or little times. I also heard Ivan, he made a great point about this earlier when he was on. He was talking about how the Fed kind of has to take a defensive to hawkish stance today. And I think when we see Powell on the stand, that's likely what he will do, because a lot of the tariff stuff that we discussed in my first segment this morning, when we discussed tariffs, I mentioned that there's just a whole bunch of question marks around it, right? We don't know the full impacts of tariffs, and neither does the Fed. We may have educated guesses, but it's not really enough for the Fed to make a decisive stance on what they're going to do with interest rates. So if I was Powell, what would I do today? I'd say, look, inflation is doing okay. The labor market's holding up okay. Let me pull up my screener just to make this point. Again, I would encourage everybody to think this way here today. If you're somebody who's like, is Powell going to make the market do something? Well, let's try and forecast what he's likely to say. How could we possibly do that? Well, we can look at the same data that they're looking at, right? So here's the thing. When we're trying to mimic what the Fed is likely to say next or do next, we want to look at economic data points that they care about. What do they care about? PCE, big time. Inflation, right? They want to see what inflation's doing. Inflation last week was great. It was a good, it's not like inflation's at a perfect spot. Don't get me wrong. Prices are still going up. But they went up, and this is the confusing part about inflation. They're going up on an annual basis less than they used to, and also less than people expected them to. So prices are going up, but they're not, instead of prices rising like this, right? Prices are rising like this. And the Fed wants them to rise like this, 2% per year, right? So the closer we get to this number, right, the happier the Fed gets. 2% inflation, they perceive as not too threatening. And you don't want negative inflation because usually it comes with mass layoffs, right? Well, the
result of mass layoffs is usually negative inflation, right? Or deflation. So they want a healthy 2% inflation. Prices going up, but at a rate that doesn't kill the consumer, right? 9% inflation, that kills the consumer. Even 3 and 4% inflation hurts the consumer if they're not getting equal or greater wage growth increases. Wage growth's at 4%. Can we talk about that? Wage growth's at 4%. Inflation is at 2.8%. That's a lot better than where it used to be, right? And, you know, when we saw the global inflation problems flare up all around the world, this was not an isolated US problem. I love, you know, when people get super political, they'll claim victories and blame people, the presidencies, for this. Biden did not cause all of the inflation that happened. That was a global phenomenon. And Trump did not cause all of the unemployment spike that happened during COVID. That was COVID, right? There's just things that happen in this world, on this little blue planet in the space, right? Crazy stuff happens, and it's not always someone's fault. Inflation went crazy and has been dialed back and seems to continue to be dialing back at this time. We also have decent wage growth. JOLTS job openings, pretty decent last week. Jobless claims, healthy. Unemployment rate came in at 4.1%, still very low unemployment rate overall. So I think if I was the Fed today, I would say, look, if I was Powell, I would say, look, our jobs data looks okay. Inflation still has work to be done, but we're on the right path. And I would say, with tariffs in mind, we don't know. We don't have a recent, we do have 2018, but the caveat with 2018 is before the tariffs went into place, we had very low inflation, right? Inflation was sub 2% at the time, and there was not really a big bump of inflation in the last tariff round. So some people take the extremes on both sides. They'll say 2018 tariffs were not inflationary, but they did cause growth scares. So we don't know the effects of the tariffs, right? That's the point. The market doesn't know, and neither does the Fed. And so the Fed, if I was the Fed, I would say we're making some progress on inflation. Jobs data seems okay. We don't know the effects of tariffs. We're going to stay put right here. We're going to see what happens. The other thing Powell mentioned is that, and he's the transitory guy. If you know Powell, if you've been trading for a while, you know he got, completely hammered for saying transitory for way too long in 2021 about inflation. But he has said in recent times, again, kind of saying that the economic consensus on tariffs is they usually cause price increases, but not necessarily sustained. Like, let's say prices, tariff, okay, prices go up. What, and this is prices, right? So P for prices. Some people are afraid that you're having this and it's going to lead to this, right? Prices jumping, but also then accelerating from there. Powell recently said, and I thought this was very interesting, he leaned more towards the yellow line, which is, okay, they're going to cause a bump in prices, but the historical lesson might be that they cause a bump in prices and they don't cause like sustained spiraling inflation. That's what people are afraid of, that I don't think is necessarily a fair conclusion. But there's no certainty. We could get somewhere in between. This is why markets are hard. This is why markets move at all. If there was certainty, nobody would trade, nobody would invest, because there would all, like, if there was obvious answers, then prices would barely move, right? Yeah. So anyways, what did I miss? Oh no, I was just saying, if there's a commenter in the chat that has like something against one of our stream hosts, we typically do ban or delete that comment, just because, again, think about it this way. If you were to come onto this show offering up your time for free to add some value to the community, the last thing you want is disrespectful people telling you like, hey, get off the stream, especially when the people that we invite on,
we do a little research on everybody that we bring on to at least know that they have some background, some reasoning for being there. And if you're going to hate on somebody, do not let it be Chris Pulver. That dude manages millions of dollars for clients. He has an incredible track record, and he's a beast of a trader. So if you're going to hate on somebody, at least do it on somebody who, you know, is a little bit more vulnerable to attack. That's like trying to take on the Roman Empire when they're at their height, right? You can't be going up against Chris Pulver. He'll smack you down. Actually, he won't even read your comment. Anyways, dollar index is up here today, holding still. I'm very curious to see, like I said, with the dot plot projections, if there's a whole bunch of rate cuts scheduled in there, dollar could actually break this level. And if there's not, if we're seeing like no rate cut or very few rate cuts on the dot plot change from previous, it's also something worth mentioning. I believe we have James was supposed to be coming on, right? Am I missing something? Chandler, James, let me know if we had a change in the lineup today. Chris is awesome. I'm learning so much. Yeah, Chris is awesome. Anyways, gold here still flat on the day. Silver's down today. What about currencies? Anything interesting there? Euro, dollar. I've had I am interested in the pound on a pullback here if we can get it. Pull back to 1.2775. Let's see. Let's see. Look at this. Oil's poking back into the bearish territory. Might have to go look at that. Aussie yen, dollar Swiss. A lot of dollar bearish setups at the time. How's your day going? It's going well, man. By the way, just quick shout out to all of our regulars. Thank you guys for being here and hanging out all the time. And especially thank you to the people who, you know, defend our show hosts. And you guys saw me get super defensive of Chris Pulver. You can't be talking to my friend like that. Pound dollar, gold, DAX, euro dollar, pound CAD, euro Aussie. Those are your bullish setups currently. Of that list, I like the pound quite a bit. So I'm trailing stops on gold, looking for buys on pound. DAX, Lee, let's take a look at your DAX, huh? How's the DAX doing? If it's anything like the NASDAQ, it's not. It's down a little bit here today, but still, I mean, this thing, man, this thing's starting to look like gold. And I don't know if you, well, it does look like gold. Looks great. So the DAX is really, really killing it. There's this whole defense contract stuff that the government there is proposing and trying to get passed and doing all this stuff. Their idea is that, okay, well, if the U.S. is taking a step back on Ukraine, the German, they're opening up the debt markets, I think. That's like the idea, right? The idea is that, okay, if the U.S. is out of the picture and we still got to take on Russia, if that is the case, the idea, and maybe we can take a look at EU 10. Yeah, here we go. When that all started occurring, look what happened. Euro bonds, this is the Euro 10-year government bond yield. The bond yield jumped from 2.4 up to 2.85. Doesn't sound like a lot, but you got to remember, bond market stuff is boring. So if there's a big jump like that, that's a big jump. That is a 20% jump in the yield that you get lending your money to, you know, European government bonds. So
can we actually look at, let's see, German bonds? I don't even know what the symbol. Does anybody have that for me? How do I know that I'm looking at? I've never looked at German bonds. EU10Y. Does anybody have that? Anyways, point is, the euro got a bump for the same reason, right? The euro jumped up on the same idea. Spending is going to go up. That's going to lead to inflation. ECB might not be as poised to rate cut, but also there's this excitement that maybe all this government spending on military stuff could be seriously stimulative to the economy. DE10Y. Thank you. Who said that? DE10Y. Thank you, Krolos. Appreciate you. German government bonds. There we go. DE10Y. So look at that, right? Huge jump in German bonds, yielding around 2.8%, which I know is not a lot, but you got to think, if this jumps and it looks opportunistic, especially when you have the US, yields more, to be honest, I'm picking US bonds over German bonds, but bond portfolio managers are like boring as anything, but they also, just like stocks, just like other things, portfolio managers want to diversify. So a big bump in the yield offered by German bonds allows bond investors, I know we're getting into boring stuff here, to go park a little bit more money in Europe and get a little better yield. So the idea is that money could also, they're going to open up and borrow a lot more money. That could lead to inflation, right? Because to pay back that borrowed funds, what does the German government have to do? What does the European Union have to do? They have to print more money. So if they're going to print money, that could lead to less likely rate cuts. And maybe the market is also saying, well, you're going to take on that debt and you're going to do a ton of spending. But specifically, you know what the European Union has mentioned with that military spending? You ready? Is James from our side here? Can you still hear? Let me hold on. I got to read this message. Sent James a message, but I haven't heard anything. Okay. Forex James. No word from Forex James. Is our James in the crowd? A1 Trading James? Lockheed Martin. Interesting concept here. Lockheed Martin, on some of the announcements of this, did a little bit worse. Okay, cool. James is in the chat. Cool. What's interesting here is that with this European military spending entourage that we're seeing, what did they say specifically? Well, just like the US, when they buy vehicles for government employees or government projects, right? They buy American cars. The European Union, for their military spending, wants to spend their money where? Right in Europe. They don't want to spend as much money on US. Now, I'm going to take the other side of that and say that they're still going to want to buy US stuff, because are you kidding me? The US military is like, if there's one thing the US loves, it's guns, right? But a lot of the idea is that they're going to spend a lot of money in European industrial stuff and in European. And so the idea is that the money is going to get directly pumped right into the European economy. And that's part of the reason why the euro looks strong. I know that was a long dated answer, but the euro still does look strong to me. If you know me well, if you are following along with the trades that I'm taking, then you'll say, why the heck are you in euro pound shorts then? And the answer is, I'm just kind of dealing with a trade that went wrong on me. But I meant to talk about this yesterday. I promised on yesterday's stream, I was watching back my stream, and I realized that I was saying that I was going to talk about a trade that I was dealing with that was a loser, and then I never did. And so now I am doing it now. Okay, here's a trade that's not going so well for me. I shorted the euro pound with small size once, a second time, and a third time. One of those trades is in profit, and 2 of those trades are negative. I am now just looking. So I dollar cost average. It's a way that I trade Forex primarily. Forex, especially certain currency pairs, are very, very mean reverting and very range bound on a longer term basis. And so I dollar cost average primarily when it comes to FX. So I shorted euro pound 3 times. Once, way too early, silly. Second, too early. Third time looks okay. I'm just looking to get out of this trade. So I think if it goes down a little bit lower, I'm just going to close out of this one and move on. But the euro looks really strong. And so, I think we're probably due for a little bit of a pullback on the euro. You've had just kind of a straight shot. And like I said, currencies typically are pretty mean reverting when they have big moves lower. There's typically kind of the reversion, especially when compared to something like gold, right? Gold and stocks, those things are very trendy, at least in the last, 2 decades. They're very trendy. So I trade a more trend following style on trendy assets. And I trade a little bit more mean reversion and dollar cost averaging and longer term on FX. So with the euro dollar, if we get a pullback in the euro, I like it. I like that potential continuation. But Chris was talking about this earlier. You got to be careful that you're not chasing shiny things either. A rush to European stocks is a popular trade. To Lee's credit in the chat, who also asked if I trade any defense stocks, not usually. Sometimes Lockheed Martin, but not too often. To his credit, he was early on this idea, or early is relative, a lot earlier than where we are now, to this idea of bullishness on the DAX. Excellent idea, right? But now I think the trade is a little popular, and same thing with my gold trade. So I'm not saying this in the point of saying like, oh, you want to short these things, right? I'm not saying I do not want to short the DAX. I'll tell you that much. I do not want to short the DAX. I do not want to short gold, right? But they're popular trades now. Let's be real, right? The popular trade in the room is buy gold and sell US stocks and buy other stocks. That's the popular trades in the room. Okay. Now I am long on gold. So I'm not saying like, oh, it's popular and henceforth I'm going to be shorting gold. That's popular, can stay popular for a while, right? So with gold, I'm long. I've trailed my stop. And I'm just going to let price action tell me when it's a good time to just cut the trade and take a profit. This is my opinion. But if I was in a DAX trade, I'd be doing the same thing. Let's just daydream and just say that I took this trade that I marked up and never pulled the trigger on because I don't know why. If I had taken this trade and put a stop right here, market breaks out, I probably would have trailed my stop here and probably would have gotten taken out for a small win. Let's just say that I entered back here. Entry, let's say I just took it, stop here, market broke through these highs. Stop loss right now would probably be like right here. If that rolls over, done. But what if it just rips again? Then I just let it keep running. I think that's the way I play this. Well, this is the way that I play these kinds of markets. I just trend follow, and I don't pretend to know where the top is. I just try to cautiously trend follow by trailing stops, right? So same thing for gold, same thing for DAX. You have runaway charts here. How do you trade runaway charts, right? That's a question I bet a lot of people have right now because you have a lot of runaway charts. How do you trade? In fact, maybe this is an important lesson today. This is something I think we should all talk about because I can compare this to for the gold traders, for the DAX traders, and for the US dollar traders. How do you trade runaway charts? It's not going to be a very fun answer, but I'll tell you what the answer is. This is the way that I do it, right? If you have a runaway chart, and when I say runaway chart, I'm talking about a chart like this, where there's minimal pullbacks, and this frustrates the heck out of traders, man. I think actually, this is the reason that I trade the way that I trade with trailing stops momentum.
These types of moves are so annoying to 95% of traders. That's going to be I'm going to stand on for active traders. I'm not talking about investors. Investors love these moves, right? Because if you're an investor and you just bought gold and you held on to it, or you bought Nvidia and it does this, you're just like, heck yeah, this is awesome, right? But if you are an active trader, there is a very high probability that you dislike moves like this. Do you guys agree with that or disagree with that? Like, that's a skewed question because I know maybe some of you guys trade similar to me where you trail stops. If you trail stops, you love these moves. If you trail stops or you are an investor, you love these kinds of moves. If you are anything else, you hate these kinds of moves. Okay? Here's why. You ready? If you use a strict 1 to 2 or 3 to 2 risk to reward, you hate these moves. Why? Let's say you buy gold here. This is why you hate this move. You say, you don't hate it because you lost money. You put it here and you say, okay, yeah, I do a 3 to 1, baby. And then you get taken out here and it does this. You hate these moves. Or you do a 2 to 1. This happens, you get taken out. I really hate this move. God forbid you do a 1 to 1 and you feel like a hero and then it rips and you hate these moves. You know who else hates these kinds of moves? Dollar cost averaging or no stop loss traders absolutely hate these moves, right? If you shorted this thing with no stop loss, this move might be blowing your account right now, right? So my point is, here's the kicker, right? Here's why trading is hard. Doesn't matter what your trading style is, there's going to be a move type that you're going to hate. It's just going to happen. For me, like let's say I had a long bias on gold and, you know, I look for a break and retest or something and I get long and then I trail out or I take a loss, right? Choppy markets, I hate choppy markets. I like markets that follow through. Oh, and the last thing that I forgot, you know who else really hates these moves? And I have been so guilty of this. This is the thing I hate the most, is when a move happens like this and I was trying to get long, DAX. I was trying to get long, missed my entry, and it just kept going without me. Sucks. It's not fun. That is the hard part of trading, is there's always going to be moves that you miss. There's going to be moves that behave in a way that whip you out of a trade. But I would encourage you, instead of flopping around strategy to strategy, style to style, you could take partials. It's not perfect. You could take a 3 to 1 risk reward. It's not going to be perfect. You could trail stops. It's not going to be perfect. Nothing is going to get you the right way to trade the market all the time because the market's conditions change. We chop, we trend the other way. Nothing works perfectly. Okay. The reason I'm saying that, and I genuinely think that's a really important message for somebody out there, hopefully just heard that and they're like, okay, I don't need to run in circles and change my strategy. I just need to embrace that sometimes you have to deal with the market condition that you don't like. So let's go back to the original question. Nick, how do you deal with runaway markets? Well, you may have a slightly different answer than me if you use a different exit strategy than I do, right? But here's what it means for me. When a runaway market is already underway, you know what sucks? The answer is you just miss it and you suck it up and you wait for the pullback. And if it doesn't happen, repeat step 1, right? It's really frustrating, but that is the downside to the market, is sometimes it moves in a way you don't like. So if you're not in this gold trade, right? I am fortunate enough this time to be long gold and loving this rally. But I have been on the sidelines wishing I was in that trade for so many times in my trading career. And there will be many thousands of times more where that happens to me. You can't avoid it. Don't try to avoid it. If you try too hard to avoid it, you're going to change your strategy every week and you're going to blow your accounts. Stick to whatever you choose to do and embrace. If you're a gamer, you ready? This is going to click with a gamer out there.
If you're some kind of a gamer, you know how whenever you choose, like in games, sometimes you can choose a class, like you can choose the heavy, tanky character that has a lot of strength but moves really slow, or you can choose the really fast character but doesn't have a lot of strength. Same with trading. Choose your class, choose your style, and accept both the pros and the cons. It's a good message to leave it off because we've got Forex James here to take over, guys. We've got him coming in just a second. He's going to take over the stream, talk some markets with you guys, share some opinions and ideas. Maybe he can continue this idea, the pros and cons of everything, right? Pros and cons of dollar cost averaging. There's pros and cons to every single strategy. Dollar cost averaging is one that James talked about, so maybe we'll hear from him on that if he wants to share his concepts. Before I move on, let me just remind you, guys, 100%, if you have not already, make sure to join our Telegram channel. It is completely free to join. We are sharing market analysis each week. We're going to drop the link in the chat. And best part is that this week on Friday, we will be dropping a free copy of the Edge Finder to someone who joins our Telegram. Click the link in the chat. Fill out this form to put your name in the hat for a chance to win a free copy of the Edge Finder. We're going to do more of those in the future. They will always be announced in our Telegram. Okay, stay tuned. Up next, we got Forex James taking over. We'll be right back.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
Hello. How's everyone doing? Hope you're well. Happy Wednesday. Hope you are not overexposed. We have FOMC coming out tonight, so that will be hopefully a lot of fun, but we'll see. It could be a complete snooze fest, but we can but wait. Tom, Bashi, hello guys, hope you're well. Yeah, so pros and cons. Man, there's pros and cons to everything. So, you know, as Nick was saying, trading strategies like dollar cost averaging, we'll just take that example. The pros is it's very, very profitable. The cons are when it's not profitable, it can be very unprofitable. You can lose a lot of money DCA and dollar cost averaging. You know, you can apply it to life as well. Like take me, for example, handsome, rich, really, really good at trading. Pros, obviously, across the board. But then the cons come when, you know, DMs are full. I've got Bloomberg Terminal asking me to do interviews. I just can't keep up with all of it. So, you know, that's obviously a joke. Don't worry. Hope you're all good. So, open positions. Dollar yen still in this one. Actually, I should probably go over the other one, which is Swiss yen. That's been my big one that I've been talking about. That was stopped out. I'll be honest. That was a bit of a messy one last night. I went to bed, almost stop loss, woke up, stop loss, obviously due to the Bank of Japan rate hold. They actually sounded quite dovish. So if anyone that was listening, I didn't stay awake for that. That was 3 a.m, no chance. So I had to do a little bit of a recap this morning. But from what I have seen so far, it seems like, what am I saying? It seems like they are not too happy to hike rates. However, inflation's still way above target. So it's still the idea of them having to hike rates really isn't off the board for me. And I'm watching Swiss yen now because it's actually, I'm going to say perfect, but perfect for me in terms of an entry position here. We've got the 200 daily moving average. We're seeing price reject for possibly the second day. Got the RSI overbought. We're a previous structure. Very nice kind of break and retest or just resistance, whatever you want to call it, is fine. So I'm quite happy to potentially look to go for another short position maybe tomorrow. I just want to see how today's daily candle closes. I'm still very bearish on Swiss yen. Remember, it's a long-term idea. So if we take a few losses on the way, that's fine. As long as we catch the move eventually. So dollar yen's pretty much in the same idea. We've just had the daily moving averages cross. RSI is coming into an overbought area. So we might get some downside, but of course, like I said, we've got FOMC tonight, so this one could be in the bin as well pretty soon. Pound New Zealand, this was a really, really nice trade actually so far. Very simple, very textbook. This is what I talk about almost all the time on my segments is, oops, that's not what I want, is the fib and sort of the trend, the RSI. This was a perfect example of how I trade on a day-to-day basis, or what I typically look for. 200 moving average, below the 50, indicating an uptrend. Where the market overall is moving to the upside, so I'm looking to buy. We've got sticky inflation in the UK, so I'm looking to buy. They're holding off on cutting rates. New Zealand, more in a rate cutting cycle. We've got we had an RSI oversold. The market came into the 50% or the 618, which is the fib golden zone. Price rejected the 200 moving average. It was just a perfect setup, really, technically. It's good reverse hit stop loss. Again, I could look a bit silly, but so far so good. Similar thing here on pound Swiss. We got the fib, previous market structure, oversold RSI, came down to 200 moving average, textbook stuff. New Zealand dollar, US dollar. This wasn't my trade. This was a trade from one of the guys at Elite Traders, one of the other guys that sends signals. So just to hedge that for my personal portfolio tonight, as we've got FOMC, I went long on the AUD USD. Again, same setup. Bullish moving averages, came to fib, previous structure, oversold RSI. So we'll see how that goes. But either way the FOMC goes, I should be pretty okay. I mean, I've got a little bit more dollar short exposure than dollar long, but it's completely fine. Okay, let me just read the chat. Let me see what's going on. Grids, Royal Trades, hello guys. Ball outs here, good stuff. Quang. Sweet. Okay. Pound Australian. We can go into Pound Australian in a second. Let's just take a quick look at gold. There's someone on Twitter that's been shorting gold since 2700. I think Nick knows exactly who I'm talking about, because Nick had a little bit of I think Nick made a video on him, but I'm not going to say names. But he's caught some heat on Twitter the past couple of days. I thought it was pretty funny, actually. It was quite ironic. But the point is, I just don't see a bearish scenario for gold at the moment. In terms of entries, it's a little bit tricky because gold has a habit of just running, and sometimes the pullbacks are just not very obvious, or they're not very large. But I will stick with what I normally do, which is looking for some sort of 50% level pullback, looking potentially for price to come and meet this 200 moving average in an area like this, again, come into the fib zone. And then I would be happy to take a break and retest. Obviously, we broke past previous all-time highs here. We'd come and retest and then continue higher. Very simple. So we'll see if we can get that. Again, FOMC could be a catalyst, but yeah, we'll see. Tesla, I have got no idea about the numbers or the financials. I just like looking at the chart because I'm really interested to see if this weekly time frame can break below the 200 EMA. I think that would be quite a significant thing, actually, because essentially the way you should think about moving averages is, especially on higher time frames, they're very, very good at dynamic support and resistance. In this case, you can see buyers are getting into the market, which is pushing price up, showing some rejections. So if the market can stay above this 200 moving average, it might be a sign you want to get into some long positions. However, if we break below, the next stopping point I see, and this is all based on technicals, by the way, again, I don't trade stocks, I don't know about the financials. The next stops are these previous lows. So I might look to go long on Tesla just as a long-term sort of dollar cost average trade, and see how that goes. Obviously low-sized positioning. Wilhelm, hello. Ball out. James here is a suggestion. Why don't you stream this segment to your channel? I'll be honest, Ball out. That was the plan, but I keep forgetting. I'll write a sticky note so I don't forget next time. 4,047 is gonna. Oh, 3,047 is gonna hit. Yeah, probably. I think gold's definitely on its way higher. Again, I just don't see any scenario where gold doesn't continue higher. We might obviously have pullbacks in the short term, but long term, or sorry, medium short term, completely fine, I'd say. My Discord name, it's just Forex James. Everything, all my social media, every single thing is just Forex James. Double X, double S. Y long AUD USD and short New Zealand US dollar. It's for FOMC. So the New Zealand US dollar trade is a signal my my trader sent out to our Discord. Now I'm fine with that, I've got no issue. But just for my personal sake, I wanted to go long just to hedge some of that risk off. So I'm not too concerned about really what happens tonight. It's more a case of I can sit back, I can relax, and I can just see what's going on. I don't have to manage positions. I don't really have to do anything because I'm positioned both ways. Angel, I appreciate that. That's nice. Did someone ask for pound Australian? Babu wants pound Australian. Let's have a look. What can we find? Let's just see. Is it on the Edge Finder? Just give me a second. Let me load it up here. I'm a little bit unprepared. I ran to my desk about 5 minutes before we started. It's really nice weather in the UK actually today, so I'm considering going out for a cigar for FOMC and just watching outside. Okay, so pound Australian isn't on the Edge Finder, so that tells me I'm not really looking to go either way. I think I would rather go long again, just because of the sticky inflation in the UK. I just think it's helping to bolster price a little bit, provide some support. So I'd be quite happy to look for some sort of pullback. Now this looks very similar to pound New Zealand, the one I took. Problem is it didn't pull back far enough. I needed it to come down to this sort of area here. Again, with the moving average, the fib level, almost around previous structure, kind of, just a wick. Obviously, we hadn't oversold RSI. But yeah, I would say both currencies, pound and the Australian, are relatively neutral compared to themselves, or compared to each other, sorry. So we've got both central banks not necessarily rushing to cut rates. They're both more holding at the moment, or neutral. So yeah, from just the rates landscape, I don't really get anything here. Crying because I sold US 30. Who knows? Maybe it'll go down soon. White Bear should have been in Elite Traders. We bought US 30. Made a few thousand on that this morning, actually, which was quite nice. I'm actually on FTMO challenge at the moment. Yeah, so I might do a video on that at some point. Anyway, how do you know what's the lineup? Oh, right, I see what you mean. Okay, so if you go to here to a1trading.com/livestream-schedule/ or you just go on the website, go into livestream schedule, which is probably a bit easier than typing it all in. You can see the schedule here. So today we had Nick, we had Chris, we've got me now, then we've got Nick, and then Chris again. Actually, I think Nick and Chris are on at the same time, and I assume they will be doing FOMC together. I would guess. So yeah, it's just me, Nick, and Chris today. Can you check US dollar CAD? Okay. Yeah, I was looking to go short dollar CAD, I think, this morning, more from a technical view rather than anything else. I'm not really convinced either way. I don't really want to sell the dollar into the CAD at the moment. So I don't want to sell the dollar because we've got, let's change this. There we go. So we've got a pretty nice level of support that's clearly holding up. We've got a very obvious fight between bulls and bears. We're not moving up. We're not moving down. We're just sideways. But this level is exactly at the election day when Trump was elected. We had a market gap, and it's providing support very clearly. Now, the other thing is that the dollar had a very aggressive drop, and it's not really had any pullback other than this consolidation. So it wouldn't be a shock to me if we do see some sort of pullback, whether it's a 50% pullback. I don't know, but some sort of pullback. So I don't really want to sell the dollar at the moment, just to be on the safe side. And the CAD, oil isn't doing well. So obviously oil is a big driver of what we see within the Canadian dollar. and Canada is stuck in a trade war with the US. And I've said it before, I'll say it again. I just don't see this. I don't see Canada coming out of this trade war on top or unscathed, really. I think they're having a fight in terms of, tariffing you, I'll tariff you back. But I don't think Canada's really going to come out very well. Their economy already is pretty weak. So yeah, I'm not optimistic at all. So maybe technically it looks good to short at the 50% pullback, but fundamentally I'm just not quite there. Sweet. So yeah, that's pretty much it in terms of my open trades. On my watch list, I'm still watching the dollar SEK. I'm considering taking it. Again, it would just be more to see if we can get a continued upside on the dollar, offset some of my dollar short risk. That's pretty much it. This is the weekly time frame, and essentially it's just been ping-ponging since 2022. So 3 years of just sideways weekly movement. So, maybe I'll get unlucky, if you will, if that's the right word to use. And this will, I'll enter and it'll finally break down lower after a 3-year consolidation. Or we could just continue this pattern and try and trade back up into resistance. I don't know. We'll see. It's not a great trade idea just yet. I don't really have much of a thesis behind it. It's more just an idea at this time. NASDAQ, I was looking to short NASDAQ on a 50% pullback, but I'm kind of changing that idea a little bit now. I'm quite happy to either buy or just not get involved. I don't really want to short indices. I've been very hesitant. In fact, I'm always very hesitant to short them. So the S&P, NASDAQ, Dow, even the FTSE and the DAX, I just don't like to short. It's much more difficult to get a profitable short system involved compared to just going long. So essentially, if you just, in theory, obviously, if you just buy every single dip that you see on the S&P or the NASDAQ, eventually you will be profitable. Whereas if you sold every peak, you would be liquidated pretty quickly. So, in theory, shorting isn't really the best idea. Now, euro dollar, I would love to see more downside on euro dollar. Actually, I'm not going to short it because I don't think it's appropriate in terms of the current landscape of economics. But if we could get some sort of downside movement, even if it's just a small correction, just something to pull back into this sort of impulsive price action, or again, whatever you want to call it, it's fine. Then I'd be quite happy to actually look for a long position. So again, we'll see, but I'm in no real side of euro dollar right now. Pound yen, not really interested at this time. We've discussed gold, we've discussed Tesla, we've discussed CAD. CAD yen actually is probably one of my most favorite setups at the moment that I'm considering taking. And the reason is, it's very, very similar setup to what I've already discussed. This is the H4, came into the 200 moving average, previous structure, overbought RSI. It technically looks fine. Fundamentally, I also don't mind it. I'm definitely not bullish on the CAD. I'm long-term bullish on the yen. But again, I'm just relaxing a little bit. I've been very busy in the markets this sort of past week and a half, so I'm just chilling a little bit. New Zealand yen, not really. Nikkei is interesting. I really like this setup. But again, going back to what I said about shorting indices, I'm just not sure I really want to get involved with this. But again, on a technical basis, it looks really good. So again, we've got the 200 moving average. We're in the fib level. The RSI is not really extended, but this sort of trade looks fine. We've also got the Bank of Japan on a path back to normalization, which typically would be a bearish factor for the Nikkei. But yeah, again, shorting can be a pain. Am I still short dollar yen? I am, yes. Shorting EU EGA. I quite like euro yen shorts. I think there's some premise behind that one. Euro dollar as well. I think you could definitely get something. It's just not really for me at this moment. But yeah, I think euro yen is great. Although we've had quite a lot of positive things for Europe, like a less restrictive policy by the ECB. We've got the German fiscal stimulus. It seems like that's all priced in. There isn't necessarily anything else. That's kind of it, really. You know, we've had some good news, and that's about it. Although that good news is very good news. But I wouldn't expect that to really continue a new trend or to continue an uptrend. So what I'm trying to say, I guess, is that if we don't continue to get good news out of Europe, I would expect the European markets, so euro dollar, euro yen, euro pound, to all correct at some point. Because again, the news is priced in, and you know, what else is price going to do if there's nothing else coming in? It's more than likely going to correct the move it had. So yeah, that's pretty much that. What else do we have? Let's see. Oil. I don't know. I'm stuck with oil a little bit because I like the short idea. I wouldn't mind going short, but the price action at the moment is just too messy. So I think I don't really trade patterns, but the only way I could really see any opportunity here is by using the the ascending breakout pattern, or whatever, you know, whatever they're called. This, I'll draw it up so you can see it. So this sort of thing here, where we've got the ascending channel, and then essentially you just want to wait for the break and then some sort of retest and continuation lower. Other than that, I don't really see anything. But whether that's me trying to force a short position and just trying to find something, I don't know. Maybe. Hey, James, I usually swing trade. However, recently I participated in a 10-day prop firm competition. For that reason, I was looking 15-minute, 30-minute intraday strategy. Think you can help? You could do a same thing, really. So the strategy I use can be applied in any time frame, but obviously I use economics, so I don't know if that would work for you. But you know, it's just waiting, define the trend here very clearly, moving to the downside, draw a fib, wait for some sort of pullback. So here you would go short, let's just say 50%. So your entry will be here, stop loss at the high of 1, and take profit will be at the fib extension down here. I don't know if that hits. It does. So there you go. Easy as that. Just draw a fib, you will make money. Now you can buy my course for $500 and you'll get a 2-page PDF on how to draw a fib. Will US 30 rise or fall after FOMC? Ton, Adam, I think just give me 10 minutes and I'll let you know. I just need to grab my crystal ball and my tarot cards and I'll give you an answer. Yeah, Bashi knows the patterns. An ascending channel. The German stimulus started with 800 billion, now it's only 500 billion. Will be deployed, out of which 100 billion is for climate change. Where's the majority of military spending? Okay, interesting. What happened to S&P 500 after Fed speech? Same answer to you. I need, yeah, again, just give me some time. I'll conjure up some spirits and I'll get my Ouija board, I'll get my tarot cards, and I'll let you know exactly what is going to be said, and I'll tell you what to buy and sell. But no, on a serious note, how do I know? I have the same information you do. I don't know what Paul's going to say. Where's James' Magic 8 Ball? Well, you see, Bashi, when a few weeks ago, what happened was I was on an absolute tear. So what happened was I bought gold with essentially full margin, about 5,000 lots. And then the FBI came to the door and they said, "Are you Michael?" I said, "No, I'm not Michael." And it turns out they're talking about ICT because I'm just destroying the market so bad they had to confiscate my 8 ball. You know, like, this is the secret, the source. My sarcasm knows no bounds. I think it's British humor. Can I SL hunt Powell? Yeah, maybe you can. Canada's having trouble now with tariff. Both Canada US oil price is dropping as well. Fundamentally, I'm long US dollar CAD. Yeah, makes sense. I think, yeah, long dollar CAD, I would say makes more sense than going short, but I don't see a long entry at the moment. Kind of check dollar index. Are we in for a pullback? Yes, I would. Yeah, it's very difficult to say. I would, based on just price action, yes, I would say so. This is a very aggressive downside move with no correction, no pullback other than consolidation. Fight between bulls and bears. I don't think this consolidation is going to break. I think the only way this breaks is FOMC. We need to have some sort of guidance, really. If we get positive or, you know, more of a hawkish tone, then yes, likely we'll come back up. But yeah, that's pretty much all I've got for you. If it's negative, or sorry, not negative, it's dovish or neutral. Yeah, I don't know. I think we might be in some trouble. I think we might be then heading down towards 101, 105, 101 to 100.5. Maybe. We'll see. Got a different kind of 8-ball if you want it. I appreciate that, Sniping Gods, but I did get a warning. Apparently they're going to put me in the back of a van and kidnap me if I did it again. So I can't really do what I used to do. But, you know, I'm going to enter Robbins next year and do negative 96% just to prove how good I am. But that's a story for a different day. Check CAD Swiss for a good short setup. CAD Swiss, okay. CAD Swiss. Yeah, I don't mind the idea. So I think, or the way I view the Swiss is more of a proxy currency in a way. So the way I treat it typically is a way to get into a different market. So if I wanted to go long or short on the CAD, but it was getting outperformed or underperformed by other currencies, I could then go to the Swiss because it, especially at the moment, it's essentially just sideways. It's a very stable currency, generally speaking. So if you wanted to go short, I can see why. If you're particularly bearish on the CAD, the Swiss might be a good little way into that. Let's see. I don't really see anything technically. I think, yeah, it did have a nice fib pullback here, but I don't know. I think I might have missed the entry, or for my strategy, the entry's been missed now, unfortunately. The poop man. Fair enough. Bash is going full margin 1 minute on the S&P. That's a recipe for disaster. Oh, Euro Pounds had a nice. Oh, it's only 15. Never mind. I thought it was 4 hour. Yeah, the Euro seems to be pulling back today, which is interesting. Oh, this was another one I was in, actually. So Euro Swiss, a little bit sad. I was doing well on Euro Swiss. I was on a 2-win streak, but it got destroyed today. So no UAV for me, unfortunately. So a bit of a rough start today. We've had Euro Swiss 2%, Australian dollar, US dollar 1%. We've had gold 1.5%. Then we had Swiss yen -1, Euro Swiss -1. So we're up about 5% this month, but yeah, we'll see if we can push those numbers up. I need an adrenaline boost today. Yeah, so do I. Okay. Well, time's gone quick today. I think I've only got like 5 minutes left. Crazy. Really quick. Time flies when you're having fun. Silver. Silver might actually give a better opportunity than gold, just because it's given us a bit more of a pullback. And to be honest, I can't take it because of FOMC, but for a short term sort of intraday position, I wouldn't mind something like this actually. Stop just below this 200 moving average, TP at the high, just under a 1 to 2. I quite like it, but yeah, a bit too risky to take right now. How do you see the BOJ intention for interest rates? Yeah, it sounded quite neutral to dovish, to be honest, which wasn't what I wanted to hear, but it's fine. The inflation rate in Japan isn't healthy. Oh, it's not on target. It's actually quite a bit away from target for them. So I think they will still hike rates, but typically in the slow fashion that the BOJ do. So definitely not holding my breath. And to be honest, I think I'm going to reduce my yen exposure. I might see how dollar yen progresses, take one more long-term trade on Swiss yen, and then just leave it, and that'll be it. At least until we start seeing more developments. As a day trader, I'm short New Zealand yen. Okay. As a day trader, what time frame are you looking at? I'll be honest, I don't really see anything technically. I mean, I suppose you've got kind of a break and currently retesting type of thing here, but other than that, I don't see much. But of course, I don't know the way you trade, so maybe you're seeing something I don't. It would be nice if these pound trades could actually do something. Pound New Zealand's fine, but pound Swiss is just sort of not really moving. It's a little bit of a shame. It's not a huge surprise, though. Normally, the market's very quiet when we've got some sort of news or bigger news coming, like FOMC. Right, let me just double check these times. So 10:15. Oh wait, no. So Chris is coming out at 12:15. What time is that for me? That's 12:15. 4:15. Okay, yeah, I've got about 3 minutes left. So if there are any final questions, let me know. If not, I'll keep rambling. No problem. Oh, the DAX. This is one I didn't cover. So I would love to get long on the DAX at some point. The problem is I just can't buy it here. It's a little bit too high for me. So I would need to see price just have some sort of pullback, whether it's, to here, whether it's 50% pullback, whether it comes all the way back down here to correct this, this bullish aggressive candle. I don't know. But if I can see something, that would be great. And then I can look to take an entry. So let's see, 50% would be here. So this might be an option if we can come slightly lower. What's the pros and cons to taking partial profits? The cons are you make less money, in my opinion. So let's say you have let's say me and you have exactly the same trades, and they're both 200 pips or 3% each. We both get both in and out at the same times. Apart from the difference is you take partials, I don't. I will make more money because you've been cutting off your profits and reducing your size along the way. So that's the con, is if that whole move works, the whole trade is good, you will make less money off your work. The good thing is, if the trade reverses, you've booked in some profits and you've reduced risk, and likely you'll make money on a losing trade, whereas I won't. So it's one of those things. Again, pros and cons. It depends on how often your trades hit take profit, how do you manage trades, how often do you take partials, all that type of thing. 4-hour flip on gold. 4-hour flip. I'm not sure what you mean by a 4-hour flip. Do you mean it's gone from bearish to bullish, or I'm not sure. I don't think I've heard that term before.
Hey, James.
Oh, hey, Nick.
How's it going, man?
Yeah, good. How are you?
Doing well, doing well. Big day today with Fed meeting, and obviously these are long streams today. So we are just about the third hour down here, thanks to your help. Got some great value to the community. Just for everybody who has enjoyed that commentary from James, he's a regular contributor to our kind of community stream here, the A1 Trading live stream show. James comes on a regular basis, and if you want more content from him, he puts out his own stuff that I highly recommend that you take a second, add this to your subscriptions list on YouTube. It's free to do, and it's free value. Check out Forex James on YouTube. And if you're interested, you can check out his exclusive services where you can trade alongside him inside of his Elite Trader service. So check that out at his website as well. That is elitetraders.io. So check that out if you're interested. And of course, also make sure to subscribe to Forex James on YouTube. James, thank you for coming on to the show and sharing some value with the community today.
Yeah, no problem. Thank you for having me. See you later, guys.
Right,
have a good one.
See ya. All right. How's everybody doing? We're back. This is the third session that I've done today. So we are marathoning today. Tell you that much. Could you guys do me a big favor? Hit the thumbs up button. I would greatly appreciate it. It would help to get the show in front of more people. We're live streaming to 550 people between Twitter and YouTube. So thank you for everybody who is hanging out, spending your day with us. Hopefully, if you're trading alongside, if you're just learning, whatever you're doing, hope that you hope more success comes your way. We're counting down now to the Fed meeting. We've got NASDAQ up about 1%. S&P 500 is up about 0.7. The dollar index is up today after kind of getting hit pretty hard here. But I want to talk a little bit Forex, a little bit more Forex focus for just a minute. Because I feel like I've really exhausted recently my, I will talk about gold as well, always. But I feel like I've exhausted my index analysis, and I really want to focus a little bit on Forex. I also want to share with you guys transparently a trade that I'm working with, Euro Pound. So let's look at Euro Pound. I've got 3 trades open. Shorted once, shorted twice, shorted a third time. Trades in the red. If it comes down to this about here, I'm probably just going to close out the trade and just take a break even between the 3 entries. This is not martingale. These are the same trade size. I took a small position here, a second one here, a second one here, or a third one here. I dollar cost average a lot when I'm trading Forex. So I have 3 trades open on this one, and I'm dealing with a trade that's kind of gone against me that I'm no longer super interested in holding. But when it comes to Forex, I want to talk about this because I think it's important that we make this distinction, especially a currency pair like Euro Pound. Whatever you trade, I would encourage you to really take a close look, take a microscope to it, and ask yourself, like, what kind of behavior does the market that I trade typically display? It's going to be really hard to convince me, and I guess you don't have to convince me, you do what you want. But it's, for me personally, it's hard for me not to see that this is a market that I don't really want to try and trend follow. And I definitely don't want to put a tight stop. And I definitely don't want to try and trail stops on this kind of market. And even good trending markets have these types of periods, don't get me wrong. But Euro Pound specifically has a track record for mostly trading choppy. And it does go in a direction, but it trades pretty choppy. So the reason I say that is that when I'm trading something like Euro Pound, the two economies are pretty intertwined, the UK and Europe, right? Big trade partners, proximity, kind of like Australia and New Zealand. So typically their currencies don't massively dominate one over the other. Typically there is a bit of a kind of a range bound, kind of choppy back and forth. You give some, you take some. So when I look at Euro Pound, the way I trade this thing is I typically dollar cost average. And if I like the fundamentals, I may short it or long it. And I'll take it in pieces instead of all in at a certain level with a tight stop. Basically, I'm just willing to dollar cost average. So with Euro Pound, I think it's gotten to a point where it's likely to push lower. If it doesn't, then I'll probably just kind of stick with the trade. But when it comes to Forex especially, I'm very focused on kind of like accumulating and distributing my position. So right now, I'm building shorts. Would I add another short position? Possibly. It depends on what the fundamentals look like. But it probably wouldn't be unless we saw a major move up here. And you may say, what the heck? Are you kidding me? Wouldn't that blow your account? And the answer is absolutely not, not even remotely close. My position sizing is so small per trade that if you get a massive move like this, it's going to barely be more than a few percent max drawdown on my account. So I'm trading with really tiny size, and I'm just willing to say, look, as long as I still like the fundamental story, and I still believe that this market is long-term, kind of due to be a range-bound type of market, I think the probability of me making money in the end is okay, right? It's not a guarantee. Nothing is. But if that's kind of the overall trade, so be it. But we also might be topping out here. We've had this key resistance level. I think we may see some more downside in this pair. And at which point I could probably just go ahead and take a small profit or break even trade on this. Okay? Do you have some promo codes? Yes, thank you for dropping that, Chandler or James. We do have promo codes. Use code YTLiveVIP, YTLive, for a subscriber discount. Nick, were you given any misconceptions about trading when you first started? And since through experience, dispelled it? Many, right? Many things, in the trading world are just not as they seem. The biggest one that I can recall from like being a viewer, right? I remember I watched so much. Some of you guys might know him. Many of you probably do not because he's retired off YouTube. But I used to watch countless hours of Rob Booker, who is a notorious OG Forex trader, stock trader, trades a little bit of everything, just like I do. And I watched so many of his videos. He was big into robot trading. I got into robot programming for trading quite heavily, watching his stuff. But anyways, one of the big things that I always thought when I first started watching and learning about trading was that profitable traders have some secret that I don't have yet. I really, truly thought to my core that what profitable traders had was some kind of secret pattern that they weren't telling you on YouTube. That's what I really thought. I really thought, and I genuinely mean this for somebody who I'm speaking to myself 10 years ago or whatever, when I was watching tons of YouTube on this stuff. Genuinely, I thought that they just weren't telling, like they were selfishly holding on to the real secret to how you spot what the market's going to do next. They're not telling me that technical pattern that they use to know which way it's going to go. And if they would just give me that selfish cheat code easy answer, I too could be a profitable trader. That is genuinely what I thought about profitable traders. And I have since then, through the years of doing this, come to realize that profitable trading is a combination of two things. Two things. Well, actually, three things. A back-tested system that you've really put your work into, back-tested and found profitability in a trading strategy through spending the time and effort, doing your homework to build and study and test a system. Understanding that a system is not going to be perfect. Nothing's perfect in trading. So a decent back-tested system strategy that overall makes more than it loses. Number two, embracing the concept that great trading is just educated guessing or gambling with an edge, right? You don't know what's going to happen on the next trade, but you have a slight favorable scenario. And then third is small positions, risk management. Those three things were the key to profitable trading. And there's a bonus one. There's a fourth one. If you think you're going to get rich quick and you don't already have a lot of trading capital, unfortunately, that's not how the markets work. You have to have a lot of capital in order to make a ton of money from the markets. In my personal experience and opinion, people who try to make a lot of money when they don't have any capital to bring to the table, if you only have like $1,000, I'm not saying this to like bum you out or disappoint you or frustrate you, but genuinely, you're more likely to blow all your money if you're trying to make that money into a big amount than you are to make great returns over time if you just embrace slow and steady and find ways to deposit and build up your trading capital. There's the slow and steady way is the truth. So those are some things that I genuinely learned through just obsessing over this stuff the last 10 years of my life. Back-tested system, good risk management, and embracing that every trade is an educated guess. It's not a certainty. You don't know what's going to happen next. And not even the best traders in the world know what's going to happen next, right? Educated guessing. That's it. Gold continues to make its move here. I've just trailed my stop yesterday on the 4-hour chart. Stops below this 3,000 level. 2980 is kind of that level support that I'd like to see it hold. Broke out. Once we broke out of that, just moved that stop loss up and just below this low. So if we do see if we see some volatility in gold and it comes down a little bit, okay, fine. I'll stop out of the trade if it breaks support. Okay. So that is kind of the game plan for gold. It is in the positive territory. It was red this morning. It's come back into green. I mean, barely, but it is green. NASDAQ's up. How's Tesla doing? I bought more Tesla shares recently. I don't know if I haven't really been talking about my stock pickups too often. And I know the stock, it's kind of sad. I can't really do it. I can't in good conscience as a YouTuber talk too much about stocks because I look at the retention graphs on my videos. Whenever you put a video on YouTube, you can watch back the retention of the video to see how well that video is performing and at which points in the video people are skipping or not watching. Anytime I talk about stocks, not so interesting. Indices like NASDAQ, S&P, people like those. People don't mind that. They like gold, they like dollar, they like euro, pound. They like those, but individual stocks, not so popular. That being said, they do make up a good portion of what I do in the markets. I bought some more Tesla shares recently. And I bought a whole bunch of stocks recently. So if the market keeps going lower, I'll have more stuff to buy. And if it starts to go up, then I'll just kind of hold what I've got. S&P 500 daily chart. Again, kind of beating this story over and over. So I am waiting for a breakout, see if we can get this kind of move as a possible confirmation that we may be starting to flip bullish, but it's still a little early to call. I think, you could have, depending on what happens with the Fed meeting and the tariff stuff, April 2nd is a big day for retaliatory tariffs that Trump wants to go forward with. You could see this market either fail out around these areas, but I'd be really curious to see. I like a bullish setup if you get a strong break above here. I'd be looking for longs. I'm not looking to short this market, so I'm not interested in shorting at these levels. But if the shorts were going to get strong, I would think that this would be the area, right? So as a bull, I'd like to see this break that level, scare the shorts out of their shorts, and I'd be looking to buy a retest intraday. That's what I'd be looking for. Put to call ratio, however, has really pulled back. So if I go market sentiment, put to call ratio. Put to call ratio, let's not do gold, let's switch it to SPX. You can see that the put to call ratio went from extremely scared, people buying puts like crazy, had a couple up days in the market, and the put to call ratio has really, really changed back to a neutral level. So sentiment for stocks, sentiment for indices is pretty neutral right now, I would say. Well, still scared, but on what the options market is showing you is a huge contraction in the put buying that was going on. So like I said, if the sellers are going to come in, if the bears were going to come in, I would think it would be closer to now. It's kind of now or never in my opinion. So if the bears are going to come into this and take this thing lower, I would think it'd be around this 57.20 level. Like I said, I'm not a bear. I am bullish. But if the sellers were going to take this, I would think it would be around here. What I'm looking for, like I said, would be the blue scenario. If you get a break, excellent. I'd be looking for pullback buys, and I think we go higher. So that is my opinion on that one. We will see. We will see. Guys, we're getting close to the Fed meeting. Coming up, the dot plot comes out in about an hour and a half. We're going to be running this show back all day long. We got a long show planned today. We're at 3 hours and 11 minutes. Real quick, I got to go get some more water. While I am doing that, maybe we can play a quick break. Shout out DNA Funded, one of our sponsors here on the show. If you guys are looking to get funded, I saw somebody asking a question about prop firms. If you guys are looking to get funded, check out DNA Funded. They are a prop firm that sponsors our show, and they are the team there, super professional. It's a the thing about prop firms is I typically like to stay away from like influencer owned or led prop firms, because while influencers are great at getting marketing going and stuff, I actually prefer more like business backgrounded prop firms. So check this out. We're going to roll a quick break, show you DNA Funded, a sponsor of today's show, and some of their great offerings that they currently have for traders. So stay tuned. We're going to play that, and I'll be right back just after this. Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90%, and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. All right, I'm back. Kind of out of breath because I ran. We got some water. Everybody stay hydrated today. What were we saying? Oh yeah. So like I said, if you're interested, check out DNA Funded. We actually have that code A1T20. I believe will get you 20% off still. So don't miss your opportunity there if you are interested in getting funded. Okay. So NAS up 1% today. The other thing about this, we talked yesterday about the average true range. Average true range for a lot of markets right now is very high. So if I look at the average true range, let's ask the same question we did yesterday. Is today's price action so far, quote unquote, meaningful? And what I mean by that is that if the move of the day is bigger than the average move, we would kind of call that like an outsized or a significant day. So today, average last 14 days for the NASDAQ is about a 470 point move. So right now, where are we at? We're at about 260. So not really. Was yesterday's move significant? Not really, right? Under the average. So the last few days have been mostly kind of tame. We haven't really seen a decisive move one way or the other for things like the NASDAQ and the SP500. You know, so when you look at, S&P, average move is about 100 points a day. So were these moves significant? Not really. 80 points, today's move, 63 points, right? So you're seeing below average moves now in the last few days. So volatility contracting a little bit. We can also see that happening in the VIX, right? The VIX cooling off. So today with the Fed meeting, if you get something that's really dovish, that could get us that breakout that we're discussing. And it would get us not only a breakout, it would get us a breakout on a above average kind of move in price action. Conversely, the same thing could happen to the downside. You could have an above average move to the downside. But what if today's Fed meeting just causes the most boring scenario where we just hardly move and we just stay in the range? Then again, we're back to, look, things are just kind of ranging. Gold, same kind of thing has been happening. You had a nice move here recently. In fact, I think yesterday was an above average move, $37 in a day. How much did we move yesterday? Yesterday we moved, about $38. So yesterday was a significant move for the price of gold. I just thought of a really cool indicator. Anybody else know where I'm going with this? A really cool indicator would be some way of highlighting candles that exceed the average true range. That actually is a really fun indicator. Like, so that would say yesterday was a significant move. This one is not. This one was not. This one was not, right? Obviously, it's just the big candles typically are going to be the ones that are significant moves. But there is something to be said about big candles. Most of the time, the market's daily range is just not that big. This is why I love the daily chart so much. The daily chart is so awesome because you can see the significant true moves that are happening in markets. Like if you take a look at the dollar index, here's a great example. All of this noise, I know this is not exciting, but like all of that is just noise. The real moves, the fundamental driven moves, are moves like this. Those are just straight bearish moves. This was, a bullish uptick, and then these were real bearish moves. But when you get these really consolidating, going nowhere candles, it can be very deceiving on the 15-minute candle, but on the daily chart, you're not getting past it's a lot more clear when something is really happening when you look at the daily chart. So just something to think about. I think dollar index is just kind of ranging. We'll see if there's a decisive move today. I actually think that would be a really cool indicator, decisive candles. I'm going to write that down because that's fun. Decisive candles. I don't know. Could be fun. Anyways, everything's still kind of just waiting range bound until we get to FOMC. Really quick, I mentioned this earlier. If you missed it, we're doing a giveaway this week in our Telegram channel for the Edge Finder. If you don't have a copy of the Edge Finder and you want a chance to win, here is your chance. Make sure, click the link just been dropped in the chat to join our free Telegram channel where we are sharing our analysis each day. And we're also sharing some free giveaway opportunities right there. Nick, what's your expectation for FOMC? Just like James said earlier, nobody knows for certain. But I think most likely Powell is going to say, I think Powell's going to just say defensive. I said this earlier, but whenever you think, look, none of us know what Powell's going to say for sure. He could surprise us all. But put yourself in his shoes, look at the data that they look at, and this gives you a decent answer as to what he's likely to say. If you understand what we're looking at, what we see here is some material cooling in CPI and PPI. So inflation is cooling, right? At least right now. Seems like it's on trend to continue to cool off. Inflation looks okay. Labor data looks okay. Jobless claims better than expected. JOLTS better than expected. Unemployment rate went up. That's not as good, but still at a low level. Wage growth still decently strong, but moderating a bit. ADP a little soft. Non-farm payrolls pretty much came in line with expectations. So you have a kind of a mixed picture. A mixed picture does not suggest he needs to rapidly cut rates, and he also definitely doesn't need to hike rates. So I think he's going to come in pretty neutral. He's going to come in likely pretty neutral. And I think he's going to point to overall, there's still room to cut rates, but that they can take their time. That's likely what Powell's going to say, right? We have to put ourselves in the perspective of Jerome Powell. We're going to try and understand the same data that they use to make their decisions. We have access to. We can look at a lot of the same stuff. Summary, inflation's cooling, jobs market's okay. There's a lot of work to be done on inflation, but there's no crises that are obviously present. It's why part of the reason, what I just said right there is why I'm bullish on stocks, right? There's not a clear and present recession is happening moment. If you read the headlines, you would say, but the headlines say that the market's going to crash because tariffs are going to cause a recession and the biggest market crash of our lifetime, right? If you've been watching my titles and thumbnails and videos, I've been having fun with that. Been teasing because you open up my videos and I'm pulling up, articles of just all these different newspapers or online sites, just trying to really convince people that this market is going off a cliff. Maybe it does, but I think most of the time that is, it does get a lot more clicks on my videos when I make more, bombastic titles and thumbnails. But I don't believe that the market is going to crash off a cliff. And I think that at the end of the day, we have fun with the titles and thumbnails, and it gets a lot more attention to what I think is really important messages within our videos. I did a side-by-side comparison. When I make like today's top setups, thumbnails and titles, way less people end up seeing the video. If I make something like the market might crash, and then I talk about in the video why I think it might crash, but it's probably not going to because this, and this, those videos do a lot better. And people, watch the video at a higher rate. They click the video more often. And at the end of the day, we put a lot of effort into our content. So whatever we can do to get that message out to more traders, especially when I think it's such an important message to not give in to the news cycle, right? And just get scared and make dumb decisions. Look, if you think that the market has room to continue lower, you might be right. But there's a lot of people acting completely out of fear right now in this market. There's a lot of people who are completely convinced the stock market's going to crash and I need to sell everything and I need to run for the hills and put my money under a mattress. Like that is really there's a lot of people out there who are drinking the Kool-Aid of news stations and news articles coming out. And it's not their fault. I mean, it's not the people's fault. That's just the system, right? The system is very much like, you know, at the end of the day, humans click and watch things that evoke fear. It's human psychology. So those stations do that because, you know, that's what sells. But you as a trader, you as an investor, also have to be careful on both sides of that. When everybody gets euphoric about something too, you have to be careful. You just have to be careful that you don't, in my opinion, the sweet spot is you don't want to be completely contrarian or completely crowd following. You want to just think for yourself, right? Ask yourself, we had tariffs in 2018. Did the world end? No. Could it lead to some economic growth concerns? Sure. Maybe that even causes some slower than expected growth for a while. And maybe the market does continue to kind of chop around or be ugly for a while. But there's a big difference between, okay, I'm going to be a little cautious and be more constructive with what I'm watching, and thinking that I need to buy puts and throw my whole account into cash or into bearish bets on the market because the headline cycle is so ugly. Oftentimes, the news gets most pessimistic right at the bottom, right? That is just market 101, right? Markets 101, or that the bottom of the 2008 sell-off or 2020 sell-off was riddled with the worst news entering your phone, entering your email, your website, your YouTube. When it gets loudest, just be careful. Just be careful. So, yeah. So we'll see. But we've got S&P 500. Like I said, if the sellers are going to take it, I would think that they're going to try here. I am not bearish. I'm looking for a breakout at that level. I'd love to see something like this. This would actually be a signal for me to look for longs. But I need that leg higher. Just beat up the bears one more time. And I think there's a good chance that from there, you have a straight shot to start seeing higher prices. Like, sellers have been in absolute control of this market for a few weeks now. Big sells, retracements, but then sellers just completely take it over again. I want to see that pattern fail. So I'm looking for this. Because at that point, I think you failed. The sellers have failed to hold, right? If we start to see rapid profit taking and sellers can't rally at these levels, again, if you're a bear, you want this level. You want to see sellers rally, right? You want to see profit taking stop, and you want to see fresh shorts come in and push this thing back through those lows. If you're a bear, that's what you want to see. Price action signals for bears would be rejection here, follow through to where we left off. That's kind of pivot one, and main point two is this, right? I'm not a bear. I think the path of least resistance for the stock market is actually higher for indices. But the price action signal that I'm looking for, I know I keep saying it, is this. Okay? Beat up the bears one more time. Yeah. Man, I don't know if you guys have seen that too, but I just feel like I scroll through Instagram and so many people are just like, it's like the crowd is just fully convinced this is it. Like, we're going to crash. It's gotten a little quieter here recently with the slowdown in selling, but during this time it was just like, and again, we saw that in the data too, that put to call ratio that I keep bringing up on the stream, right? Put to call ratio got really, really overdone. And I make this point because nobody knows with certainty what's going to happen with the markets. But even if you're bearish, this is my thought. If you're bearish on indices, totally cool. You may have a good reason for doing so. And you may be being patient and constructive and managing risk. And I love it. I am bullish. We may disagree, but we can both, as long as we're being respectable, managing risk traders, we can still coexist peacefully, right? There's the old expression that in the markets, bulls make money, Bears make money, pigs get slaughtered. And it's a pretty aggressive statement about Wall Street, but it's true, right? If you're just chasing and you're just trading off emotions, you're most likely to get beat up in this market. But if you're constructively bullish, or you're constructively bearish, and you're managing risk and you have your reasons, then great. But I think that you just want to be careful. If you're a bear, right, you don't want to be selling at the lows. Just like if you're a bull, you don't want to be buying the highs, right? You don't want to chase something off a cliff, and you don't want to, just outright get short when the big selling move has already kind of occurred. Again, if you're a bear, maybe you see this level, hold, and we start constructively seeing price action break down once more. Cool. That's the point, is you can coexist. Bulls and bears, we may have two different opinions. I might pull up gold and you might say, I think this thing is going lower. But maybe you're like, but I'm going to wait patiently for signs of failure at key levels of structure. And then I'm looking to take this thing lower. Cool. I respect that. Like, I'm bullish, you're bearish, and we can coexist. What I don't get is just shorting it, and just getting pissed off and shorting it more because you're mad that it's going up. That's not trading. That is just, you don't have a reasoning for what you're doing. You just are hoping and praying, which is not a very good trading strategy. Hoping for a reversal is not a very good strategy. So again, I think we can be more constructive than that, and we can wait for patient setups. And even if you're bullish and I'm bearish, or I'm bullish and you're bearish, even if you disagree with something that I'm saying, like, we can coexist, right? The other thing is I listen to a lot of channels that think very differently than me on purpose. I think it's really important that you do that. That if I'm saying something that you disagree with, hear me out. And if I'm saying something that you agree with, I hope that you also find other creators that you disagree with. It's empowering to listen to opposing thoughts, because it helps you to either build out your stance or your reasoning for something, or for a belief that you have. And it's also maybe sometimes eye-opening to get you to change something or challenge something, right? It's a good thing to challenge your own beliefs, trading especially. I think we get investor sentiment stuff coming out tonight. Is that right? It comes out every Wednesday. So tonight we get the latest round of AAII investor sentiment survey stuff, right? We've had incredibly bearish sentiment for the last few weeks. My guess is it's going to come in a little bit less bearish. You've had a little bit of sideways, a little bit of choppiness, some up days. I think you're going to get a little sway in sentiment. If anything, the put to call ratio would suggest that, right? The put to call ratio was extremely scared. Now it's come down. So probably you're going to get investor sentiment survey doing the same. People reporting that they're feeling at least less bearishness than what we saw last week, right? Carlos, you had a question for me? Let me see if I can find it. S&P has always made a big move to the upside after a decent drop, when the media and everything else has convinced people that it's a crash. Very commonly the case. Not always the case, but most of the time when you get huge corrections and people really, really scared, that historically is usually a good buying opportunity. To the fairness of the bears, a lot of times the buying opportunity is around the corner, but it could still be another sell-off or two later, right? Timing the bottom is very difficult when it comes to market sell-offs.
But yes, I do agree. Generally speaking, right, when you get the crowd really scared, the risk to reward starts getting really good. So what I do as a trader is the crowd is really scared. I'm looking for the technical signals that a bottom is in, and then I can take a good, proper stab, if you will, educated guess at getting long the S&P. Silver down 1.4% today. Copper, Chris was talking about this earlier. Copper, which is a very useful asset for determining the state of economies globally, like this is usually a pretty good indicator, is telling you something interesting here. Copper is used in like everything. Copper wiring, it's used in a lot of stuff. So when economies of the world are expected to be strong, copper typically goes up. So when I point that out, I find that to be very interesting because right now the whole world's worried, or a lot of people are scared that we're going to go into a ginormous global recession. But I think what might be happening here is that the tariff stuff is prompting a huge kind of debate, discussion, renegotiation of global trade, right? A lot of places may benefit from that, and maybe the US too will benefit from it. Who knows? But if there's this huge investment going into Europe due to the change in Ukraine and US and Russia relations, if the European Union is going to spend a ton more money on military and start, opening up their debt market like we discussed earlier in the stream, that could be stimulative to the global economy. If more places start to negotiate with the United States with their tariffs, that too could be an interesting thing, an interesting dynamic shift in the world trade situation. If other places start to negotiate with the US and tariffs actually come off, what could happen is, and again, this is the optimistic or hopeful idea for people who are more on the pro-tariff side. They're hoping for renegotiation that ultimately leads to lots of places like taking down their tariffs, which levels the playing field a little bit more for the US, which could stimulate, hey, okay, we're good, we can continue to trade, and there's less, of an imbalance in the trade relation. There's pros and cons to it with everything else there is too, right? But that's the idea is like, if the US has tariffs on other places, or I'm sorry, if other places have tariffs on the US, and then the US basically says, hey, we're going to put those same on you. And then the other country, the idea is that the other country says, okay, fine, we'll renegotiate. Maybe we meet in the middle somewhere. And the US walks away with a slightly better trade scenario than they did recently. And the other country's like, okay, cool, we get to keep the US trade relation, which is the biggest consumer in the world. You could see a trend of taking down tariffs. I know the idea is like, this is crazy because most people are thinking tariffs are going on everywhere. But what if the ultimate end of the story is by putting on all these tariffs and negotiating, if other countries work with the US, maybe the idea is they can actually ultimately pull off a lot of tariffs. Like a lot of tariffs could come off like uniformly. Like, okay, fine, we'll take some of ours off if you take some of yours off. Like, I think that's the idea. We'll see. You're playing with fire there because it disrupts the supply chain of the world and it could cause growth concerns. So there's downsides to tariffs too, and some serious risks there. But there's the idea too that, look, if you have negotiations, the idea is like, okay, either the US gets a bump in revenue or the US gets better trade relations. I think the ultimate goal would be to get better trade relations. It's just up to the other countries to see if they actually work with the US or not. And I don't know that stuff, right? The foreign affairs stuff, that's a lot of unknowns. That's why the market's so freaked out, right? So we'll see. I tend to think here's a wild thing. I think the market is going to bottom out before April 2nd. Okay? April 2nd, okay? Here's a prediction for you, not that you asked for one. The prediction is this is the day that reciprocal tariffs go into effect, and that the idea is mass tariffs are everywhere. The market is really scared around this. I would venture to guess there's a possibility, depending on the Fed day today, that we may have already put in a bottom. We may be in the process of bottoming as we speak, because again, sentiment got very stretched. People shorted into the lows, as they typically do. Sentiment got really, really bad. And now you see this market trying to constructively bottom out. But why would I say the market's going to bottom out before April 2nd, most likely, in my personal opinion? This is not financial advice. The reason is because the market does this. It gets really scared of something, and not always, but most of the time, that's why this is an educated guess, most of the time, the market's worst fears are not realized. And what I think could happen is that in the next few weeks, we get some negotiations that lighten up the load. The world doesn't want to go into a recession. A lot of these other places don't want to go into a recession, and U.S. tariffs could lead to that, right? For those places, more so even than the U.S. Canada is way more sensitive to the tariffs than the U.S. is, because huge amounts of Canadian GDP come from trade with the United States. Small amounts of U.S. GDP come from Canada. So the point is, we may see a return to the negotiation table, which would make the market excited. So a lot of people think, oh no, April 2nd is doomsday, right? That's the day it's all going to crash. But the markets do this all the time. Usually the worst fears, and we have these big, scary, looming deadlines. Oh my gosh, April 2nd, just don't even wake up that day because the world's over, right? That's what the headlines would have you believe. Just set your alarm for never, because anyways, the point is, I think a controversial opinion is that maybe we've already hit a short-term low, maybe not a forever low, but I think the market has put in a strong low for now. And then I think we could short-term see this market continue to go up despite having that scary date ahead of us. I think there may be a return to the negotiation table between now and then for a lot of places, and that the worst fears of the market are likely not going to be realized. If you're an options trader, this is 101 stuff. Implied volatility is usually higher than actual volatility. Not always, not guaranteed, and that's where the risk is, but most likely, right? Most likely, I think that the market's worst fears are not going to be realized, and then the market will have bottomed out. That's my controversial opinion. I want to bring in some heavy-hitting help on this one because it is a controversial one. We're going to talk to Chris Pulver in just a second, see what his thoughts are as we count down 1 hour to go until meeting minutes. Hold on, I gotta figure out. Am I going on? I'm going to let Chris go for just a second here solo and then join him. I think I might do that. Yeah. Chris, if it's cool with you, I'm going to just jump and grab some water, take a few minutes break, and then I'll come back and join you if that's okay with you. All right, cool. Chris is going to take over for a few minutes, guys, and then I'm going to join him in just a bit to get ready for the FOMC dot plot event. Huge day today. Real quick before I leave, guys, join our Telegram channel. We're doing a free giveaway for the Edge Finder this week. We'll drop the link in the chat. We're going to set up the stream, play a quick break, and Chris Pulver's on right after this. Be right back.
2025 is here, and to kick off your new year of trading, you can get access to our free A1 Trading Telegram channel. Inside, we share EdgeFinder data, free trading courses, market forecasts written by our in-house traders, and free trade ideas on Forex, indices, gold, and more. And if you're more into the stock trading world, we have a whole Telegram channel dedicated to just that. Start your new year off right by joining the A1 Trading Telegram channels completely free. Links can be found in the description and in the live chat. Now, back to the show.
All right, everybody. Calm before the storm. Just after 1 p.m., just spot checking everything. We're still up on the day. Market's clinging to a slight green day. We've got SPX up 0.7, SPY up 0.66, equal weight S&P up 0.4, NASDAQ 0.9, Q's up 0.89, Dow is up 0.49%. IWM or Russell 0.76. We've got the IWD, which is the top 1,000 value, up a little bit today. IWI is growth, the one that probably got hit just as hard as IWM. IWX is serving a little bit better, top 200 value, up 0.33. IWX holding pretty steady here. I did post in the Pulver Alerts, I added a chunk of shares on SCHY. I did some deep diving over the weekend. SPEU, DBEU, VGK, IEUR, JFAM, all these. Basically, it's all non-US ETFs or funds that I wanted to consider playing. So I chose SCHY, which is a Schwab instrument. I also have some exposure in SCHD, which is a Schwab dividend play, mostly on blue chips, kind of plays along with the Dow, but has a slightly higher dividend, and also SCHG, which is a growth. It's a growth diversifier. I think there's over 200 symbols in the SCHG. There's over 100 in SCHD. SCHY, as far as the makeup goes, it is 56% Europe, 21.6% Asia, 11.23 Oceania. We've got some North America exposure, mostly Canada, Mexico. This is all non-US, Middle East, Latin America, Africa. So two ways I'm trading this. I like SCHY for a non-US play. And then also I have Latin America with ILF and EWZ. ILF and EWZ. EWZ is Brazil. I've been holding that one for a while. I added some more to it recently, and we're moving pretty nicely off the lows. To me, this looks like a nice little cup and handle pattern that is breaking these recent highs. We look back, left in the chart. This was a bit of a bear trap through, the lows of 2022, nearly testing the COVID lows, which is part of the reason I was pretty intrigued by this in the first place, is buying this essentially off of 2022 lows and being willing to hold. Now, as far as my profit targets go, look, I'd love to see some diversifiers head up at some pretty attractive levels. I mean, and this is just one little sliver. I mean, I'm talking about maybe putting in 100 to 200 shares here. The ETF right now is trading for $26 or $27. It's not going to break the bank. It's just a little exposure. But to me, if this can head up, let's say we go from 26 to $40. Well, that's a 50% increase. I mean, I don't know what stock in the US or index in the US right now is going to give that in, I think, the next 6 to 12 months. I don't know how aggressive this rip and rotation is going to be. I still think there's a lot of reasons for the market in the US to still remain somewhat stable. I say that I pulled some interesting data this morning. I was just in a live session that just wrapped up. We talked about the dot plot a little bit earlier today in my session. This is my outlook on SCHY, the chart that I posted in Pulver Alerts. Minimum target would be about 27.20. I'd like to hold this into 30s. For EWZ, I'd like to get into the 40s. Thought some interesting stuff here on market breadth, which I've talked about. This I thought was interesting. This is a point from, you may have heard of this guy, Tom Lee. He's on YouTube quite a bit, runs a pretty successful hedge fund. This is one of the fastest corrections we've seen all time in the S&P, the fastest 10% correction. Okay. On top of that, we talked market breadth, we talked AAIS sentiment, we talked the fear and greed index. All these things have been a little bit overcooked to the downside. So I'll go back and just kind of repeat this. I think it is pretty critical that the market just kind of stabilizes in here. And as we're sitting right below this 200 moving average, I could see the market in kind of an indecision zone. So we've had, a little bit of indecision heading into this correction. Obviously, the correction itself was a pretty decisive move for the market. And now between the Fed, core PCE, the end of the quarter, and tariffs coming in early April, I just remain pretty firm on if this market does not make a massive break lower. I could see a retest. I could see a bear trap. I could see, market breadth pushing into test some lows again. But we're not that far away from having what I think could be, really good kind of bottom picking for the broader market. It may be sector based. It might be a recovery in what has been beat up. So I mean, just take a look at what's been performing well as also performing poorly. Consumer discretionary. If there is a bottom, then look for the overextended move into consumer discretionary. Same thing that I use on the S&P above the 50-day moving average. Look to see how many consumer discretionary stocks are above the 50-day moving average, because that one is like beat down to nearly the bottoms. So if we start to see what is beat up start to have some rotation in, we may continue to see energy do well, healthcare do well, utilities do well, but utilities still has some room to get to the upside. But I would say your beat up stocks, your tech stocks, your consumer discretionary, even the S&Ps. S&P, above the 50-day moving average is, I think, in the 20s. NASDAQ, same type of thing. So it's a good indicator of market breadth. It's been a fantastic timing indicator over the last, 20 years that I've been trading. And I'm going to watch it. So as far as like the pain trade and the big flush out, opportunities are plentiful if you can, kind of time the market that way. So from a technical standpoint, I still like this area. This April low, this August low, I think it's pretty critical that the market doesn't do too much damage below this trend line, right? If we poke it, okay, fine. If we break it, but then get back above it, that is a bear trap. And then I see how this thing recovers. I'm fairly confident that if we don't break these lows, this market's able to get back to about 50+% of this retracement. And then we'll see if the bulls, have what it takes to continue to kind of claw and grind and fight their way back. Now, what has to unfold, info-wise? Market's going to have some semblance of clarity with Trump and tariffs. Right now it's like this Fed event today is probably going to be noisy, maybe a bit of a nothing burger. But what Powell says will be really interesting just to see if price action is aggressive or not. It may be, it may not be. I think that, Powell is speaking mostly to the general public. He's not going to, name names or point fingers at the administration. He pretty much stays out of that stuff. I don't think he's going to call Donald Trump out in particular. I don't think he's necessarily going to mention anything on tariffs outside of, I don't know. He could say the uncertainty, right? But I think Powell's script today, if he wants to provide some stability, and obviously the Fed provides some transparency, it will probably toe the lines of where the economy's at, what labor conditions look like, where inflation looks to be, and then what the Fed's plan is. Also, the dot plot, if that's even mentioned by him, or we just get it in the release at 2 p.m., that's what I want to look for too. So pulling up the headline news when it comes around at 2 p.m., I should have the dot plot posted right in here. So any major headlines, anything from Powell's press conference at 2:30, I should be able to find it right in here. Okay, so we'll see. But all in all, it's always the case, price action is going to lead. So if the market just can't handle it, there's nothing to get optimistic about, then the market may not like this at all. And the market might just come from this little recovery on Friday to Monday. Market comes up here and then just kind of slowly unwinds, gets back to the lows again. We wait until April, and then we're talking, that scenario. Do we break fresh lows? Do we, bottom out, use the support level? Do we rip up post April 2nd? Like I said, I think there's a firm level here around this 55.50 zone, 55.60 zone. I wouldn't be surprised if the market continues to show some hedge flows off of that. And, we've seen volume go down quite a bit. We're still looking at a VIX that is slowly declining. So the VIX is heading slightly lower today with a red candle. If the VIX continues to unravel a little bit, that's good. One thing on the VIX term structure is this is flattening out a little bit more. So we're not that far away from a flatter VIX term structure and possibly heading back into contango, which is usually the case, where we just have, lighter volatility. Market doesn't know that yet. Okay. Lee, what's the question there? How long does it take for an emerging market to eventually regulate? Emerging market meaning what? Meaning Latin America. That's all emerging markets. Most of Europe, I pulled this from a Bloomberg terminal. Let me see if I can find it in here. There. I think I shared this week. There are some ETFs here. You can trade Poland, Austria, There's China large cap, which is FXI. I've been in that one for a couple of years. Greece, Spain, Germany, Colombia, Chile, Italy, Sweden. Those are your best performing ETFs, non-US this year. So you talk about emerging market. I mean, Europe has been underperforming for years. Europe is essentially trading and considered value-wise like an emerging market. China, certainly not an emerging market, but everyone, I think that the way to play China is you rent China, not buy China. And I say that because the trades are good. The trades have good asymmetry. I've done very well with the up move in Baidu. Baba has been like the best one. Baba, so a combo of things. So FXI has done pretty well recently. So I was riding this thing out for the last couple of years. This has been a good run. K-Web is another one. Same thing here. I was riding it out at these lows around these 25 handles. Now we're up to 37. FXI just did that one. This is Alibaba, which started to rip on. It's now considered an AI stock. So what started here as me building positions around this like 75 to 65 area has blossomed some really nice profits when it came to that September rip, a deep retest, and then another huge surge this year where the stock itself has had like a 80+% run. Now Baidu, what I read this week is they had something with AI, and I don't know what the heck just happened, but that quickly got faded, which isn't a terrible thing. But I was looking to roll some Baidu because I have some expirations out to, I think, April. Let me check this really quickly. So Baidu is, I still have some exposure on Baba for another $1,300 to $1,400. That's fine. Baidu is right below that. And this one, I have some shares. I have a April 17 collar with the covered call at $100. I may let this stock go. I own it around $86. If I let it go, I'm letting it go for somewhere around like $14 to $15 per share, which is fine. And then I have a bunch of puts and ratio spreads down below in the 80s, which I think will finish out of the money, which will be income trades. And all in all, this will be fine. So that, like I said, that to me is like, that's my rent. I'm just temporarily taking trades on China. I still think this stock overall has room to run. It just may not be blistering up speed like we had in Alibaba. This might be, up and down and up and down and up and down and up again. But I do think we come back to the September high. So I wouldn't mind if we pull back again. I wouldn't mind looking at some rate spreads and something where I could solidify this low. Anything like less than $80. I think if we hold these levels, anything below $80 with cash secured puts or ratio spreads look pretty good to generate some income. And if price goes up, that's fine. If there is any assignment price, I wouldn't mind taking the assignment based on the current valuations and the discounted cash flow model. I think this still has like $115 to $120 upside. Okay, so let me go back to this. Again, top performing ETFs. I mean, basically, I'm going to cut this thing off and say anything above 15% for the year is doing pretty well. Brazil's up 14.79%. France is up 15%. Finland, Sweden, Italy, Chile, Colombia, Germany, Spain, Greece, China large cap ETF FXI, and then Austria, Poland. Poland, 36.56% out of the gates year to date. I mean, it wasn't on my radar, right? Eurozone was on my radar. DAX was on my radar. Euro stocks on my radar. Okay, FTSE 100 on my radar. The FTSE's not doing too bad. It's up 11.24%. It's crazy. Like it's just, there's a lot of money going back into local economies. So this to me is the picture of the global economy. This is for me the picture of if the US can't do it, it's going back home. And Eurozone looks pretty good. There are some major bills getting passed and voted on. I think there's going to be a pretty like solid, overwhelming approval for these like defense spending and other aspects in the Eurozone, which I think is good. I think it leads to continued flows. I think this is a pretty solid rotation. But again, remember, it's also an index or it's also an ETF. It's not like it's not, I don't know. It's not Palantir, I mean, so an ETF to be up 20 to 30%, that's pretty ridiculous. Argentina has been one of the craziest ETFs for a while. And Argentina, I'm looking for it this year. Argentina is flat for the year. It's up 1.62%. But go to Argentina, which would be ARGT. And from this 2024, let's go to January of 2024. So when we started trading the year, Argentina was around this area, and this thing ripped up into the end of the year. This thing was up 70, almost 80% year to date. So they can certainly rip. but it's not the norm. Like, I'm not sure how many, standard deviations above the expected move was ARGT last year. It doesn't really matter. I would like to see something like this, like another pullback, and we find some support, and then there's some more buying opportunities there. Okay. So there's lots of them. And so, like I said, I'm diversifying a little bit. I've been doing this last year. I had some China exposure. I still have gold, still have silver. I'm in the TLT for 10-year treasuries. I'm in UNG for natural gas. I've got some energy plays, some healthcare plays. Like, that's my way of kind of diversifying, controlling some of the beta risk and controlling some of the volatility in my portfolio. Also, a lot of those are providing really good income on top of hedging and things like that to make sure I play the downside. So, if we just put a pin in this conversation and remember, okay, March 19th, Fed Day, just remember where we're at right now, right? Because this is, I mean, whether this week today is going to be that significant or coming into the end of the year, there's going to be something about this correction that you're going to remember, right? This correction right here is not going to be forgotten. This is how 2025 pretty much felt from the beginning. Once we started to top over, it was struggling. The market just rolled over, and here we are below the 200 moving average. Now, over the next 6 to 9 months to wrap up the entire year, is this market going to be higher? Is this market going to be lower? Nobody knows. In fact, if you want to check the tail of the tape, go ahead and look and see what the market thinks is possible. If you go to SPX and go out to the end of the year, this is the amazing thing about the markets, right? It's not your, investment bank analyst forecast. This is looking to see, what does the market think? Here is the December 31st expiration on the SPX. Right now, this is looking at about a 680 point move. So on the high side, this looks about an extended move around 63.25. And on the low side, an extended move down to about 49.75. Now, this is subject to change. This can shift, but plus or minus right now, based on today and current option prices and current volatility environment, which is pretty high, by the way. An IV rank of 43 is historically high. We're usually seeing these index implied volatility ranks in the teens or 20s. So the good thing is the expected move is oftentimes bigger than the actual move, which means to the downside, if we can stomach the pain of maybe down to 5,000, there's going to be incredible amounts of opportunity to be buying from there for any type of repair. If we don't go too much lower, then on the upside, we rebuild back into the 62 to 6,300 zone. That's also fresh all-time highs. That gets us up to all-time highs again. I think once the market, if and when the market eclipses these highs, it's probably coming with some additional momentum. But I think right now, it wouldn't surprise me if this market from here to here is going to play around with a lot of indecision, right? And if it does, I'm going to have to figure out how to trade it. If it doesn't, I want to be hedged. I want to be diversified, and I want to be, loading up for better opportunities way down here at about that 20% level, which may or may not happen. But that's why I think this current level is so important. This current level and these current lows are really important to see in the near term. Does this market stop the bleeding? Because if it stops the bleeding, there's money to be made on a little recovery. There's ability to de-risk, right? And that de-risking also, and I'm just thinking of institutional money, that de-risking allows institutional money to also allocate to what is performing well. The one thing that most portfolio managers are going to be forced to do this year is not lag other benchmarks, right? Everyone has the S&P benchmark. Well, right now it's garbage. So your S&P benchmark is down. You can't survive on just being tick for tick down with the benchmark, right? There's got to be some type of tactical allocation. There has to be some type of responsibility to investors and try to eliminate the risk. So this is where they're shedding Mag 7. This is where they're dumping growth and momentum. This is where they're going into lower beta and more defense stocks. This is where they're looking to go outside of the U.S. for maybe some growth opportunities. Okay. All right. So a lot of stuff. It's critical. We'll see what happens today for the intraday trading. It has been relatively quiet. I did see a nice couple of wins this morning on SPX, which has been good. And I'll take it. And it's, we're only about 37 minutes away from FOMC. So grabbed a couple of profits this morning. This is today's trading so far. So nothing too crazy. Again, for the high and low, do we get above this high or this low, or is today just a bunch of noise for the day? It could be that. I go into some of my real-time levels. This is SPX potentially lining up a bigger flood down to 5,600 to revisit this low. That is very possible on the day. A couple levels to watch here would be if we come back to 5,600, if we come back to this, I think market makers would still be able to defend that pretty well, right? A lot of times with FOMC, we might see a flush lower, a spike back up, a flush up, and a flush back down, and all it is a monster indecision candle, and that is the tornado effect of FOMC. It goes down, it goes up, it goes up, it goes down, and it just settles. And afterwards, do you get a breakout one way or the other? Okay. What is rare is what we saw back in December, which is the market started to go down and continued to go down, and it just goes from 2 p.m. to 4 p.m. in the same direction. That is very, very rare for FOMC to do that. With the pause today, with the dot plot, I don't think a lot is going to change. So again, I just got to see what price is going to do. But this floor was pretty interesting to watch yesterday. So if we do come down to that level, I wouldn't be surprised in the near term if we actually take a stab like that. So, if we come down and poke, I wouldn't be surprised if we bounce back up. If we go higher, wouldn't be surprised if we fade off these recent highs. I don't know. So that's why I'm pretty much closed up. No daily trades running, no zero DTs today outside of what I did this morning. And that's it. Okay. So we'll see. Let me take some levels on the SPY, see if anything stands out. Right now, SPY levels, I'm still getting a decent one up here towards 573. I noted that this morning. I think there's a strong case for support around 560. So if we bounce at 560 and start to move back up, I think by Friday, if this market is going to come out of FOMC with something positive, you can write this one down, but between 570 and 573, I think that offers a bit of a near-term rally. Now, whether it's this week or next week or by the end of the quarter, I mean, fine. But this is usually about a 5 to 10 day window for me when I look at some of these major liquidity levels. Okay. So that's what I'm watching for. Again, look at the lows. That's a really strong floor. Does it bounce and offer support? If so, a pretty easy trade would be buying a 560 call, selling a 561, or buying a 560 and selling a 565. Try to get something where you have like a 1-for-1, where I could pay 250 to get 250. It might be a slight higher risk. I might have to pay like $3 to get $2, which is okay. It's still a pretty good return if I'm right directionally. Or if you just like this level, go out and try to buy, relatively cheap call option for a 1 to 2 day expiration. If this market does go up to try to tag 573, you could turn probably a call option into maybe a 300 to 500% gain. Not bad. Okay. Somebody should ask me about gold. Surprised nobody's asking about gold yet. That's like 30 comments in the market. Gold. All right. Bunch of gold members in here. We're at 30.33. I still like the trade that I took on gold. I'm long GC, I'm long GLD, but I put in a call condor trade where it looks something like this. Basically, if gold, here's the reason that I think we at least stall for a second. Gold has been running hot. This little breakout's been pretty encouraging. The reason I am standoffish on gold right now and just waiting for a pullback is based on some pretty simple stuff. Here is one of my workspaces for gold.
What's up, Chris? Chris, I laughed out loud to what you just said about gold because at first I thought you were serious. You're like, oh yeah, somebody should ask about gold, and then you're like, nobody's saying it, and I look in the comments, it's just all gold.
Yeah. Okay. So daily time frame, overbought conditions with divergence. Weekly time frame, overbought conditions with divergence. I can't in good measure. On top of that, with a percentage move away from this 200 moving average, I can't in my 25 years of trading, I can't look at this chart and say I want to buy gold right now. So I'm not buying gold right now. I'm waiting for a pullback. This percentage away is significant, and this time away is significant. With it, Nick, this is now like almost 370 bars away from the last test of the 200 moving average. So this is the reason that I was short on the S&P this year. This is the reason I was short Meta, short Costco, short Walmart, short Palantir, short Qs, short everything for that bar count. It's that simple. So I can't really get long on gold other than just holding what I'm currently in, waiting for some type of pullback, and then I'll reestablish more positions. I like gold longer term. I think it's great. But I think in the near term, I just want some income trades and I want to get a pullback and dip. What do you think?
Is that Knoxville divergence?
You know it, dude.
I
Classic.
love Knoxville divergence. Yeah.
Yep. Classic.
That's awesome.
So I'm only interested on that with like daily and weekly charts. It's got to be like a daily, weekly chart. Then I pay attention. The relative strength, the standard relative strength indicator is a 14 period. Knoxville is based on a 21 period. So it's harder to get to overbought, oversold conditions, which is more the reason I like it, because it's harder to get overbought, oversold, which means you get less false tops and bottoms. So I've used it. I mean, you've been around the game for a while too, but it's like, I know you've had that indicator in your kit for a while, as have I probably had it for over 10 years.
The missed pivots are also pretty fun too.
There you go.
Pivots,
way more in Forex than it is in the stock market. Yearly pivots maybe in the stock market, but way less interested in like, daily, weekly, monthlies. But Forex, absolutely, like great stuff in the structure trading here.
So Chris, I'll share my thoughts on gold too, just because I have kind of a different. I'm bullish on it, but not at these levels. So just like yourself, like you're talking about, like, okay, long term, still love gold. I think I've pulled up the monthly chart, and I think this is like keeping it so simple, but keeping it so, simple in a good way too. If we take a look, actually, no, I meant to do the 12-month chart, the yearly chart for gold. When it does its thing for multiple years in a row. But even within these big moves, like here's the 2001, the fallout that happened in 2001, gold was just this wonderful thing for the next, well, really 12 years, even through the financial crisis. There was that safe haven, big sell-off on gold as things kind of found their footing again. And then I think that you've entered kind of into this acceleration phase where we might see gold kind of just run away for a little bit, as it already has been doing. That being said, I mean, for me, it's been constructively bullish on pullbacks, but chasing this thing is dangerous too, right? There's a lot of people out there who are, they look at gold and they see it going up every day, and it's easy to chase it. But there's equally a lot of people who are trying to short this thing, and I think that that's really hard to do too. I think that the what you discussed, waiting for proper pullbacks, is in my opinion, the best way to approach it, because this thing metals might be in a secular uptrend for the next, 5 years. We've had a great start. The last 2020 kicked off a really good environment for metals. Global mass money printing by central banks everywhere. I mean, it's a good theme for gold to keep going. It doesn't mean, however, that it can't have a couple or pullbacks within good upward moves. We've had a really good stretch for gold. For me, the way I'm playing it is I'm just trailing stops. I'm just letting it run. If it breaks down, I'm done. But I took this trade here. It was pretty aggressive on the entry, but I put the stop just below, and you got to know when you're going to get out. Like, that's the thing, is if you're gonna trade something with momentum, the thing about momentum, when it's moving like that, you've got to find your way out of the trade quickly if it's not working. And then if you're talking more value, talking more wait for a proper pullback, like you've mentioned, Chris, I think, you get your 200-day moving average out and you say, look, this thing is due for a bigger pullback. It might be tomorrow. It might be 3 weeks from now. It's due for one, just like the S&P 500. I mean, Chris, you and I ranted on that for so long, and then look how quick it actually just happened.
Yep. Type in, you got the screen here, type in Netflix, type in Meta.
Yeah.
Look at
Meta too. Meta's close to that 200.
It is close. I mean, it's right there. So, I'm not even interested in Meta until that thing is hit. And honestly, if it slides a little bit lower, I think the safe thing on Meta would be just draw a trend line and look for some type of like really obvious bullish pattern. You could have a cup and handle pattern forming off those lows. You can have like the, close below, close above. Very simple stuff to start establishing positions as opposed to catching a falling knife. Nick, yesterday I did put on a trade, TGT, Target. Another one that's just been absolutely obliterated. I put on a trade to the end of the year. It's mostly an income trade. Let me see. I posted it in Pulver Alerts, but I wouldn't take any type of real heat on this trade unless price is down here towards, I think $80. Let me double check. It's either an 85 by 80 or an 80 by 75, but it is right here. I did, 80 by 75. So I collected $1.74 on the trade, and it's an income trade. So right now, if we just stay above $80, I make $1.74. If we come back down all the way down to 80, 79, 78, 77, 76, 75, I could make potentially $674 per contract. I wouldn't take any assignment unless we're at $75. Now, $75 on target, which, correct me if I'm wrong, Nick, but look, I know it's not Costco. I know it's not Amazon. I know it's not Walmart, but it's a pretty big retailer that is a good sign of the current consumer. I don't know what is happening here with Target to be so crappy. I get it during COVID where they had like all these inventory issues, but it's down 61%. And I don't understand why necessarily when the fair market value is around $175. So I'm trying to take advantage of where the current applied volatility is, the uncertainty is, and I really don't think I'm gonna have to have much of an assignment risk. The trade automatically started out when I took it yesterday to 91% probability to profit. I'm happy to own the shares, and if I own the shares at like $73, or no, actually cheaper than that, it'd be like $68. $68 ownership. I would own some shares of Target at 75% off. So could it go down to 80, 90%? It could it be, the worst stock ever? And it's like, oh my God, now it's like JCPenney. I don't think Target's going to be that retailer, in my opinion. So there are opportunities like this, and this is what I'm doing. If I can find trades like this, I'm looking for income. Tesla, what are your thoughts on Tesla? Are you actually liking Tesla because of this giant decline? Are you getting a little more attracted to it? I heard you say something like that this morning before we teamed up.
Yeah, it's my most controversial idea, but I like Tesla. I mean, I've liked it for a long time. I think but it's just why it's so controversial is if you look at a PE ratio, it looks stupid.
Doge is why it's controversial. It's overvalued, and Doge is, I mean, the sentiment on Tesla is garbage right now.
Yeah, well, and it's hated, and it's in the news, and it's. I mean, I've been picking up some shares recently. I think that put your like him or not, Elon Musk political side to the side. I think that the technologies that they're working on are pretty incredible. The vehicles are incredible, the EVs, and the thing is, nobody's disputing that. You know why? Because the PE ratio says that nobody's disputing that there's some incredible technologies that they're building. But what I really like is that I think that stuff, there's this phenomenon of markets that I kind of subscribe to, which is just like people kind of overestimate implied volatility, like you were discussing earlier with like market expected moves. A lot of times, like technologies and game changers like AI, people overestimate. This is, this very well, I'm sure. People overestimate the potential impacts of new technologies in the short run and underestimate them in the long term. I think that, autonomous driving, I think that
quantum
robotics,
computing.
Yeah. I mean, if Tesla puts into factories, robots that replace workers, I mean, I hate that. It sounds eerie and sounds like the end of the times, but if that's a profitable way for businesses to cut out some monotonous, repeatable tasks and put in fact, robotics instead, like that stuff, I buy the story. I think long-term, it's a cool stock to own. It's high risk though. Like you have to know, you put that in a portfolio, it could go to 0 or it could 10x.
Yeah. And that's why, there never, ever should be, look, there's a few ways to diversify, right? You can trade your way through anything. If you're diversified, meaning like, rather than having like, okay, there's one thing that I trade. I don't like it. I mean, if you obviously see my screen, almost every single day, there's a lot of stuff that I trade.
We trade
and
everything.
I think that's why it's like I trade everything because I just want this to be a calculated risk. It's just a trade. If it works, it works. If it doesn't, it doesn't. Move on, trade through it. You can diversify that way. Also, if you like Tesla that much and you're going to allocate a decent amount to it or whatever you want to it, you can trade options around own positions to at least protect yourself to the downside. So a simple collar trade has helped so much this year because having some shares in here and buying a put, selling a call has actually helped me lower my cost basis.
Yes.
So I'm not that far off from like current break evens around like $300 for me. And if I take on another chunk of shares, I'm going to own this around like 247. And I'm going to go ahead and do like a quick repair of this and just try to turn it into income. I've got some more out here through April that I want to see if I can survive above this 250, 255 level. But I'm okay. Like, again, this is one stock. It's expensive enough that it's like, I don't want to own hundreds and hundreds of shares of Tesla. I think having, per account, 100 shares is the most exposure. There's plenty of volatility in this. The nice thing is if I get a break even somewhere down here, Nick, and this thing goes up, that's 100% get to the upside or more.
Oh yeah.
Right. So I mean, the enticement is you double your investment.
Just your point with Tesla specifically is, you and I have talked about this a little bit in the past, but like I've taken out that the volatility. I like the stock. I like the company. I like the potential, but this and Robinhood, I've also got pulled up. These are the two stocks in my portfolio that I don't mind taking ownership in,
but I like to hedge their absolutely high volatility by selling calls and just taking out a little bit of the risk. I mean, I sold calls, even though, so I own Tesla from way back here. I've owned it off and on since 2020. Made a really great return on the way up. Closed out of it. Bought back in. I mean, I've done really well with the stock over the years. And what I'm also looking for is, I talked about it with you over here. When this thing cratered, at least I was selling calls on the way down, and I cushioned a little bit of it. Now I still
Sure.
gave back a ton of gains on the stock. Don't get me wrong, but I sold puts. I've gotten assigned. I got into some of those shares down in these lows, and I sold calls on the way down. So I'm cushioning it a little bit. So there are ways to still be involved with your favorite stocks if they're super high risk by at least using options. That's the beauty of options in general, is you can kind of mix and match and build things. Chris, I want to get back on schedule here. We got about 20 minutes before the Fed meeting or the dot plot that comes out. I want to get your thoughts just about, as we get closer, dot plot. If it comes in that, I guess, what are you looking for? What is the biggest thing that you'd be looking for in a dot plot today? Are you looking for signs that the Fed is going to cut less or more? Do you have an opinion about which way it goes, or are you just strictly going to watch to see what it says?
I think at this point it's you got to be a spectator. I mean, right now I'll just talk technicals. I mean, if the market is going to have, honestly, the most important thing for me is price action today. If the market can defend, like yesterday was a really very eerily like support day, right? The Qs found support right around 472. The SPY found support right around 560. SPX found a floor of 5,600. I mean, again, doesn't mean anything, but to me, this would be the important level for the bulls to stay, hey, we're still in this fight as long as the bulls don't get beat up below that. So if we're up on the day and we're oscillating here, could we come back down initially and then rally from there? I mean, structurally, that makes a lot of sense. The dot plot, I don't really know what's going to change. I did pull this interesting data point. This does make me a little bit nervous, to be honest. This is the 2-year Treasury constant maturity rate, which is actually the market setting the rate versus the Fed. And then in the purple line you see here, this is my, I'm trying to think here, in blue, yeah, this is the constant maturity rate. And then in the purple overlay is the Fed funds rate. So right now, Fed funds rate is sitting at that, 4.25 to 5%, or 4.25 to 4.5. So it's effectively 4.33. Now, this 2-year Treasury constant maturity is below. And any times that we've seen the blue line, which is your Fed rate, or I'm sorry, you see the Fed rate above the other rate, like the Fed usually has to play some catch up. So I say that because right here during the Great Financial Crisis, let's go back. This is a long ways back here. But what happened during 0809? You have the Fed funds rate above the 2-year maturity rate. Okay. And that led to, I'm not saying this is what led to it, but something about this chart has called some of the biggest corrections and crises in the market. Same thing that happened in here. This would have been, major flush down in 07. Same thing happened here with all this, play out. And then finally we had to kind of bottom out and fight our way back through 2009 after all the drama. Now we get into the same thing through 2020. Look at when this happened, Nick. This thing crossed over here in March of 2019, going into the end of 2019 into 2020. We said COVID happened, but what actually was the case here? We just had the crossover that just kind of led to, I mean, I don't know where you position end of 2019, but I was bearish going into the end of 2019 into 2020. COVID had nothing to do with it, right? COVID was
sitting
the
on
excuse
so
the
much
market took.
cash. I was sitting on a lot of cash at that time. I got a little bit of luck, a little bit of skill, but 2020 was pretty phenomenal for me because I ended up, that's where I got long Tesla.
There you go. Well, just wait for Tesla then. But my point is, this has called some pretty big levels. So do we have another crossover, right? Look what happened here in 2022. Okay, another crossover, and right now we're kind of sitting in the same level. So if this the official Fed funds rate is above, which it is right here, I mean, we almost want to see that this kind of stays in limbo together and doesn't get too divergent because that probably doesn't yield good things. Also, did you notice that the 10 and the 2 year versus the 10 and the 3 month, like the 10 and the 3 month, I think reinverted briefly.
Yeah.
Let me see if I can find that here. 10 and yeah, so this is the 10 and the 2 year still remains above the 0 line. The 10 and the 3 month is back to a inverted curve again, which I thought was interesting. We talked about that last year on this big steepening. This is another thing that also resembles the labor market. If this is going down, that is typically a good thing that correlates with stronger or resilient labor markets. What we don't want to see is this thing heading higher. We don't want to see this thing heading higher. So again, like market stability for the job front, if this heads back down, that's probably a good sign for the economy and showing that we still have a fairly tight labor market, despite what we think is happening with the federal government right now, which again, nobody knows, man. I mean, I believe that in this market there is such a thing as a Fed put, and there is such a thing as a Trump put. Trump may not be saying much about the markets right now because he shouldn't. If they want this correction, they want the dollar lower, they want yields to drop, they want the markets to drop, they want this asset bubble to be dissolved a little bit or let the air out. They got it, right? But I think Trump's approval and risk of recession are significantly higher if we're way down below 5,500.
I agree.
So
I think
this
that
floor is important.
There's the debate of, is there a Trump put, is there a Fed put, all this. I think that there is, like you're saying, for both. I think the way that I've heard it explained well is that the Trump put is a little out of the money right now. That's basically what you're like you're just saying. It's there. It's just you might need a little bit more pain before it really triggers, and he will act like he doesn't care about it, because again, at the end of the day, why would you act like you care about it now when you could just kind of put that on the previous administration if you wanted to?
Exactly.
Just say, oh, hey, well,
we've got to fix it.
Yeah,
we got to fix it. Look what they did. They ran the worst government ever, blah, blah, blah. He speaks in hyperbole and superlatives.
I would do the same thing if I was president, right?
He has free reign to pretty much do and say what he needs because he can blame everybody else. Nothing about right now that's bad Trump's never going to take ownership of anything other than if anything good happens, it's all because of Trump. If anything bad happens,
there is
the
that
previous administration.
Yeah, there is that possibility that, like you said, it flushes things out and maybe the clouds roll away. I actually think that, my opinion on it is how we're going to go into big old fat recession. And I actually really take the other side to that. I don't think that, even if you are not the biggest fan of tariffs or things like that, I don't necessarily think that the jump to, massive spike in recession likelihood is a fair conclusion. I think that that's a little bit dangerous to make. I also, we've been updating this new heat map that we've been working on, and I want to show you this really quick because the stocks impact section is pretty cool, because what you can see here is that the stocks impact basically looks at GDP, manufacturing PMIs, retail sales, inflation data, wage growth, all of our stats. And it says, here's the US dollar impact on each of these things and summarized, and here's stocks impact. Now, the dollar looks weak to me. Pretty solid, because this makes good sense. Why? Well, inflation was cool and jobs data has been a little bit lackluster. It's not been as strong. Wage growth is down a little bit. We can point to a lot of things and say, yeah, the dollar is weak for good reason, but inflation cooling is good for stocks. And doesn't mean that we're out of the woods with inflation, but it's been a little bit better than expected. So while the market, this is the discrepancy, right? This is the implied volatility versus actual volatility. I think that the headlines and the market is like, oh my gosh, recession. And the data right now does not truly support that. Could it change? Of course it could change. And you might say, well, the market's forward looking, but oftentimes the market is jumping the gun, right? It's a little too ambitious. So my opinion on this right now is that stocks, even if you think that they're going lower, I think that the sentiment extremes that you were discussing earlier, I mean, we can look at tonight we get the latest AAII investor sentiment. Sentiment is really extreme, right? So this is my biggest kind of my strongest point right now is put to call ratio was extreme. It's kind of dialed it back a little bit. Investor sentiment, really extreme. I think this is the highest level of bearishness we've had since 2008. So even if you are thinking constructively this year, we could find a new low. I think that a short-term bottom is a pretty fair idea. The other thing, the last point I'll say about this, and I was talking about this just before you jumped on, Chris, I wanted to get your thoughts on this. The market loves to do this gotcha stuff. April 2nd is the big doomsday for a lot of people. Oh my gosh, that's the day all the tariffs are going to come out of the sky.
Right.
And everybody is, many people, I am so sure that there's so many people out there who are buying puts April 2nd. That's going to be doomsday. And maybe it is, but the market loves to play gotcha. The market loves to, set it up like this, like that's the day, that's doomsday, and then bottom well before then. So I would not be surprised if we put in, even if it's just a short term, even if it's like a month long or 3 weeks or 2 weeks, I wouldn't be surprised if we bottom out before then, because these other, this was what I was saying just before you joined, was these other economies are more hurt by tariffs than the US. Canada and Mexico, those tariffs hurt them disproportionately. There's a possibility that between now and then, while everybody is so scared of these dates, there's some negotiations that short-term cause the market to sigh a breath of relief, and we see something like this. So I just think that that's a high probability trade right now, especially if we can get some constructive breakouts here, like you were talking about earlier. Look for some price action to form here, a little bit of higher lows. That's my thoughts. I think sentiment's stretched. I think market data on the fundamental side does not support massive recession, so I don't think we should jump the gun. And I think April 2nd is a bit of a fluke. That's my opinion on it.
Yeah, I agree. I think it's, it's very typical what the market does. I mean, when you get extreme sentiment readings, as I said, sentiment is not an actual signal. But man, when you line up the timing of like the market breadth hitting those extremes where, everything's oversold. And I mean, we hit, I don't know what the exact alignment was, but the S&P and the NASDAQ and the Dow and the Russell all in oversold conditions. That doesn't happen very often. And they all hit around that Thursday low last week.
Yeah.
And they were all, this is RSI 14 period. So they're all under the 30 level. And again, that doesn't mean that the market has to bottom from there, but it does mean that typically we see at that area, the market's paying attention for some type of divergent bottom. If we go a little bit lower, there's typically like a lack of momentum. And if price and momentum disagree, there's your divergence. The market can recover a little bit. And noting the extremes like the AI sentiment and the fear and greed index, it's like extreme fear and extreme concern is usually a fade, and because most investors like that they go and buy record puts and they're just running for the hills, they usually end up losing. And but I still think in the near term, if you're just going, ham on buying calls, or you're going ham on bullishness right now, I'm not there yet, dude. I am still defensively bullish or cautiously bullish, but I'm like just to the level you just pointed out, near term cautiously bullish.
Well, and that's the thing is, I think you can be, even if you're bearish, even if you're bullish, I think using a level of caution is where you survive right now. Where I think a lot of people they're gonna die and lose their shirts is the same people who were ripping into their savings to buy Palantir when it was at the highs. Those are the same people who are now throwing all their money in puts that are dated 1 week out and trying to save their account from like that you're going to learn a hard lesson. And that's how the markets work. They punish that, impulsive, it's happening, we're shorting now because the market's going to drop like crazy. Like that impulsiveness gets absolutely snuffed out of the market. And I think that even if you're a bear, right? Even if you think, oh, I think this thing is not done, maybe just be cautious, let off the gas when everybody is rushing for puts. And then, if you're going to get bullish, wait for some signs, wait for some bottoming patterns to form. Just be constructive and patient. And as you said, our favorite expression, cautiously bullish, be open to the idea. We might have some downside. We can go by test those lows. Don't go all in, basically.
Yeah, no, I agree. There are some key levels that I have, and I'm paying attention to. This would be 560. This is for this week. So we're trading at 563. This one expires on Friday. I need to watch that one pretty carefully. So I've got a SPY trade. This is a big one. And also I've done a bit of trading on XSP over the last couple of months, which is the mini version of the SPX. If this stays greater than these are two levels. I need this to be above 550. And I'd love for it to be where it is right now, greater than 560. If we stay there, I have about 13 positions running that are all going to be closing for profit in the next couple of weeks. So if we get a little relief rally, this is where I'm taking some profit, de-risking. Let's see where the bulls and bears want to fight it out and how much fun it's going to be. one thing that could also surprise the market is after this type of flush, we might not see a return of volatility like that at all, Nick. This might be
Yeah.
like the peak in volatility for a while. So unless it's going to turn into a 2022 where the market is down, the market is up, the market's down. I mean, 2022 was a legitimate deleveraging, right? We
Yes.
bazookaed the economy with tons of money printing, and then tech was overvalued. We hit kind of bubbly territories, and the deleveraging was very real. I'm not going to say that was a systemic risk or anything, because it wasn't a recession. We kind of had like this rolling recession. It was a weird and challenging market because there was no real safe haven unless you hit out in currencies and you were long the dollar, weak the yen in FX, or you were somehow just because bonds were garbage. Bonds were down,
Yeah.
stocks were down. Every
Well,
sector was trash in 2022 until we got out of
2022 was a
Q4.
classic. It was a classic inflation fear bear market. I mean, take a look. If we
Yeah.
can switch over to my screen for just a
Yeah, yeah.
second. Beautiful, very. I mean, that was your standard in many ways standard bear market. About a 2-year period where you really had some struggle in the market. What was not so standard, like you're pointing out, was bonds weren't a safe haven. There's no safe haven. But for an
Right.
inflation, what was a safe haven? Well, a lot of commodities did okay, as you mentioned, the dollar
First half.
index. Yeah,
Because that was
right.
the only reason I had resiliency because of commodities in Q1. I made
Right.
I made a ton in Q1, and then currencies pretty much saved me for the year to be positive for the year. But everything
that's the
turned
thing.
hard. Like
That's the thing
commodities
too,
turned
Chris.
hard,
Is
inflation turned hard.
I think if we do enter into this super terrified recession, it's
Mhm.
going to be different than what people experience in 2022. And you and I
will
know
be.
that, but new people, it's unlikely, at least right now, the way I see it, it's unlikely that it's going to be a massive inflation fear sell-off. And
Right.
and if it happens, it'd be more likely a growth scare. In 2018,
Correct.
that was
Stagflation.
a growth fear, right? The
Yep.
the 2018, 21% off on the S&P, that was not inflation about tariffs. It was growth, because growth fears. And so that's the thing is I see more risks to growth personally than I do to inflation at this time. So we'll see. Maybe that's right or wrong. It's hard to say. But for me personally, I mean, these short-term bounces that we're seeing, just be careful with this extreme sentiment. When everybody gets bearish, just be cautious. You can still be cautiously bearish or cautiously bullish. There's just a difference between being outright gun-ho bullish or gun-ho bearish.
Just for fun, I'm going to see something. Let me run this really quickly. I'm going to go to, I'm going to try to go back 11 years. And anytime the VIX is over, all I'm going to do is sell a put. I'm just going to sell a put at let's do a 30 delta put, which is pretty wide, by the way, but like a 30 delta put, if all I did was go out, let's say, I don't know, man, let's go out 60 days. And I'm going to make this based on let's do this daily. I can trade this anytime. It doesn't happen very often, but I'm going to go after 50% take profit. Actually, fudge it. Let's go 75%. And I'm going to use the VIX exit. So I want to go for entry conditions, use VIX. So I want minimum VIX to be above 25. You know how many times it's going to filter out the market? If the VIX has to be of 25 for me to even take this trade, we're only talking maybe taking this trade like 10 to 20% of the time over 11 years. It's so rare, but the probability of profit on this trade is probably extremely high. And the odds of getting assigned, I'd say extremely low, but we'll find out. Let's find out. So I'm going to say the minimum of VIX is 25. All I'm going to do is do a cash secured put with a 30 delta, go out 60 days. All I'm looking for is we're at 30. If the market goes up, you can kind of time this out within 45 to 60 days. I'll play around with it, but I'm pretty sure this is going to be a pretty good equity curve. I'll even take into consideration the commission. So you're paying in for an option trade, and let's run this and see what it does. It's not a terribly difficult trade. See if this will run. So SPY, sell put 30 delta, 60 days expiration. I don't need to use exact DTE. Minimum VIX 25, 75. All right, let's see if this works. Son of a bee. All right. I'll do it. I'll do it. We'll talk about it tomorrow. I'm curious because my point is on the VIX
I'm
was
curious too.
when the VIX is at 25 or 30, it is a mean reverting instrument. I mentioned this morning, the term structure. This is flattening out. This is really important to see because literally last week, this was in backwardation, which means short-term volatility is crazy high. And it looks like it's going to take time until it starts to look like longer term uncertainty is what people should focus on. But instead, everyone's focused on right now, so much uncertainty. So I know we have 1 or 2 minutes before FOMC.
Yep, I was just going to
but
say
this flattening is a good
the
thing.
I've got the
Go
all
ahead.
markets ready. If you want to try
Let's
and
do
just
it, man.
pull up
Grab
on
your
your
screen.
end
Yep.
the financial juice, just keep an eye
Yep, I
on
got it.
what we've got. So guys,
I
we've
got
got the dot plot coming out. The news will be dropping here in the next minute. Just a quick reminder, we've got about 40 seconds. First of all, please be careful. Don't gamble. Second of all, with this dot plot, we're looking to see what the Fed's projections going forward are likely to be. But please understand, market price action is likely to be very noisy in the next hour. This data will drop now, and then in 30 minutes, we'll have the press conference with Jerome Powell. There is likely to be big reversals, all spikes in different directions for the next hour or so. We'll see if there's any initial movements here in the next few minutes. Sometimes there is, sometimes there's not. We'll go to our breaking news coming in just about 10 seconds, guys.
Let's do it.
All right, I got gold, NAS, S&P, just so we can see a price reaction here as the data drops. Initial movement here, a little bit mixed. No.
Yep. I'm seeing SPY go up a little bit initially, right out of the gates. 562 up 2 points already. I'm looking for anything dot plot, looking for any headlines, anything flashing red on my screen. But initial reaction is markets up slightly.
Gold also slightly higher, 30.36, by the way. Wow. NASDAQ slightly higher, S&P slightly higher. Dollar initial reaction is lower. But again, like I said, guys, just be careful with, this could be way back here, could be way up here. It can move like crazy. So just
watch SPY 560 and SPY 572. I'm looking at basically the 560 to 572 window as that's my market maker range that I'd be looking to see if price can touch them and tag them, but usually not necessarily close above or below.
Yep. And a lot of this stuff here, guys, is obviously going to be a lot of algo trading, just reading data that's coming in and placing instantaneous high frequency trades. So that's where a lot of the noise comes from, is because it's still digesting everything. It's trying to price it all out. So just understand volatility is likely to be higher. Chris, you got anything on financial juice yet?
All I'm seeing here, interest rate decision actual 4.5. That's what we knew was going to happen. It's going to be the pause. Median rate forecast for next year, actual 3.37, forecast 3.37. That's on par. The next 2 years, actual 3.12, forecast 3.12. That's on par. So pretty much exactly how the market expected the Fed to deliver today. So far, so good. That's just hitting expectations. Long run, 3%, forecast 3.12. So longer run, that looks like maybe another chunk of cutting rates, but I don't know what long run means. Maybe that's 2026. Because if I look at the dot plot on my screenshots from this morning, the dot plot that I see goes out to 2027 and then longer run. So I'm just assuming that's out to 2028.
Mm-hmm.
And the Fed has those, most of those dots sitting around 3%, between 3 and 3.2% roughly. But I want to get a picture of the current dot plot, which I'm not seeing it yet. As expected, here we go. I got the new dot plot, Nick. Yep.
All right.
So we've got most of 2025 sitting at, it's the same thing, dude, sitting around like 3.8, 3.85. I'll take a screenshot of that.
Yeah, there you go.
Yep.
So dot plot coming in pretty in line with what we previously had.
Correct. Right here was the previous. Here's the current. It's the same. Like this is what I'm watching for 2025. This is just below the 4% line. And this will all be on the CME watch tool as well. But if you go here for 2025, it is just below the 4% line. Now, the one thing I want to look at for this recent dot plot is, I guess we have some that they're right. The majority is sitting right below 4%. There's still some, I dare you say, dissenters that are just above that. So that would be essentially saying we're going to hold. We should hold.
I've got the 10-year yield pulled up on my screen here just to get a bond market reaction of this. You can see it's really, as you're pointing out, not a big shift in any direction. What we'd be looking at, this is a great kind of square way to look at the bond market's expectations of Fed interest rate cuts or hikes. You can see we are just on the day, just printing this kind of ugly doji candle, not any sort of decisive one way or the other. But again, it is still early.
please understand that when Powell takes the stand, he's the chairman, so he might say something that's a little bit more hawkish or dovish that could get this market moving. But as you pointed out, Chris, dot plot looks relatively unchanged, and that's mostly how these things go, right, Chris? I mean, most of the time the market kind of prices it out, and it doesn't really give you anything too crazy to work with.
Yeah, and same thing I'm seeing here. Officials median view for the end of 2025, 3.9%, previous 3.9%. So it's right in line with what the print was pre-FOMC. Longer run 3%, previous was 3%. Forecast shows the GDP of 2025 at 1.7 versus 2.1 in December. So that's a slight revision lower, which is still way different than what that, what was it, Fed Now or GDP Now from the Atlanta Fed that like squashed it into like negative 2% GDP growth.
Yeah.
So that's more in line with like what I think a lot of people expected, which would be somewhere between like 1.5 to 2.5% GDP end of year. Let's see here. Omits language about Fed's goals.
Gold holding its gains. I mean, just kind of sitting here at consolidation at the highs. So dollar index just a little bit lower, not nothing crazy. I mean, this is a pretty good 4-hour reversal. That's the biggest move I've seen so far. Is just a reaction out of the dollar.
Yeah.
VIX continues to kind of be lower here today. S&P 500, not too much of a change since before the dot plot released. Silver down 1.2%. Let's see, Bitcoin up 1.7 on the day. Nothing too crazy there. Bonds flat on the day now. We're negative now just flat.
Okay.
Interesting stuff.
Is it though? There's not really much. There's not a lot of movement considering it's always a wait and see, right? But it's pretty lackluster for right now. I'm reading a lot of the similar stuff. Fed to slow balance sheet runoff starting April 1st. Median forecast shows a 50 basis point rate cut in 2025. That's what the dot plot shows as well. Again, Powell coming up at 2:30. We'll see if there's any follow through with his comments, or not even follow through, more like lack of direction, which we're seeing now. Is there any direction coming out of Powell today? Like I said, watch that 560 low on SPY. Watch that 570 to 572 level on SPY. I can see intraday we fill today's gap. Perhaps that 560 floor was sitting all day yesterday. Literally, Nick, since like 10 a.m. Eastern time yesterday into the close, we just held that 560 SPY. So
yep,
if we just sit there and like, I think that floor is going to be important. I would look short term going into what may be uncertainty through, end of, I don't know. I think that the end of the month, we kind of priced in a really terrible slide. The market's been battered and bruised. The put volume, and like you mentioned, the put volume being extreme, the AAI sentiment being extreme, all these typically like bullish indicators, at least for a near-term recovery, are in play. And I'm curious if like Powell kind of starts, or even post FOMC today, the market just kind of starts this little bit of relief, because I don't think Powell's going to say anything that's going to, I don't think he is, but I don't think Powell's the type of guy that's going to go tit for tat and say, what is happening with tariffs, the uncertainty, and I don't know what the administration is doing. It's like, he's not going to call out Trump. He's just going to say his thing. It's probably going to be very scripted. And everything we're seeing is right in line with what they already forecasted. So I think until data is needed to have the Fed react to something, they're probably just going to stay the course, because if they don't touch anything, they will see where inflation goes over the next, we got PC at the end of the month. We go into the new CPI data for April. Seasonality wise, historically speaking, April and May are typically good times in the market for rallies. April, May through, April, May, June is pretty good. If the market has any type of sustained rally, we might even rally from April into July or August. I'm a bit more concerned with end of the year, though, depending on what we look like September to December. I don't know, man. We could be at all-time highs, or we could be at the same freaking spot we're at right now. Nobody knows.
Guys, just wanted to reference something. Somebody asked if anybody got liquidated in the chat today. Let me just say this. If you got liquidated and the market hasn't even moved, please be careful. Like, there's nothing happened. Like, we barely moved. Nothing really moved. So just be careful out there. A lot of people really gamble on these events. So please, if you're setting aside some money to lose and gamble and have fun, I prefer roulette or
this is right around the corner. You
blackjack.
can do it there.
Yeah, I mean, it's more fun at the casino if you're just going to gamble, but be careful out there. Also, just taking a look here in terms of updated market reaction, NASDAQ, like I said, really unchanged, but there is something I want to ask about, Chris, or think about here with you, which is the last time Powell was asked about tariffs, he used the big bad word transitory. Well, he didn't really use the word, but he was asked about tariffs. He was asked, do you think that will, and this is the economic debate right now.
about tariffs. Do they cause hikes in prices? 100%. Nobody even disputes that. That is economics 101. You add a tariff, it gets passed on the consumer. That's not the question. The question is, and this was poised to Powell, and I thought his response was interesting. The question was, okay, tariffs happen. Is that a type of inflation that we get this kind of bump and it's a one-time? Or is it more of a bump and it continues to compound and we cause inflation?
Right.
And Powell, given that opportunity in his recent, I forgot the name of the gentleman who was interviewing him, pointed more towards the transitory one-time price increase. We'll see if he's right. There's a debate on this. That's the economics debate right now for tariffs, is whether or not it causes a suspended kind of a ricochet effect, right? A waterfall effect on inflation. Oh,
Yep.
more inflation because supply disruption, all this. Or is it more like okay, everything kind of gets repriced once and then we kind of stick there? And I don't know. I think that's just something I'm curious to see if in this upcoming press conference, that is for me personally, what I would look for most. Does he double down on this theory where he sees basically a more dovish concept of like, we don't need to do a whole bunch of adjusting, like the market's just going to adjust accordingly? Or does he take the more hawkish thing and he says, I don't want to repeat my transitory mistakes last time? And
Well, he's not going to say that. He'll just leave out the word transitory.
Yeah, just use a new word.
He'll never admit that they was. I mean, the Fed won't admit they're wrong.
Right,
Trump won't admit
he's
wrong.
I think he forgot that word on purpose.
Yeah, you just omit that word, and yeah. But I think the uncertainty is right now. It's not so much like the tariff number, but it's more the retaliation. Because how is Trump negotiating? 25% to Canada and Mexico, and Canada says we're going to do 25%, and then the U.S. is like we'll do 100%, and then Canada's like all right, whatever, dude. And then it's like, and then they back off. It's like the amount that Trump is just willing to swing and say, you want to play? You want to play? Like sit down at the table, let's play. And it's like, fine, 200% on champagne, 100%. It's like just like egregious numbers that are really not realistic. But it's like he's not bluffing when it comes to if this is his MO and this is the administration that is right now the majority Republicans. They have the ability. I mean, the one thing that is fortunate right now for the Democrats is that they avoided a government shutdown, because the ability for the Republicans to pass things through with a government shutdown would be dramatically higher. So there's at least some, it's minor, but there's some form of friction or gridlock with just having at least not a government shutdown. You averted it. I know Schumer got a bunch of flack for it, but still, this current administration can just play hardball, and that's what everyone is wondering, like, how outlandish do the numbers get? I mean, are we really talking 100% tariffs on China and BRICS countries? Maybe, maybe not.
Yeah.
Is it realistic?
It's an interesting,
I don't know.
It's an interesting concept to watch. I mean, that's why the markets are so volatile right now. There's a lot of question marks around what you've accurately described there. Is like, are they going to cave into U.S. kind of pressures, or are they going to not back down? And I kind of think that there's going to be a middle ground. I think negotiations. I feel like I got to be optimistic about it and say I think there's probably going to. Hey, we need each other. Like, let's shake hands and let's pop a bottle of champagne.
Frenemies, frenemy. Yeah, let here on us. We'll buy the 200% bottle of champagne.
Exactly. Anyways, just an updated reaction, guys. We got dollar index a little bit lower. Nasdaq's up 1% now, so we did get a little bit of movement here. Nothing too crazy, but I mean, this is just kind of recapturing where we left off here. Bitcoin up 2.3. Jumped up to 85K and now giving back a little bit of those gains. Bonds jumping here a little bit. Euro up a little bit. Pound up a little. Dollar yen. Look at dollar yen strength coming in here on this. So you're getting some movements. It's not ginormous, but again, as we always say with these events, you really want to stick around for that 2:30 meeting. That is where things get sometimes interesting. Chris, I'll never forget. I mean, that meeting that we had back in December last year, where we were sitting here and we were both kind of like, we'll see. And then all of a sudden he just came out with just a super hawkish. I forgot what he said. There was something super hawkish that Powell said. And, I know what it was. He basically signaled a hold.
He just called tariffs. He just said hold. And like the fact that tariffs create so much uncertainty. I mean, he went like, it felt like very much off script in December.
Yeah.
And I don't know what that purpose was. But it was not a typical Powell press conference. It felt like he really took the Q&A and was like, fudge it, let's wing it. And he didn't, obviously, but like he was prepared for those type of questions. And he got into a little bit of the political side, which is usually not his style.
And I mean, that was a day where we saw NAS, the range on that day was 4.7%. I mean, that was an ugly day. So,
Yep.
I mean, granted, we just went chopped sideways from there and then tested all-time highs, and then we really tanked. So, you know, you have that potential. Most of the time, you do not get those kind of moves, but that's why we do these things. Is sometimes you do, and you want to kind of hang on the edge of your seat for every word to see what's going to happen. But every once in a while, you get a smoke show, and most of the time, you kind of just get a whatever. So we'll see, but not too, and just to say this too, Chris, I think this is also worth adding to our list of repeated items for these types of events, is that if nothing happens, I'm going to go ahead and lean towards that's bullish. So if nothing happens and it's just a risk event is now behind us, the market will say like, okay, we're good. Whereas people who are probably watching this market, if nothing happens, but they sold a bunch of their shares before because they were like, let me just get out of stuff before this event, they buy them back. That's why that happens, right? That's the idea. Although in the bear market times in 2022 is kind of the opposite. You would see post Fed meetings just more selling after. It was like sell before, sell during, and sell after. So depends your context.
And that's the scary part about momentum. I mean, 2022 felt like the bulls, all they could do is get like that near-term recovery, and the bears were like, thank you for being suckers. We're right back into our wheelhouse. We're going to sell higher and take it down lower. Like that was a bear market. This is different. I mean, this
is a kangaroo market right now.
Fifth or sixth fastest in history. And I don't necessarily think we make like the August 5th recovery like we did last year. I don't think we're slingshotting back to all-time highs. But I think in that 5,800 zone, the market can fight around a little bit. We can deal with some more uncertainty. I think if the market can get through the first part of April without any major damage to the downside, there's going to be a little bit more of a sigh of relief. There might be more of a grind fest, but seasonality wise, April, May, the market may not be at all-time highs, which is okay. But like I said, it's just really important we don't do too much damage below the like the 550 or 5,500 handle right now.
Yep.
So let me see if anything else is popping up on. Actually, Nick, while I was in here, I actually am looking at a trade on Uber. I was just pulling this one up a second ago. I took a trade that I pulled like $3 out of Uber. It expires Friday, but I closed it out for a small debit, so I took the profit on it. But I'm going to look at Uber out to, I guess I could look out to maybe May.
Do you own any shares in Uber, Chris?
I don't anymore. I own Uber shares. I'm trying to think when I owned it. I took a stab during COVID, like I did pretty much in everything. COVID was good, and then once we settle back in to these double bottoms in 2022, I need to go like $365. Trying to think when I bought it. So we had COVID lows right here, and I was long Uber. Once we got above this all-time high, I was trailing for profits, so that was a pretty nice return. But once we returned back into these like 2020 lows, it wasn't quite at the COVID lows, but I started to get in and nibble around these like $25 marks. I didn't take a huge trade though. I mean, from $25, it was a measure move. It was this low to high and then traded to symmetry. And on this run here, I was just trailing out. So I went from somewhere around like $25 to about $40 to $45. Still a good gain. Obviously missed out on that. But now I'm looking at this kind of broadening pattern. I'm just trying to say I like Uber. I like the discounted cash flow. I still refer to pretty much every rideshare as Uber, even if I'm buying Lyft.
Yeah,
it's still
a household name. I like Uber too. I've got 200 shares of Uber, and I shorted puts at 71. So and that was that comes up pretty soon. So it's pretty close to in the money. I could roll it down and out if I wanted to, but I honestly wouldn't mind the share assignment. A little bit bigger of a position. I love the company too. I think that's I've completely changed my thoughts on Uber. I used to be more bearish on it, uncertain about it, but the proven profitability of it, the household name status, the adoption worldwide, I think that's a household name for many years to come. So I like the stock. Anyways, let's just get a little bit of an update here, guys, because we've just got about 10 minutes before Powell takes the stand. NASDAQ up just over 1% now. S&P up 0.77. Russell, Chris, can we talk about the Russell for a second? Is the Russell
my least favorite index?
This thing is making me mad.
I'm saying it, Nick, because when I started looking, I've got some trades in. I've got trades in that my line in the sand is 190. That goes out to March, April, May. So I've got an income trade on it. I sold premium. But here, I mean, I will take shares of Russell if I need to, but we have to make fresh lows again, which are around 196.
Mhm.
The reason I don't love the Russell as a whole is because until the Fed starts cutting rates, small caps are going to struggle. Majority of the 2,000 stocks are in the the Russell don't make money. That's my concern. They don't make money.
It's
Right?
it's
They need borrowing. They need to borrow. They need to have the cash runway, and they can't do it unless rates are lower. And so
yeah.
until that happens, I just don't. Now the catch-up trade, like we timed in 2023 to 2024, worked out really well. The
Mhm.
trade into the end of the year post-election worked out really well. Like the Russell has that ability to catch up and outperform in that sprint. But
Yeah.
look at it now. It's like I mean, it sucks.
Well,
It's
it needs
down 20%.
it needs a perfect spring day in order to do really
Yeah.
well, and it just
Yeah.
has not had that for a while. And
Yep.
you compare that with the Mag 7, the Mag 7 does not need a spring day to make money and grow. And those
Sure.
things are beast modes even in uncertain times. 2023 was uncertain, 2022, I mean they got hit like everything else, but you got to think about the risk to reward profile like the Mag 7. Like, I get it. Everybody loves them. They're already, everybody owns them and they're probably over, exposed. Everybody loves them. But, they drew down about the same as everything else in 2022. And then they powerhoused everything else for the following 2 years because they're kind of like the new staples trade, right? It's like the modern day, staples. People want the Mag 7 because they grow revenue like crazy. That's slowing a little bit, but again, you can't really get out there and say like, oh, I want to get massively bullish the Russell because it's a tough environment for them. Like you said, I don't see interest rates coming down a whole lot unless you get a recession and the Russell gets killed in a recession. So, it's a tricky trade for me. I think that it's here's what I see though. If tariff concerns, like I said, resolve in some positive negotiations, if that happens and inflation still continues to disinflate, you might be back on track with the Russell. But it's hard to call that. That's a really difficult prediction to make.
I agree.
So I don't know.
And I
like
know some smart traders that are doing the pairs trade. You're long Russell, you're short S&P,
Oh yeah.
and it hasn't worked. Like, and the hard
Is
part
that that Tom Sosnoff doing
you
something
know
like
it,
that?
dude.
Yep, I think I've heard him talk about that. I thought it was like short Nas by Russell or something like that, but maybe it was S&P.
He said like for months now, like he's been short S&Ps, long Russell. I know like
It's a tough trade.
he's like a nibbler. He'll just go in, sell premium, and he just takes tons of like 10% profits. But as far as like his bigger directional trades, if he's skewed on anything, he's probably skewed on the Russell looking for some upside, and it's just not performing. But that's why I dove into like, okay, you don't have to trade Russell 2000. You can trade Russell 200. You can trade Russell 200 growth, Russell 200
IWF.
value. Like those are great. Like I'm way more on board with those. Is like you already get the 10%, which is get rid of a lot of the garbage, and then you can kind of get like the premium.
Well, look at
Russell.
IWF. I mean, there you go.
I know
it's doing great.
Yeah. Well, look at IWX. Look at
IWX.
Look at how much better
Top
this is.
200 value ETF. Okay.
It's hanging in there. Like that Russell looks a lot more attractive to me than anything else right now.
Yeah, IWM, you're just taking a lot of unprofitable stuff that's thrown in there too, right? A lot of debt sensitive stuff. Interesting point. I mean, I made some money on IWF. I traded this one for a while. Sold puts and then just rode it higher. So that was it's the Russell, I feel for it. I want the trade to work. You want something like this to perform. This is the bellwether of the U.S. economy. This is, in my opinion, a more accurate reflection of. It's kind of similar to the RSP, right? This is your equal weight S&P 500. I think this is a little bit more accurate to how the average stock in the S&P 500. This is what that does, right? It shows an equal weighted performance of all 500 S&P 500 companies, and so you can see it's had good performance, but it certainly is no SPY or QQQ, which has outperformed. But long term, the RSP, I feel like is maybe due for a little bit of mean reversion. Maybe a pairs trade is not horrible in that view. If you think the broadening out, Chris, we've actually had a broadening out. It's just been in a weird way, right?
We've had
in a down market broadening out.
Yep, it happens. It's one of the other ways the market broadens out. Like 2023, summer 2023, we had a broadening out of like everything was going up together. But a lot of times the market broadens out with the market falling together. Nick, I just took a trade on Uber.
Did you?
I'm doing a 112, so I'm buying a put at 67.50, selling a put at 65, selling another 2 puts at 60. Collected $1.33. It's only an expiration out to May 16th, which is 58 days out. Probably going to be an income trade. Probability of profit is around 87%. If I took on shares of Uber, I would own them. Let me do the numbers here. That would be the assignment would be 200 shares at $60. So $60 assignment. And then I have another 250. So $1.25 minus 60 minus the $1.33.
Mm-hmm.
So I'd own the shares. Why did I do the math backwards? 60 minus $1.25 minus $1.33. There we go. 57.42 would be my break even. So right now on Uber, if I own it at 57 and change, that would be, we'd have to have another 21% decline on Uber, and we would be probably, I'm guessing, 30 to 40% off the all-time highs.
So you bought a call and sold 3 puts.
No, it's all puts. I bought a put.
Okay.
Yep. So basically what this does is this provides like a little bear trap.
Yep.
So if I'm right, this gives me $250 in a profit trap. That also lowers the cost basis of my assignment, and then I still collect credit on the actual put itself. That's like
a bull put spread, and then you've got 2 additional puts sold lower.
Yeah, it's like a ratio. Okay. I'm spacing out, doing the 1-2 for ratio spread. I'm doing a 1-1-1.
Okay. Yeah, I mean I like the stock. I've been way more interested in stocks here recently than I have in a long time, Chris. There's been some stuff on sale. I got Amazon going. I got Nvidia. Finally, I still feel like this is aggressive, but I've been looking into some cybersecurity stuff, Fortinet, Palo Alto. I like those names quite a bit for the long term. I think that this is, check this out, Chris. This is a crazy concept. In the tech world, I think cybersecurity, this may come back to be like a famous last words. I think cybersecurity might be in the technology sector a bit of a staple in the technology sector. I think going forward in the next 10 years, cybersecurity is not an option to spend money on. I think the world is getting to a point.
It's a necessity, yeah.
It's a necessity. It's a staple in the tech world.
Yep.
So I think that you've had this. Look at this. We've had stocks. I mean, ignore CrowdStrike for a second, but Fortinet's down 14.5%. There's other stuff that's gotten way more waxed than that in the tech world. So I think on a relative basis, yes, this has gotten hit hard. At one point down 18%, and that's more than the indices, but tech generally moves higher, faster, and lower faster. So, I feel like cybersecurity stuff is high risk, high reward as most tech is, but it's an interesting part of the market. I also think, go ahead.
What do you like? You said CrowdStrike and Palo Alto.
I like Palo Alto and Fortinet. And
Fortinet, okay.
I like them all. I mean, I would have a little bit exposure. I hope they go lower. I'd build bigger positions if they did, but I think that they're just great long term. And again, these are things that if you're going off a PE ratio, they're just scary. But if you're going off of, a lot of stuff has high, like Amazon has had high PE ratios since inception.
True.
So
very true.
PE ratios are difficult to try and use as the ultimate. Is this a decent or bad pick at all? Amazon has had high PEs forever, and the company has done phenomenal for decades.
I'm just going to put it in my Uber trade here. I'll get that posted for Pulver alerts.
Yep.
So
no worries. Guys, we're counting down. We've got up next, Powell is taking the stand. We're going to hear from him. We'll see, market reaction here so far. And you have to understand this. This makes sense once you realize, why did the market go up on what was largely considered a non-event? Well, it's because people who were selling their shares before out of fear may just be buying back their shares. And anytime you get a fear event behind you, a lot of times you'll see the market kind of rally after it, right? It's just people buying back their shares that might have sold ahead of time. There was no ginormous fear with the dot plot realized. So the market might just be saying, well, all right, let's move on to Powell's speech. With Powell's speech, just a couple things that we're discussing. Let me do a rapid fire with just 2 minutes to go. We're going to go as fast as we can. Economic heat map generally shows that the U.S. economy, we have inflation cooling decently. Jobs data is mixed. It's okay. It's not It's not phenomenal. It's not horrible. It's okay. At the same time, most things are pointing towards a bearish dollar. Most things are pointing towards a mixed reaction for the stock market. And I think the Powell's just going to say we're at an okay spot, and we're going to wait to see what tariffs bring. We don't know what the data that tariffs could have. Like, they could come in fine, or things from tariffs could really seriously negatively impact the market. I think the Fed has the luxury with what I just discussed. Inflation is cooling decently, and the jobs market is holding up decently. The Fed doesn't need to do anything right now. They don't need to cut rates a whole bunch this year. They don't need to hike rates. They're comfortable, in my opinion, just holding them. And I think that's what we're going to hear from Powell. The surprise factors could be, and I think this is the most volatile portion of his speech, would be questions about tariffs. And if he kind of goes off the rails a little bit like he did a few months ago in December, if he goes off the rails and starts letting in more insights on tariff concerns, things like that, then yeah, you could get some serious market volatility. Right now, like I said, I think Powell's going to say we're good where we are, and we're going to kind of wait and see. And we're going to wait for some further clarification about what the tariffs actually look like. I mean, we're all thinking about this right now. Tomorrow, Trump could sit down and have a conversation with, Canada or Mexico or Europe or whatever, and they could come to the negotiation table and fix things. That is possible, and the Fed knows that too. We don't know that for certain, and so the Fed is going to probably say exactly what we're saying here, which is we're going to wait for more clarification before we make any sort of hardline decision. And here we go. We got Powell up on the stand.
Let's see it.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1%.
Tell me if this is following me is better, guys.
I'm not hearing anything on him, Nick.
Oh, sorry, one sec.
Projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So two things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariffs? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also frankly a little bit of inertia. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms. Can you say that today, that we have that price stability, that households and businesses are ignoring price growth when you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring
situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else?
Didn't you get everything wrong before?
So I'm just wondering why
Don't
the
you
nine
suck
aren't
at your job?
taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
Pandemic? Yes, during the
because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that.
Dude,
and
Powell's a beast.
it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them. And we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all.
it's also not where the forecast is. I don't know any mainstream forecast that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, you know, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer, and I have nothing new for you on that today.
Well, well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless, we take notice of it.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And, you know, we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully. And we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that, you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that. And the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero. And you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know in a couple of months. We'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what in your mind would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is like, frankly, housing services inflation, which by the way has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have 4.1% unemployment. We've got 2% growth. And, it's a pretty good economy, but people are unhappy because of the price level. And we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts. The median was. And so you come in and you see, broadly speaking, weaker growth, but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that. And we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time. And that probably has to do with, turmoil at the beginning of an administration that's making, big changes in areas of policy. And that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast. And I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer, and people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant. Although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change. And in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5 year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Chris, I think I'm capped out. I think we're mostly behind all that stuff for now. What do you say we call it good there?
Yeah, all good, dude. It is. I mean, like you and I were talking online or offline. It's good that he's coming in to be a little bit more reassuring to the market. I was just writing down GDP growth steady, labor market steady, wages outpacing inflation steady. Acknowledging that tariffs are creating uncertainty, but we don't know what will be tariff-based inflation versus others. Obviously, we've been dealing with past inflation that we're trying to focus on. So, I mean, all in all, reassuring to the market. We're seeing that in price action. A little bit of noise. It's been just a steady run to the upside. That 572 level that I talked about it's just been swelling the entire time I've been sitting here watching it for the last hour.
Yep.
So that's a good thing, and hopefully that offers up the little relief rally. And if this is the thing of this is a sign of things to come, then perhaps we are kind of in the clear for maybe that like 5750 to 5850 zone. And then we'll see where the possible like bulls and bears fight it out. But I think for right now, it'd be nice to see tomorrow follow through as opposed to wipe this entire move away. Right. I think that's another key of price action for the rest of the week, is to finish out this week on a high note and see if the market can kind of put in a nice green candle to fight back a little bit.
Yep. You got NAS up 2.3, S&P 1.8. I mean, market's ripping, minus 10.5% for the VIX here today. That was pretty bullish reaction overall. Again, Powell not too disturbed by tariffs, at least for now. Didn't seem like there was anything baked into the policy shift to adjust for that. So not too worried about the economy. That's a pretty positive Powell, for probably the most positive you could ask for given the uncertainty ahead of us. Chris, thanks for hanging on. We're looking at just about 6 hours, so I got to hop off and actually film a video. So I'm going to gas out for the last 30 minutes here, and we'll be back tomorrow. Thank you very much for coming on, Chris.
Yeah, it was fun as always. Thanks, everybody.
Everybody go find Chris. Find him on YouTube at Chris Pulver. We'll drop his link in the chat. Chris, we'll see you next time. Thanks for joining me, man. See ya.
Yep.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.